Summit. We're excited about it. We've been running it for a long time. We have about 450 LPs that are here. We obviously have a very scaled alts platform. We manage or supervise over $500 billion of alts across private equity, private credit, infrastructure, and real estate. And so we've been doing this, as you said, we've been in the alts business for more than 30 years. But the growth of private capital formation continues. And candidly, I still think we're in the early innings of private capital formation when you look at the scale of it. I think it's very constructive for markets. Obviously, some of the private capital formation is also a response to the regulatory structure, particularly when you look at private lending and private credit. And some of that, in my opinion, is going to get rebalanced out, in the coming years. But it's important, and I think one of the strengths of the U.S. Economy is that we have the most robust capital markets and capital formation system in the world. I was just in Europe last week, and it's a completely different ecosystem. You don't have the risk taking, you don't have the participation of retail investors and the stock market broadly, and so the private capital formation ecosystem here is a very powerful driving force for the strength of the U.S. economy, and something we should all support.
Those alternative investments have historically been for wealthier investors, and there's the one take on it that, hey, everybody should be able to get access to this. The reason it's been a little more limited to individual investors is that sometimes these are pretty illiquid investments. And what does that mean for somebody who doesn't have a lot of liquidity or other things to fall back on? What do you say to people? How much should you have before you get invested in some of these things? What are some of the wariness, some of the concerns people should have?
Well, we certainly let investors speculate in lots of things with a lot of latitude.
More so lately.
That I think with a long-term view, certainly can be, riskier than a diversified portfolio.
Don't have the 200.
Some alternatives. I think like everything else, there's time and place. Time and place matters. And, I think about it appropriately. I have children that are, in their 30s, and I think about the retirement accounts, an allocation of 20 or 25% in the retirement accounts where they're really putting money away for 30 years and they don't need that liquidity. I think that makes a lot of sense for somebody that's working hard, is saving, is building a retirement. I think that makes a lot of sense. And so we are going to see more access to these products in a variety of different channels that allow investors to participate more. Whenever we do things like that, there are people that push too far, or there are practices that develop, and those are things that should be watched and, need to be managed appropriately.
I'm thinking your kids have a really good future. For some,
I'm very.
You're saying generic 30-year-old children. You're not talking about David Solomon.
I'm very proud of my kids. They're working away.
All right,
they're
but I think
somehow they
going to be.
They popped out and they're doing great.
David, one of the things that I think about though is the private assets. The whole private world obviously uses sort of a different disclosure and transparency policy than public assets, and we're putting effectively those private assets in the public markets in this sort of unique way. And whether you think there should be either guardrails or different sort of auditing techniques or other things. I mean, one of the things about the NAVs of all of these funds is, to a large degree, they are being maintained or decided by the fund managers. And I wonder, once you get into a public market space, whether they really need to be provided ultimately by some kind of third party or even fourth party that are somehow independently verified as we sort of get into a different place with all of this.
Well, I think you're raising a couple of things because private companies do have different reporting standards. Although there are lots of private companies at scale that report the same way they would report,
right,
if they were a public company. That's different from valuation metrics against private investments and how private investments are valued and how those marks are moved over time. So I do think as there's more exposure of these products to broader markets, this is something that'll get discussed and debated, and I think it's an appropriate thing to think about. One of the reasons why I think that the activity, if you look at private equity in particular, that the activity or the monetization or the broad cut of private equity assets has been slower is because in 2020 and 2021, a lot of those assets were marked up.
Right.
The values actually declined below the marks, and the marks didn't necessarily follow. We've now been through a period of a few years where those businesses have been growing back into the marks. So
the industry,
that is something to think about.
But the industry would say that's a bug, that's a feature, not a bug, right? That the idea that you can actually hold those assets at a marginally different valuation than the public markets, that you're not marking it to market all the time, is actually a feature of that piece of it. I'm not arguing that's the case. I'm saying that's what they would tell you.
I think like most things,
You're a
Andrew,
mark-to-market kind of guy.
I think we've been a mark-to-market firm in a lot of ways for a long time. I think it depends on the context. So that's fine if you're in something that's truly illiquid,
Right.
okay, and you don't have any liquidity option for years and years and years. If you are offering some sort of liquidity, you know, a percentage of liquidity, whether it's on a quarter basis or an annual basis or something like that, then the actual value that's delivered when people look for liquidity matters, and then the marks become very important. So I think generally speaking, it's prudent to mark things for what they're worth and where they can be sold. There are others that would disagree strongly.
Guaranteed of doing well. I just, for the heck of it, went on AI and said, has Harvard dug itself out of a liquidity PE mess that its endowment got into? You know,
There was no bias in that prompt to the AI agent, was there?
it didn't go like this. It came up with a no immediately that Harvard has not yet dug it. And this is, how far back does that go?
That was pre-financial.
Yeah, just before the financial crisis, and there's still about, I don't know, 40, way too much, and it still can't get out.
There's no question the ability to monetize these investments over the last 5 years has been slow, but that's been a choice on the part of the managers, and that's reflective of the incentive system that basically they have a long-dated option to keep compounding the value.
Harvard can't do it. Should the individual investors be expected to?
I think there's a time and place. You know, I think there's a time and place for everything. But I think when you look at these products, you have to think carefully about time horizons, liquidity, and you really have to understand. But we certainly allow individual investors to invest in lots of things that carry a greater degree of risk if you're not factoring in liquidity.
More and more of these assets not being taken public,
Yes.
it does raise the question of how do you get in on this? Do you agree with the Trump administration's push to say we shouldn't be reporting quarterly, like every 6 months instead?
So I've been thinking a lot about this. Yeah, I mean, I've been thinking a lot about this, and I'd say, first of all, I think there's an argument, a good constructive argument, that to have companies, public companies, reporting every 6 months in a full-scale reporting parameter would work well. There's a lot of work that goes into quarterly earnings. I know the arguments for transparency and the quarterly transparency, but 6 months is a very short period of time, and it allows companies, you know, to focus on those true releases and spend more time, you know, really focus on strategy and business. If there was, you know, a shift to that policy, a lot of companies, including Goldman Sachs, might still report on a 4-quarter basis, or we might report 2 quarters where we really report, you know, differently, a little light. We give information, but not to the same scale. But I think there are reasonable arguments. Companies should be focused on long-term performance. It's important for investors to have transparency, but, you know, I don't think there's a lot of difference between transparency twice a year and transparency every quarter.
Let's shift and talk a little bit about some of the concerns we've heard recently with private credit. It's certainly been a big issue with some of the regional banks. Zions Bancorp was up today after reporting yesterday, and it didn't look like there was additional problems there. But you know these markets a lot better than most people do. Do you have concerns about what's taken place there, about the standards for some of these credits, about potential for fraud?
Well, it's interesting. You're talking about regional banks, and so you said private credit. Regional banks are lending as they do. That's their business. I think that it is interesting that we've had 3 events that, on the face, seem to be 3 idiosyncratic events. And you know, 3 idiosyncratic events does not make, you know, a trend or a systemic issue by any stretch. I do think it's an appropriate time for people that are significant players in credit markets, given we haven't had a credit cycle for a very, very long time, to be looking at their portfolios, thinking about their risk management practices. And look, at the end of the day, credit is about underwriting standards, diligence, process. You know, it's a very, very deep process-oriented, you know, investment practice. And, you know, one thing I know for sure is when we do have an economic slowdown, and we will someday have an economic slowdown, when we do, and when we do have a recession, you know, we will go through a credit cycle, and you certainly will see, you know, losses and pressure on those that lend and provide credit. We've just gone through a very long period of time. We have historically very, very tight credit spreads, and I think it's probably a time, you know, to watch carefully. But I don't see things at the moment that lead me to say there's something broader going on. And without economic pressure, it's hard to see a real credit cycle. Although I guarantee things will pop up, just as these things popped up.
We were talking to Rob Kaplan, who now works for you again,
Yes.
Yesterday. One of the things that I think is up for grabs, and I don't know if anyone knows the answer yet, is the idea that so much of the credit market has now moved off balance sheet from the banks and is in the private credit space. Has that effectively de-risked the entire system, or is it as risky because there are these liquidity lines between these things, because there is leverage that's oftentimes offered by the banking system into the funds? What do you think?
Well, I mean, a couple of comments. You know, first, one of the things I think is very important, sometimes I've heard people talk about the regulatory system, the unregulated system. It's one system. It's all interconnected. It's one system.
Meaning a problem anywhere, it's a problem for the whole body.
A problem anywhere has an impact on the whole system. I think one of the things is we live in a world of remembering what's in the rearview mirror, so we remember, 17 years ago, and that doesn't mean every time we have a credit cycle, we have economic pressure, that you're going to see something systemic in markets. And I think that's a very, very important point. People are talking, Andrew, to your point, a lot about lending that goes to support the deployment of private credit, and you have to remember that a lot of that lending is securitized lending. I've seen some articles recently that said the people that are doing that lending don't really understand what they're lending to. That is not true. These facilities allow them to underwrite and pick credit by credit that are put into the facilities. These are secured facilities, generally speaking. And so, a lot of this is process, collateral selection, and I think most of the practices in the industry are good practices. That doesn't mean that there can't be people that pop up who don't. There will always be. You're 100% right, Jim. There will always
be. You can say, oh, we got it this time.
Yeah.
Underwriting standards across. There's always going to be people that are going to cut some corners to try and take business, market share.
Yeah, and one of the things that's happening is the flows, into these products have been significant. And so the people that have taken those flows feel pressure to deploy. And that's when you start to, when credit spreads are tight, you get late cycle. And we're definitely late cycle. Doesn't mean the cycle can't go on for quite a period of time, but you get late cycle. Sometimes standards decrease, and so I know there'll be places in hindsight that we can point to and say, oh, there's another example of that when there ultimately is a credit cycle.
There was a lot of talk of bubbles just over the last week, bubbles in AI, bubbles in markets. You don't particularly like that term. It's not one you want to use yourself.
Yeah, I don't like to be over dramatic.
The bubble in bubbles.
I've been looking at tech multiples and trying to put tech multiples in a historical context. I've looked at a variety of data on public company tech multiples, and also private capital formation for tech companies. And it strikes me that that the multiples are kind of 75th percentile or 80th percentile. So there's no question, we're somewhere in a cycle where the values are higher, but the growth opportunity coming from AI is significant. But I'm certainly in the camp that they're going to be winners and losers. Capital's been allocated to companies that are going to be hugely important companies, and it's going to be allocated to companies that ultimately won't make it or won't succeed in that context. And ultimately, whenever we have a new technology, especially at scale, and you have significant capital formation around it, they're going to be winners or losers. We're not smart enough to pick them all, and ultimately there's a rebalancing. But I think the long-term trends around this technology, the opportunity for productivity gains for some great companies to be formed is really quite exciting.
How about how you're using it internally at Goldman Sachs? Because you've made a lot of comments in the past about how this can really do the work for investment bankers much faster.
Well, I think there are a couple of base ways that we're using it. We're very focused on this. The first is we've always, since I started 40-some years ago, we get technology tools into the hands of really smart people to make them more productive. So I always joke about doing a common stock comparison 40 years ago. It took 6 hours. You had to go to the library, go get microfiche to get back issues of the Wall Street Journal. Now somebody can do it in seconds. It doesn't mean we don't have a lot of very smart young people doing a lot of work. They're just doing different work than they did when I started 40 years ago. And so we continue to get these tools into the hands of our very smart people, and it makes them more productive. It gives them an ability to spend more time with clients, to do more. It scales our footprint, our reach. The more interesting thing we're spending a lot of time on, you might have seen last week, Becky, that we put out a memo where we announced what we're calling One Goldman Sachs 3.0, the evolution of our One Goldman Sachs operating ethos, is we're really looking at 6 principles, throughout the firm to operate the firm more efficiently, serve clients better, where we're looking at processes inside the firm and saying this technology gives us the right and the ability for the first time to reimagine these processes and really do them entirely differently, to automate a bunch of things, to create meaningful efficiency that then can be reinvested in growth in the business. It's not just taking out cost, it's giving us more capacity to invest in our business and grow. And so we announced that because we're doing a lot of work internally. And we said that in January we'll talk more specifically about how this can affect the business. And we wanted a framework to be able to really work inside the firm and really drive this forward. But I can't find a CEO that I'm talking to in any industry that is not focused on how they can reimagine and automate processes in the business to create operating efficiency and productivity. And that's a really good thing for economic growth.
Does that mean that this time is different and that it's not just going to make your employees more efficient, but it's going to reduce your headcount? Or
I don't think it's different. Technology has been having an impact on headcount, the way people work, what workers you have, for decades and decades and decades. And this, I think one of the things that's happening here that's a little bit different is this is going at a pace that's quicker.
Yeah.
And so because the pace is so quick, I think there's a possibility that there's a little bit more volatility or, an unsettled transition, around certain job functions and things like that. But at the end of the day, we have an incredibly flexible, nimble economy. We have a great ability to adapt and adjust. And yes, there will be job functions that shift and change. If you go back 25 years ago, we didn't have 13,000 engineers at Goldman Sachs, and we've shifted and changed. My guess is the mix of engineers with this technology will again shift and change, but I'm excited about it. If you take a 3 to 5 year view, it's giving us more capacity to invest in our business. And I see lots of opportunities for our business, but I still feel some constraints because we've got to deliver returns as to how much we can invest to grow our business. And this should free up more capacity to do the things we want to do to serve our clients and grow our business. And that's exciting.
What other acquisitions do you want to make?
Well, I'm excited about the acquisition we made last week.
I know.
If you humor me for a moment to say 2 words about it.
I'm very happy to, yes.
We bought a company called Industry Ventures, which manages about $7 billion of kind of early stage venture. It's touched over 325 venture firms. Hans Swilden was the founder of the business, an extraordinary guy. We've known this firm from a while. We had a stake, a 25% stake in the GP through our XIG business, and Mike Brandmeier and our XIG business, knew Hans and was close to Hans, and Hans approached him to say he was getting some interesting offers for the business, and Mike appropriately said, hey, let's bring this business into Goldman Sachs. And so what this allows us to do is really expand an offering to our clients and give more access to our clients to early stage venture. But if you think about our ecosystem, our banking ecosystem, our private wealth ecosystem, getting access to these businesses earlier than we would naturally see them in the life cycle of Goldman Sachs creates great synergy for us. And so we're quite excited about it. And I think this acquisition represents the kinds of things we're trying to do, things that expand our offering and accelerates the growth trajectory of our asset and wealth management business. And there are other things like this that we're looking at, some small, some bigger, but we really are trying to broaden and expand what we think is a very powerful asset wealth management offering.
So if we were all sitting together 5 years from now, what would Goldman Sachs look like? Same?
I think 5 years from now, and look, there can be ups and downs in the world that can affect it, but Goldman Sachs will basically have the 2 principal businesses that it's in now, where it's a leader and has a right to win, banking and markets, where I think our position is, without dispute. And then asset and wealth management, where we supervise right now $3.5 trillion of assets. We've talked publicly about the durable revenue in that business growing high single digit. If you look at our last earnings report, it's growing faster than that. And so we can continue to grow that business. I think we can add inorganically to that business to broaden that platform and accelerate it. And I think that those are 2 businesses that Goldman Sachs has a lot of room to run, a lot of room to win, and a lot of room to create value for shareholders. And so we continue to be excited about the value trajectory that the firm's on.
David, I want to thank you for coming in today. We know you have to run, but we appreciate your time here.
Well, I really appreciate you guys having me. It's good to see you.
Alternative has nothing to do with music. You said that. LPs, alternative, and you're an aficionado too.
Oh, I love music. I saw your comment about Walk Away, Renee. on the front page of the Post, early.
Did you understand what
I
you saw?
absolutely understand that. The
Yeah.
four
You know
tops.
why?
The rest of
Because you're a boomer.
Yeah, because I'm old like you.
You're like me.
So I'm old like you.
We're old.
Becky and Andrew are much
But
younger.
among all the other benefits
Yeah.
of being old in terms of wisdom and seeing the moon landing and all these
You
things.
know all this great old music.
And we understand the cover of the Post.
Absolutely.
We got that
Absolutely.
going for us.
Absolutely.
Which is
It's
nice.
good to see you all.
Good to see you.
Thanks and have a great day. Appreciate it. Thank you.
Coming up, NASDAQ just out with better than expected results. Its CEO, Adina Friedman, is going to be with us to break it all down and give us an update on the IPO pipeline. That's coming up right after the break. Don't go anywhere. And then next hour, you don't want to miss this, an exclusive interview with somebody who he sometimes holds his tongue. No, not really. Pershing Square's Bill Ackman. It's not happening on X or Twitter. It's happening here on Squawk Box. He's got a lot to say about New York City's mayoral race. We're also going to get into his latest take on the markets and so much more. 8:30 a.m., folks. Do not miss it. Squawk Box is coming right back after this. Welcome back to Squawk Box. NASDAQ results out this morning's earnings growing 19% to 88 cents per share. Congratulations. 2 cents better than estimates on revenue of $1.3 billion, just ahead of expectations. Company saying that market volatility from macroeconomic and trade policy uncertainty boosting trading volumes. And join us right now to weigh in on all of the Q3 results, plus the market landscape, the IPO pipeline, and so much more. NASDAQ CEO and Chair Adina Friedman is here. Good morning to you.
It's great to be here.
Double digits.
We're very happy about it.
Double digits. So what's going on? Where does this go from here at this point? And can you, I mean, these numbers are pretty great. And so the question is, can you keep going at this pace?
Yeah, well, we feel great about the results. So we had 11% revenue growth for the quarter, and then we have a 3 and 3/13. So we've reached $3 billion in our annualized recurring revenue, which is a 9% growth, and that's the third quarter in a row that we've been able to demonstrate that 9% growth, talking about sustainability. And then 3/13. So in our market modernization program, in terms of our markets, we had 13% growth in our trading business, our markets business. In the innovation economy, supporting the innovation economy, we had 13% growth in our index business. And then in our fintech division, which really supports the trust in the financial system, we had 13% growth in our fintech division as well. So really, really proud of the broad-based growth we've delivered.
Right.
The way that we're engaged with our clients is spectacular. You know, there's a lot of demand for what we do, and there's a lot of trust that they have in us to be able to deliver for them.
So you moved actually to arguably more durable, these durable parts of the business that are less volatile based on what's going on in the market, but you did benefit from this market. So what do you think is happening in this market right now?
Yeah, so we have had very robust trading volumes in the markets. And when we look at the options business, we had 6 of the top 10 trading days ever in the options markets in the third quarter, with another new record in October. And then in the equities world, in the cash equities business, really strong volumes throughout the quarter, but now we're actually reaching a point where we're having an average of 20 billion shares traded a day in October, so it's a lot of volume. So what's really happening is, I think it's macroeconomic news that creates a lot of different investor sentiment. We've had about a 5-year increase in the amount of retail investment in the equities markets, which is a very sustainable trend. You also have the fact that you have this new technology called AI that's delivering a lot of promise and actually delivering a lot of growth. We looked at the NASDAQ 100 over since the beginning of 24, which is when really AI started really kind of coming into the earnings of these companies, has the earnings of the NASDAQ 100 grown 32%. The index value has gone up to 47%. So you actually really are seeing that these companies are earning their returns. They're earning their valuations in that regard. So all of that, I think, is kind of combining to create a lot of interest in the markets and a lot of activity.
Is the options that these crazy day short term? Is it all speculation and gambling?
What?
Or is that the incremental addition? I mean, what did you say? 6
Yeah,
out of that?
6 out of the top 10. So we've actually been seeing, overall in the options business, over 100 million options traded within a day. So it's a lot.
It
So,
used to be hedging. It used to be
well, there's a lot of
reasons to-
hedging. I mean, I still
Is
think
there a
it's.
lot of gambling?
I think that it's both a combination. The options markets have actually always had a lot of retail and a lot of institutional interest. But the retail interest has definitely increased over the last 5 years. But institutional interest as well. I mean, short-dated options really are about being able to make decisions and kind of change your opinion. The macroeconomic environment has delivered a lot of mixed data. It's changed. There's a lot of changes that happen from day to day in the world. And I think the options markets are a great way to be able to reflect your views on those changes, both at a macro level and a micro level.
We're not allowed, I don't think.
Talking about measuring
That's all
your
I
views.
need. DraftKings.
I'm just curious what your reaction was. A week ago, guys, your competitor of sorts, ICE, took a stake in Polymarket. And I'm curious what you think of that whole space, given what you do.
Yeah, well, prediction markets are interesting. I mean, I focus on the prediction markets as it pertains to financial assets. There's a lot of other predictions happening out in the prediction markets, but when you look at the financial assets, do you want to have a binary way of thinking about it, like almost like a yes/no decision on what the future value of a stock would be or the future value of an index would be? I think there is actually a real market for that. But you can do that in a regulated market. So would binary options be something that we would want to offer our investors? That is something that we'd be interested in.
But is that something you would go out and acquire and take a piece of Kalshi or somebody else, or would you go and do it yourself?
I mean, when it comes to financial assets, I feel like we have an opportunity and a right to win in terms of being able to offer those types of solutions in the markets that we operate. And then we would look, I think that overall the prediction space is interesting, but right now, we like to operate in regulated businesses.
Right.
We think that our regulated markets provide proper investor protection, that we actually have the guardrails to understand how to operate them, and we can do these types of assets. We can make these assets available in
But
regulated.
only
That's
for-
interesting that you don't feel as comfortable with the other stuff that reaches outside the regulated markets.
Yeah, we've had a lot of experience over the years in understanding how to operate markets, both in the regulated space and unregulated space. And our view is that regulation has a reason. There's a reason for regulation. It gives you the right guardrails, the rules to be able to trade in. And I think we have a real right to win in these regulated markets. As the SEC and the CFTC start to think about bringing more asset classes into a regulatory regime that we can understand and that investors can understand, and they're putting guardrails in place for investors, then it makes us more confident and comfortable that we can bring our great leading solutions to
So
those
the prediction markets is just like for financial, so not the political end of things, because maybe you should be watching that, because if Mamdani wins, you might be moving this entire place to Texas. And I don't know, would we go? What
To
are
Texas?
I mean, yeah, we have a lot of great states in the United States, so it's exciting. She's already got.
operations.
But no, but
We
I-
do.
That's what I mean. We might-
But I'm
As an
curious.
output
But I am
of
curious.
those.
So you think? I mean, all of the sort of betting or investing in, who's going to be the next mayor, or where Taylor Swift and Travis are going to get married, which is also apparently you can
Do you
bet
think
on
that's
that.
reckless for the ICE, for ICE to get involved?
No, I'm not going to speak on behalf of their decision.
But
I'm
you
going
don't
to say
want
that prediction markets are an interesting space. What we focus on is what we think are real financial assets and how we can be a great market operator for financial assets. That's really our focus.
Talking about financial assets, so the IPO market is now hot again. The window seems to be open. SPACs seem to be back. How long do you think this is open? How wide is the window? What's going on here in terms of what the pipeline looks like?
We've seen a fair amount of momentum as we've gone through the year. And so what is causing the momentum? Investors are definitely, professional institutional investors are more ready to take those risk decisions. And I think that the reason for that is, number one, you've got changes in monetary policy. As we know, if you take down the cost of capital, that makes investors more excited and frankly more confident in understanding the future earnings of a company, and it makes them more interested in taking that risk. I think the second thing is that the deregulatory environment in the United States continues to be a tailwind. And the third is that the U.S. economy remains resilient. I mean, there are obviously some mixed economic signals, which is of course driving that change in monetary policy, but the overall economy remains resilient. So I think investors have gained a lot more confidence in being able to underwrite IPO risk. We have a very healthy pipeline of companies looking to come out, and we're pretty excited about how it's moving forward. Obviously, the government shutdown, frankly, is creating a short-term issue, but I think that'll be very temporary.
And then I wanted to ask you actually about cybersecurity, because that's something you focused a lot on, and in the context actually of just what happened yesterday with AWS, because we had this big outage across the country. I don't know if that impacted you in any material way.
So our markets were not impacted in any way. Some of our SaaS solutions had some impact, but we're fully recovered at this point.
When we think about the risk in the system of resilience, both in the sort of cybersecurity realm, but also even more broadly, even in just what happened yesterday, how should we think about that?
Yeah, I mean, first of all, as a critical infrastructure provider, we think about risk and resilience every single minute of every single day.
And redundancy.
And redundancy. We strive for perfection. Perfection's impossible. But the fact is that we strive for perfection, and resiliency is such a core underpinning of who we are and how we operate. And as you said, redundancy, you think about also, redundancy in every element of your business. And at the same time, I think that as cloud providers become critical infrastructure, and we as operators operate on that critical infrastructure, we all have to focus together on those redundancies in the way that we are building that resilience for the system.
Earlier this month, NASDAQ, the Wall Street Journal, NASDAQ has become the market of choice for dubious penny stock IPOs.
Well, one thing that we really do focus on is investor protection, and we have actually proposed
Tighten
changes
standards,
to
right?
our listing rules.
But you like that
and it's
business.
really-
You'll take the business, right?
Well, I think that frankly, we are changing our rules to elevate the standards to make sure that as companies come onto our market, they are basically raising enough capital and broadening their investor base so that it makes it so that those stocks are less likely to be subject to manipulation. And so the whole idea for us is we do care deeply about investor protection and making sure that we are bringing companies onto the market that both have great promise and great interest and expectations from investors, but also that have enough capital coming into the market to make it more difficult for bad actors to come
Right,
and
you
manipulate.
don't need to be if people want to take risks in penny stocks.
Well, our view is that we want to be the home to companies at early stages of their lives, as well as the largest companies in the world. And that is the role of public markets. You want to allow small cap companies to come in and grow their businesses and make those investments available to investors.
You still need
but you need to have enough capital to come in to make sure that you've got a broad-based investor base.
Do you still need diversity on your board to list on the NASDAQ?
So that rule was eliminated quite some time ago.
How long ago?
So I think that it was sometime last year. So yeah, and our view is that governance is an important part of being a great company and making sure you have proper governance. And there's a diversity in a lot of different ways, but that rule no longer exists.
By the way, there wasn't a rule. It was just about disclosure.
Right.
Just to
do it.
put it out there.
Someone called me DEI as a boomer.
Oh well. Adina, thank you for coming to this.
Thank you. It's great to see you.
Much. Just squawk
Thank you.
DEI boomer something. So
Is that right?
I'm very pro DEI if I am.
I'm glad.
Well, your job is safe.
Exactly.
Great. Thank you very much.
Thank you.
Really great to be here. Or really great to be here with you, I guess we should say.
Well, it's great to, we love having you here.
We love being
As
here.
always.
We do love being here. We'll go to Texas. Coming up, U.S. soybean farmers waiting on any new developments in the trade war with China. What was I saying? Oh, we will get into that issue and much more with Agriculture Secretary Brooke Rollins in just a few moments. Squawk Box returns in just a minute.
A couple of earnings movers to tell you about this morning. Aerospace and defense company RTX reporting earnings of $1.70 a share. That beat the estimates of $1.41. Revenue also beating expectations, and the company raising its full-year guidance. As a result, that stock up by better than 5%. In the meantime, Northrop Grumman's earnings also beating estimates, and that company raising its full-year guidance, but it did lower its full-year sales forecast. Those shares are off by just over 2%. Lockheed Martin earnings coming in at $6.95 a share. That beat estimates of $6.36. A revenue of $18.6 billion also beat the expectations, and the company raised its full-year guidance. That stock up by about 3%. And then there's Elevance Health, that company reporting earnings of $6.03 a share. That was well above estimates of $4.93. The company managing to keep medical costs in check, reporting a medical loss ratio of 91.3%. That compares to estimates of 91.7%. And Elevance also affirming its full-year guidance. That stock right now up by 1.6%. Shares of tobacco giant Philip Morris are higher this morning. Earnings came in at $2.24 a share. That beat the street's expectations of $2.09. Revenue of 10.8 billion, also beating expectations, and Philip Morris shares up by 3.75%.
All right, coming up, Agriculture Secretary Brooke Rollins on two big issues: the soybean trade and the trade war with China, how that's being impacted. And the U.S. apparently is considering buying some beef, importing some beef from Argentina, as prices have soared. He joins us next and later. Senator Ron Johnson on the government shutdown. He'll join us at 8:10 a.m. Eastern Time. Squawk Box returns in just a moment. U.S. soybean farmers caught in the middle of a trade war with China, with potential aid for the industry being held up by the government shutdown. Joining us now with more, Agriculture Secretary Brooke Rollins. Madam Secretary, it's great to have you on. Thanks for joining us.
Good morning. Good to be on.
What do we need to do? Will aid be forthcoming for farmers? And are you optimistic that when the president meets, presumably next week with President Xi, that they could restart? I mean, I know soybeans got a boost when it looked like that meeting was on. Are you expecting a resumption of exports to China for soybean farmers?
Well, yeah, first of all, thank you so much for having me on. I think the president has been very resolute in his constant work to try to find these markets for all of our great goods all around the country. I mean, the trade realignment that began earlier this year, we've now had massive trade wins all across the world: the UK, the EU, Indonesia, the Philippines, Taiwan, Australia. Sort of the list goes on. And for the farmers, for agriculture, no one wins more under that scenario than our farmers. Having said that, when you look at China, specific to soybeans and sorghum and a few other row crops are in there too. You know, China, we had a trade deal with them in 2019. The Biden team came in. They did not require abidance to that trade deal of China. In fact, we had no new trade deals under the 4 years of Biden, which is part of the problem, one of the big reasons we're here. But to your point, the president Again, even yesterday in the cabinet room, in the meeting he was having, I think with one of the prime ministers, perhaps from Australia, he was talking about how we've got to get soybeans sold out into the world market, and he feels fairly encouraged that he thinks we can get something done. But I will say, the biggest point in all of this is how important it is that we continue to strike these trade deals around the world so that our farmers aren't so reliant on one buyer, especially our soybean farmers and especially with China. So we're working on that too.
But farmers probably do feel like collateral damage because we have so many issues with China. I mean, we could just go down the list with technology and, security and Taiwan and all these things. And China manifested that by cutting off entirely. I mean, I know it was slowing a little bit under the Biden administration, but they were still buying soybeans from us. It went to zero at the beginning of the year. None have been sold, I don't think, in 2025. Well, do you think that in any negotiations we have with China, will that be something that we insist on to arrive at a deal?
Well, I don't want to get ahead, obviously, ever of President Trump and our amazing negotiators, Secretary Bessent, Ambassador Greer, and Secretary Lutnick. They continue to just work literally around the clock on all of this. I do know that as we're watching the markets, as we understand where different countries are around the world, I mean, for example, Japan, in their trade deal, committed to buying $8 billion of goods, including soybeans. When I was talking to Italy, they buy many of their soybeans from other countries, and we thought, we need to be talking about buying soybeans from America. But there's no doubt that we are in a bridge point right now, that the president is working to ensure all these markets are open. But as he moves over to Asia in the next few weeks, and as we have those continuing conversations, we are there to support these farmers. And I know you mentioned at the top of the show, and I think on this show a few weeks ago, Secretary Bessent talked about the potential trade aid package to those farmers who've been hurt under the current trade renegotiation. Once the shutdown lifts, once the Democrats, I think we had 10 votes as of yesterday, once the Schumer shutdown ends, then we'll begin to start moving out some of these programs that are so important to our farmers.
This government shutdown's not helping, Madam Secretary. Jameson Greer pointed out you can't just take the tariff money and just say, okay, here you go. Congress has to allow that. So then the next thing that would be nice to do is to let farmers get these marketing assistance loans with Senator Thune once the administration did that. But you can't do that because the USDA would have to reopen Farm Service Agency offices, which were closed.
Yeah, look at you. You know what you're talking about. No, that's right. The Farm Service Agency, the FSA offices all over the country are closed right now. These farmers, even if they have checks in hand, under some old rule, have to have a USDA signature. We're working to change that moving forward once we get through this as well. But no, it's sort of an unbelievable compromising situation with this government shutdown, not just for our farmers, who of course are our number one constituents at USDA and frankly the backbone of this country, but for the SNAP program, the food stamp program, which of course we administer, for the WIC program, which we administer, just the running of a massive agency. But back to your point, I thought was so good on the farmers and these loans, this aid that's there. At the end of the day, I think, and I always try to say this, these farmers don't want checks from the government. They want to be able to sell their product. And again, this short-term, bridge that we're building to get us to the next phase, all of these trade deals that the president has struck, every one of them really begin to move into effect beginning next year. But why these loans are so important and this aid is so important right now is why these soybeans are sitting, in piles waiting to be sold while we're waiting on China and other markets. They are already planning for our farmers what they're going to do next year, what their planting season is going to look like. They're halfway through harvest right now. But in order to be able to do that, to secure the loans needed to plant for next year, they have to make sure that they've got the money coming that will allow them to secure the loans for the next planting season. So that's what we're really focused on. This isn't just about our farmers. This is about national security, being able to feed ourselves, and ensuring that we've got the products that are necessary and that these farmers have the support that they need.
can you explain, Madam Secretary, why beef prices have soared and all to get to the point of where we're thinking about importing some beef from Argentina, the same country that's selling all of their soybeans to China? I mean, there's a lot of moving parts, and you're always, you're going to make someone mad when you do something. The president's just trying to lower beef costs, but to soybean farmers, that must be like, you're kidding me. We're going to import beef from Argentina when this is the same country that, and we're helping them out in other ways, obviously, but the farmers seem like the ones that are left out. What about, are we going to do that? Is that feasible, and why? What happened to beef prices? How do we bring them down?
We have had a massive run on beef over the last decade. We've had almost 17% of our producers close, which is about our ranchers, which is about 150,000 ranchers have now stopped ranching. It's a whole other show. We need to describe that, but basically there's been a massive consolidation, which has not been good for our ranching industry. We have, offshored a lot of that to some companies in Brazil and some other internationally. China owns some other companies. There's a really important realignment that has to happen for us to begin to onshore. When we talk about onshoring and reshoring for manufacturing, we need to onshore and reshore for our beef producers, for our ranchers. So the prices are high. The president is very focused on fulfilling his promise of bringing grocery prices down, but he's also very focused, and you'll hear more from us perhaps in the next day or two, on what we are going to do to incentivize, to open up new lands, to make it easier to become a rancher, to build more processing plants around the country so there aren't just a handful in the middle of the country. We've got a pretty big package coming out. Haven't talked about it publicly. This is the first time, but that'll be coming out very, very soon. Again, perhaps this week, and we'll be able to begin to move the onshoring of beef back to America. And of course, as you know, the bigger supply, even aligned with a bigger demand, is going to allow those prices to come down, but also to have a vital industry for these ranchers to be able to survive in, which is what we've got to do.
What about beef from Argentina? Is that a possibility?
Well, the president has mentioned it a couple of times. I think you'll be hearing more about exactly what that looks like. Right now, in America, we consume about 12 million metric tons of beef. 10 million of that we produce here in America, but the 2 million I'm talking about, we've been offshoring, and there's different parts of that, what McDonald's buys in ground beef versus the actual muscle cuts, which is what a lot of Americans, the healthy part of all of this. I mean, here's the other thing that's so exciting for our beef industry is that Bobby Kennedy and my partnership with Making America Healthy Again, a lot of that is going to be moving around the new dietary guidelines around a return to saturated fats, and what that means for our protein industry, beef, chicken, et cetera, poultry, pork is really, really, really encouraging. But having said that, we've got to make sure we've got the production to be able to align with that. So yes, the president has said he's in discussions with Argentina. I think we'll be hearing more about that in the next day or two. But as part of that 12 million metric tons, it will not be very much. Argentina is also facing a foot and mouth disease issue, which we at USDA have to ensure that our livestock industry is secure. And I know you've heard a lot about the screwworm coming up from Mexico. Foot and mouth is a challenge too. So we're on it. We're on the front lines. We're going to ensure our livestock industry is protected. But this is a very nuanced, very complex market, but that we're moving in every potential possible direction to make sure we've got a good future for these ranchers.
All right, Madam Secretary, thank you.
Thank you so
good to
much.
have you on, Secretary Rollins. Do you remember Where's the Beef? When I asked, this is my boomer quiz. What year?
Where is the beef? I remember
Where's
that
the beef?
too. Where is the beef?
1984.
Yes.
1984. Clara.
That's right.
Where's the beef? Apparently it was at Wendy's. I don't know if it's still there. We're looking for it. Madam Secretary, thank you. Spark Box coming right back.
Give it credit. come back, Morgan Stanley's chief U.S. equity strategist, Mike Wilson, will give us his latest call on the markets. Squawk Box returns in a moment. All right, welcome back, everybody. It's 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among our top stories this morning, conservative politician Sane Takaichi has won Japan's parliamentary vote, becoming the country's first female prime minister. Ambassador Jameson Greer accusing China of retaliating against firms investing in key U.S. industries like shipbuilding. The U.S. trade rep called it part of a broader pattern of economic coercion after Beijing sanctioned U.S. units of a South Korean shipping company. And activist investor Starboard Value has taken a nearly 5% stake in construction firm Fluor. That's according to the Wall Street Journal. Starboard plans to push for ways to lift Fluor's share price, including possibly selling its 40% stake in NuScale Power, which develops small modular nuclear reactors.
I want to take a look at the futures right now. We do have some green on the screen after some red earlier this morning. Right now, the Dow up about 32 points, the S&P 500 up about 4 points, the NASDAQ up about 10 points. Want to get over to our good friend Dom Chu. He's got a look at this morning's pre-market movers. What's on tap, my friend?
All right, good morning, Andrew. Good morning, Becky. Good morning, Joe. We've got plenty of earnings movers this morning to keep an eye on, and a lot of green on the screen. So we're going to start with shares of General Motors, up over 9% right now, after beating its third quarter estimates and raising its full year profit guidance. Now, it comes just a week after GM announced a $1.6 billion impairment charge on its EV business. GM CFO Paul Jacobson telling our own Phil LeBeau just last hour that he's not putting a timetable on full profitability for EVs. Now, an improved tariff outlook, also strong gasoline vehicle performance is helping to boost the stock. So keep an eye on GM shares up 9.25%. Meantime, another General Electric Aerospace, GE Aerospace, also rising to the tune of 2% after beating its quarter with strong profit and revenues guidance. The jet engine maker saw stronger revenue growth in its commercial engine and services business and improved its full-year revenue outlook for that segment as well. Its defense and propulsion technology segment also saw revenue growth north of 25%, but it did see a contraction in orders during that quarter. But on balance, a 2% gain for GE Aerospace. And we'll wrap things up with shares of Lockheed Martin also moving higher to 2.5%. The defense giant also beat estimates in its report amidst a record backlog and revenue growth across every single division it has. It also raised its revenue and profit guidance and increased its quarterly dividend by 5%, and its share repurchase program by an additional $2 billion. So keep an eye on those shares. I will send things, Becky, back over to you.
All right, Don, thank you.
You got it.
Joining us right now is Mike Wilson. He is the CIO and Chief U.S. Equity Strategist at Morgan Stanley. And Mike, there have been so many questions about what's happening in the market. Volatility has definitely stepped up, but you've been of this long-term view that we're in pretty good times for quite a while to come. You're still feeling that?
Yeah, I think our differentiated view is what we talked about, I think the last time I was on the show, is that we believe that we were in a rolling recession for the last 2 or 3 years. The private economy has been quite weak. I think the Treasury Secretary sort of said the same thing. And now we're in a rolling recovery. The recession itself ended with the Doge layoffs. And if we look at the data closely, and we've documented this, it shows very clearly that there was a spike in layoffs, and there was a low in all the jobs creation, which the revisions now are proving. And the stock market figured this out. The stock market's smarter than all of us, and the confirmation for us is that the earnings revisions now have really exploded higher in a way they only do in a new economic cycle.
That's what I think is so interesting. David Solomon was here just a little bit ago, and he called this late cycle. You think we're still early cycle?
Well, I think we just transitioned.
Yeah.
Now, where I think I also differ, have been differing, is that the cycles aren't going to last that long. Right, we're now in an inflationary regime. It's very different than all of our careers where inflation was coming down. And what that means is that these cycles can't be elongated the way that they were, because the Fed has to respond ultimately to higher inflation. Think about the last 5 years. 2 years on, 2020, 2021, 1 year off, and a nice recovery in 23, 24. Then we had another kind of capitulation recession in this year, and now we're into a new 2-year cycle. So you just got to keep that in the back of your mind.
That's not that different than what he was saying then. What David Solomon was saying, we're late cycle, this could have another year or two to run.
That's right, but I think that context is important to distinguish, because if it's late cycle, then you only want to own sort of defensive, high-quality names. In an early cycle new recovery, the market will expand, it will broaden out, and that's kind of what's starting to happen now. We think that's the story for 26. It looks a lot like 21 in that regard.
What do you like?
Well, we like a barbell at the moment, because we still think the Fed needs to cut rates. So we've been on the cyclical side. We have liked a lot of the tech sector. We have like financials. We have like industrials. That's the pro side on the cyclical side. And then the defensive high quality side, it's basically healthcare right now. We think healthcare looks quite interesting. Now, we do think the Fed will get with the program, and they will start cutting rates in a more meaningful way once the labor data confirms what we all know, which is that the labor market is not that good. And when that happens, then we can really transition to the interest rate sensitive parts of the market that have been languishing, things like housing, things like consumer goods, all the durable goods, the areas where there's pent up demand.
How difficult is it to not have government data at this point? Yeah, because you sound so sure in your beliefs on these things.
Well, I think the government data that we're waiting for, everybody's waiting for, is mostly the jobs data, but that's backward looking. I think we've already confirmed that the trough was in April. That doesn't mean, by the way, we're totally out of the woods. But what it means is that I don't think we're going to learn a whole lot from this data that we're not seeing at the moment. I think it gives comfort. I think it will give the Fed the cover to do what I think they need to do, which is cut rates in a more meaningful way. So to me, that's the risk, is that we don't get the data that allows the Fed to cut more meaningfully.
And when you say more meaningfully, you're talking about more than 25 basis points at a clip?
Exactly. Let me just put it in context. So the Fed is behind the curve, in my view, until they get lower than 2-year Treasury yields.
Okay.
Today it's about 75, 85 basis points. So that's just 3 cuts to get to neutral. To get ahead of the curve, they probably got to cut 150 plus. And the only way they're going to do that is if we get weaker labor data, which I think is probably forthcoming, or we get some sort of bond volatility or financial stress, the third mandate, if you will.
All of your thoughts about the market continuing to climb from here, what would happen if we do get some of that bond market turmoil that you're talking about, or tensions continue on this China trade front? Because that's been the macro issue that has made markets wobble recently.
Yeah, so I want to distinguish. Our 12-month view is quite constructive for the reasons I just laid out. But in a short-term basis, this is probably the first time since April that I think we had maybe a tradable correction. And it would be those 3 things you mentioned. First, the China-U.S. trade tensions. We're kind of walking towards this, deadline. The markets may get nervous around that. And by the way, it's a correction. It's not like we're going back to where we were in April. But a 10% correction would feel pretty nasty. The second reason would be we get funding market stress, which, by the way, the Chair Powell talked about last week. That's one of the reasons why we may NQT a little bit earlier next year because we're starting to see a little bit of funding stress, which is essentially the bank reserves are maybe a little bit too low for the liquidity we need, not just for the financial markets, but now for this economy, which I think it could be booming next year. So those are two reasons I think we could see some corrective activity in the near term. I don't think it derails our core view on the rolling recovery.
It's nice you said all of us have spent our entire careers in a low inflation environment. It was nice that you
One exception.
Yeah, it's nice that you threw me in there. And just to, because it's hard to believe, inflation rate, right when I started in the business, 13.5%. Inflation rate, 13.5. Unemployment, 9.5.
Wow.
And what was
9.5.
like a 30-year mortgage?
Prime rate went to 21.5, and the 30-year mortgage was 15 or 16. No one was ever going to buy another home. And I was lucky enough. We at Maryland were lucky enough to design a product that where you, instead of getting 13.5 tax-free municipals, we did a floating rate thing.
There you go.
Instead of locking that in, we put people in. Hey, you don't have to worry. It wasn't going up from 13.5. That was the time, but
30-year zero coupons, what you wanted to buy.
Exactly.
That's what my mom was pitching me.
Because they're not, you couldn't call them.
That's
Because
right.
yeah, exactly, they weren't callable. Yeah, but when you think about things being bad, think of 13. I mean,
I can't, that's.
that's like almost speaking of Argentina, that's like a South American type inflation rate.
But I think it's important to distinguish, like, inflation is not bad for stocks, okay, because it creates earnings growth. It's just different.
Yeah.
And if you think,
Painful for everybody living through it, though.
well, it's painful for the consumer,
Yeah.
right? And that's why we have this bifurcated economy. But don't fear inflation next year. In fact, if we don't get inflation next year, I'll probably get more bearish because that means the earnings story is probably not going to deliver on what people are expecting.
You are really contrarian on all these things. We tell people some of the stuff you say and they go, that's insane.
That's good. That makes me feel better, quite frankly.
Yeah, it does. But yeah, you're right about the earnings revisions. You're early.
Yeah. And that's a leading indicator. So we know that next year's numbers are going to be quite good. And once again, one of the key risks to that is that we don't get inflation. We don't get the CapEx boom that they're kind of gearing for. That we need that. And then inflation becomes a problem in these cycles when the Fed has to respond. And they're not in that mode right now, right? They're going to let it run hot intentionally. But eventually that probably will
They
come
move
back.
the goalposts.
That's right. Well, not until they move the goalposts,
Exactly.
until it becomes a constraining factor in the economy.
Exactly.
Right.
Mike, thanks for coming in.
My pleasure.
All right, we got some news this morning to tell you about right now. A series of product updates coming out of Airbnb, the company launching new social features for experiences so people can connect through the app with people they meet during their travels. Also, Airbnb saying it has now expanded its AI-powered customer support to include more languages, also some better answers. And tomorrow, right here, first on CNBC, we're going to be talking with CEO Brian Chesky about these updates, the state of travel, the consumer, and so much more. A conversation you do not want to miss at 8:30 Eastern Time at this table.
And coming up, getting paid during the shutdown. Senator Ron Johnson has introduced a bill to do just that for certain individuals. He joins us after the break. And then investor Bill Ackman will be here. His thoughts on what's happening in New York City with the mayoral race and much more. We'll be right back. A vote could come as early as this week on the Shutdown Fairness Act, which would ensure that federal employees not receiving paychecks still get paid. Joining us now with more details, Republican Senator Ron Johnson, who introduced the legislation. How's it work, Senator, and welcome?
Good morning, Joe. First of all, I'm just getting sick of reporting on these shutdowns. You've been around here a long time, so have I. Since I got to Congress in 2011, this is our fourth shutdown. We've had 55 continuing resolutions. We've increased or suspended the debt ceiling 12 times. I'm just getting sick and tired of it. I introduced the Eliminate Shutdown Act. We could do away these for all time. Right now, we're in third week of now moving to the fourth week of this shutdown. And all I'm saying, and this should pass 100% bipartisan support, we forced federal workers to work. We call them accepted, but these are the essential workers, the people that pay your Social Security, federal law enforcement, military, that kind. We force these people to work, and we're not going to give them a paycheck. By the way, there's already a law that we will pay them back pay once the federal government gets reopened. We've got appropriation bills. So this is just a charade. It's a very destructive charade. It's, people are playing games with people's lives. TSA agents shouldn't have to go to food banks. You shouldn't have, as a air traffic controller, drive DoorDash to pay tuition for your daughter. But that's what we're forcing federal employees to do. It's absolutely ridiculous. If they're going to work, we just pay their salary. This is across the board. Whether I like the agency they work for or not, it's anybody who's being forced to work by law, we just give them a paycheck. Just makes perfect sense. Again, it'll just be so unbelievably disappointing if Democrats won't even support that.
Wouldn't you need to open the government to pass that law, though, Senator?
No.
No? How would it work?
I mean, listen, let's face it, most of government remains open and functioning. And again, the people who are working that functioning part of government, they're going to get back pay anyways. This isn't anything more. So we just pay them now.
Is there a way to do it without what you're talking about? I mean, there's money, right? The president founded for the military.
Well, that ability is going to be limited. He can find certain pockets that he does have, reapportionment authority on, but that's going to be limited. I can't really tell you. I mean, I'm sure Russ Vought is as good as anybody at doing this. They found enough money to pay the military for their first paycheck they would have missed. I'm not sure there's going to be money for that. I think air traffic controllers, and that could be a real pinch point here. But again, it makes perfect sense. Just pay the people. They're going to get paid anyway. Don't put them through this kind of agony. Don't put the stress on their families. Just pay them.
Why don't you take it a step further and say no government shutdown?
Right. Well, yeah, right. But then the Democrats, they will wait till Thanksgiving if they're not forced to, to worry about the workers getting paid. I mean, that's an impetus to get something done, isn't it? Now you're going to remove that impetus.
Okay, the best solution was my Eliminate Shutdowns Act, which just would have established rolling 14-day continuing appropriations. And again, what really was disappointing that is that the reason even some Republicans voted against the Eliminate Shutdown Act, they said it would undercut the appropriations process. But let me describe the appropriations process I'm supposedly undermining. I've been here, we should have passed 180 appropriation bills before the start of the fiscal year, 180. You know how many we passed? We passed 6. So they're complaining about undermining an appropriation process that has a 96.7% failure rate. And again, so the appropriators, let's face it, the Uniparty loves this dysfunction. This is how they create these cliffs, put all kinds of pressure so that they can write up a 2,000-page omnibus spending bill that nobody reads, drop on our desks and say, oh, hey, it's Christmas Eve tomorrow. You want to go home? Better vote for this sucker. That's one of the reasons we're $37 trillion in debt. So it seems dysfunctional. It is dysfunctional here, but this is a very well-honed process by the Uniparty, basically the big spenders in both parties, to just spend money that we can't afford.
Yeah, the Uniparty. And right at the top when you said, yeah, we've had 5 shutdowns, it's like, yeah, how many they were bipartisan, right? I mean, they weren't all Democrat shutdowns like this one, right?
Well, again, 55 continuing resolutions. I voted for most of those. I don't like to shut down government. Democrats have voted for most of those. Now all of a sudden they're saying we're not going to vote for this clean continuing resolution. Again,
how's this going to end? Where are we now? Is anyone? What I see that Senator Shaheen said something. Fetterman, Angus. What's the running count now? How does it finally happen? Is a deal made with Chuck Schumer, or do do some rogues break off from the minority leader and vote for it?
Well, we've had 3 Democrats consistently vote with us to just pass the House continuing resolution, but it's been that same 3. Now, they had a chance. We were hoping that after their protests this weekend, that would take the pressure off and they would release some of the people who aren't even running for re-election, like Senator Shaheen or Senator Peters. There should be enough of them. Senator Durbin, there are people that ought to just step up the plate, take the heat off of anybody else who might get into trouble with their radical left, and just do what makes sense, is just open up government and give the appropriations time to work itself out. And by the way, that's what the Eliminate Shutdown Act would do as well. It wouldn't undermine the appropriation process. It just keeps government funded at last year's levels, Biden's levels, by the way. Listen, I don't like this continuing resolution. I don't like that spending level. I don't like the fact that they're ending this one right before Thanksgiving and they're creating one of those cliffs. But I'm voting for it because I don't want to see the government shut down. I don't want to be playing with people's lives.
Do they really want the 1.5 trillion, or do they want the 345 billion just for the pandemic era ACA subsidies? What do they hold? What do you think they're going to hold out for? Because
they'd love the 1.5 trillion. They don't mind more in the future. But I think their core ask really is to continue the enhanced subsidies. But again, there's been a real, I think, purposeful misconception about that. They make it sound like the subsidies are going to go away. They won't. You just go back to Obamacare as it was originally poorly designed. It's Obamacare that's driving up premiums. So let's say you've got somebody at the poverty line and their insurance policy costs $18,000. They'll still get a subsidy of $17,500. But right now they're getting the full thing paid, no premium policies, which is driving massive fraud, probably millions of policies signed up by unscrupulous insurance brokers and agents. The money goes right to the insurance carriers for policies that people don't even know they have, so they're not using them. So it's a massive fraud, $20 to $30 billion a year. Anybody who wants to extend those enhanced subsidies is basically voting to perpetuate that massive fraud. Again, Democrats don't care. I'm concerned that there may be some Republicans that are so afraid of the lies, they may join them to extend those. But
you can feel it.
We are happy to talk to Democrats about repairing the damage done by Obamacare, and there's been a lot of damage done. Totally screwed up the individual market, drove up premiums, drove up deductibles, got rid of high-risk pools that could have been tweaked, could have taken care of pre-existing conditions, but Obamacare destroyed all that, drove up premiums, so they're being forced to subsidize and enhance the subsidies to pay for the premiums that have been driven up by Obamacare. So happy to fix that, happy to repair that damage, and transition to a system that actually would hold down healthcare's costs.
So what would have to happen? Would President Trump have to just repeat what you said, we're happy to do this, and they'd have to, that's what Senator Mark Kelly said. He needs the president to say, we will definitely do this if you reopen the government. Is that the way out of this?
Well, again, Democrats could demand you extend those subsidies. Well, we would say, listen, we'll work with you. Let's bring free market competition back into the healthcare industry. Let's bring back, way more consumer choice. So Rick Scott, an expert in healthcare, right? He's working with people like myself, leadership, the White House. Let's design the Republican plan. We completely blew it with the repeal and replace. I never liked that term. I always said, let's repair the damage done, transition to a system that works. Health savings accounts. Again, open up the marketplace to high catastrophic plan. Let individuals use money we deposit in a health savings account to buy whatever insurance they want. Association plans. I mean, there's all kinds of good free market ideas out there that give consumers the choice, put them in the driver's seat, and bring back the benefits of free market competition, because that's what we've driven out of healthcare.
Hey, Senator, the clock is ticking, though. Like, you know that November 1st is open enrollment period again. You know that these issues are coming up quickly. Are there conversations that are taking place between Democrats and Republicans right now to get some of these things done? Because what you're talking about, some of these free market competition and other things, we've heard this go round and round for the last 15 years about what all of these things mean. Nothing's gotten accomplished. What can you get accomplished quickly so that people, like you're saying, people who aren't getting paid right now, people don't suffer without health care insurance too? How do we fix this in a way and fix it quickly?
So again, I keep hearing this November 1st, this is when premiums are going to be announced. Again, premiums are going not because of the enhanced subsidies, being taken away. It's because of the poor design, the faulty design of Obamacare, where you made individuals pay the full cost of covering people with pre-existing conditions. But if you're at 400% of the poverty line or below, yeah, your subsidy will be reduced slightly. Again, for somebody at the poverty line, it's $50 a month. It's $10 a week. Again, it's going to increase costs, but again, from $18,000 subsidy to $17,500. So again, if you're above $130,000, you're not going to get subsidized. You should have been subsidized. That was a mistake. We never should have done that. Okay, so I don't think this is going to be any kind of gut-wrenching problem if these enhanced subsidies just go away. We will probably have to weather the lies told by the Democrats. But again, we're happy to work with Democrats and fix the broken Obamacare system.
Millions of people are going to die. They've said millions of people will die if these subsidies aren't renewed, enhanced.
Democrats say all kinds of things that aren't true. I mean, I got that, and it does scare people because a lot of people in the legacy media carry their water, amplify their falsehoods. I got that. That scares a lot of Republicans as well. It doesn't scare me. I'm just looking at the reality situation. We need to describe the reality, which is what I'm trying to do on the show. Again, these subsidies don't go away. People will still get the subsidies. Obamacare, as poorly as it was designed, will still be in place. People still get subsidies. We need to fix Obamacare. As even the Washington Post said, the problem with the Affordable Care Act is it was never affordable. Boy, no kidding. Rates, here's one rate classification. Inflation's gone up about 39%. These premiums have gone up about 118%, 3 times the rate of inflation. That's just one data point. It's hard to look at it because you've got so many different premiums, but again, Obamacare has been a disaster. It did not, you couldn't keep your doctor, you couldn't keep your health care plan. That was a PolitiFact 2013 lie of the year. It's driven up premiums, which forced Democrats to subsidize and throw good money after bad just to hide the fact that Obamacare has completely failed at controlling health care costs.
Senator, I am at a loss. You mentioned legacy media. I don't see a lot of outrage about the government being closed either. Comparable to the last time that it was closed. It's like, hey, we have to do this. It's understandable.
First of all, we've got a Republican president who's making it as painless as possible. When Democrats are in charge, Republicans getting blamed, they make it painful. This president's trying to make it very painless, and you're right. Most Americans don't recognize that whatever parts of government are shut down, they don't even realize it. So that's why I'm trying to come in at this point in time. Democrats aren't budging. They didn't come back from their I hate America protests and vote to open the government. So let's at least pay the people we are forcing.
I have to fact check you there. It was not an I hate America.
I'm sorry.
It was a no kings. It was a no kings protest.
I listen to House members much. Sorry.
Yeah, exactly. All right. We'll see you again. Thanks for coming on today.
Have a good day.
All right, still to come this morning, from the markets to the mayoral race right here in New York City. Pershing Square's Bill Ackman will join us. Got a lot to talk about with him. Squawk Box, we'll be right back.
Novo Nordisk says its board chair and 6 other board members, will step down. The outgoing chair said the board has not been able to reach an understanding with its majority shareholder. The Novo Nordisk Foundation regarding the future composition of the board, the Wegovy maker, has called an extraordinary general meeting for November 14th to elect some new board members, and its majority shareholder has proposed a slate of candidates.
Coming up next, a conversation you do not want to miss. Billionaire investor and CEO of Pershing Square, Bill Ackman, is going to join us right here to discuss the New York City mayoral race, the markets, the government shutdown, and so much more. Squawk Box coming right back with Bill Ackman after this. Welcome back to Squawk Box. Election Day here in New York City is just 2 weeks away. It's become a national conversation. Joining us right now is a discussion about the mayoral race, the markets, the economy, and so much more. Pershing Square CEO Bill Ackman is here. Good morning to you.
Morning.
You have been quite outspoken on X and elsewhere about this mayoral race. A lot of folks around the country looking at New York as a proxy for what the Democratic Party even looks like. You've been calling on Sliwa to get out of the race. You've been calling on all sorts of things to happen. Right now, in terms of where you think things actually are, based on what the numbers are, we've been looking at Polymarket and other things, and it seems like Zohran Mamdani is the clear favorite, not just the clear favorite, but that almost under any circumstance he's going to win at this point.
Remember, Polymarket is probability wins the election based on the facts that exist now. Probably accurate. However, if Sliwa were to say, I'm not going to run, right now the polls are 43, the most recent polls, 44 Mamdani, 33 Cuomo, and 19 Sliwa. I've seen polls that say the Sliwa voters are going to vote 65% for Andrew, 7% other. and 25% won't vote, something like this. But if slew of voters vote for Andrew, Andrew wins. The key is Slew has to be out of the race.
And just
It's
not only have to
almost
get out of the
impossible.
race, and we were looking at the front page of the New York Post this morning, which was also calling for that. Does he have to get out of the race and endorse
He doesn't have to
Cuomo?
look, I think the smartest thing he could do for his legacy is to say, look, I love New York. I care about this city. I've put a lot of energy in keeping this city safe. You know, the polls, the facts just tell me I'm not going to win this time. I'm going to step aside. You know, I'm going to rely on Andrew to take care of the city. I'm going to keep doing my job protecting New Yorkers, and I'm going to run in 4 years. And then we'll build we'll have a gold statue of him in Times Square. And I know actually a guy offered to pay for a gold statue of him.
Let me ask you
Gold,
this.
by the way, it's gone up in value.
So that's expensive.
Let me ask you this. We've had Cuomo on the broadcast. We've asked Zoran to come on. He has not come on yet.
There's a reason for that.
And there's an invitation that's still standing.
By the way,
watching.
Here's what you should do. You should go to the DSA website. It says the capitalist economic system is the cause of violence, unemployment, and a climate crisis and poses an existential threat to life on Earth.
That's the Democratic Socialist.
That's the DSA, which is Zoran's policy. How can he come on CNBC?
So my question to you, though, is when you look at sort of the number 1, 2, and 3 issues that you have with him, and I am assuming that your vote for Cuomo is effectively a vote against him.
It is.
Right?
And I like Andrew.
What are the issues for you? Is it about capitalism? Is it about policing in the city? Is it about anti-Semitism? I mean, give me the list, but in the true priority, because I think there's a lot of people who think that maybe you're in this because you don't want your taxes raised.
Okay. So number one, I love New York. I love New York City. It's been very good to me. I care about this place. It's one of the greatest cities in the world, but it has issues. Okay, where is Mondami right? He's right that we have an affordability issue here. Okay, why do we have an affordability issue in New York? Rent is too high, right? Utility costs are too high. Why is that? Right? The answer is because of policies that he wants to make worse, right? Real estate developers would love to build more apartments in New York. There's enormous demand, right? Economics, if we increase, there's not enough supply to meet the demand, so what happens is rents go up, right? Why is that? Because we make it, one, extremely difficult to build in New York, all kinds of regulatory, other, not in my backyard, protests, things that drive up costs that make it uneconomic to build new housing. Then there's rent regulation, right? If you're telling people we're going to freeze rents, well, number one, you can only freeze rents on 1 million, maybe apartments, not the other, 25% of the housing stock, not the other 75% of the housing stock. We've got 50,000 apartments that sit vacant because the owner can't economically afford to renovate them because they can't earn a return on the incremental capital they put in. If you look at places like Argentina, which deregulated rent control, rents come down because supply comes back into the market. Some supply comes in immediately, apartments that are being held off, and then developers start building. What you want in New York is you want cranes everywhere, building apartments, and that's going to drive down, that's going to keep rents from growing at a rate in excess of inflation. So affordability is a problem. Why are electricity costs so high? Because of Green New Deal, because of people fighting power lines, because of people shutting down natural gas, nuclear power plants, and that has caused the cost of. And we're going to have all this. We have all this demand from AI, of course, for power. That's made it more expensive for people. So he's right on affordability, but his policies are wrong. So that's an important issue. Another important issue is public safety, right? The mayor actually probably has more impact on public safety. That's probably the most important issue for most New Yorkers. And if he has a hostile relationship with the police department,
right.
Okay, you already are reading stories about people retiring in advance of Mondami being mayor. If you look at what he said prior to the last few months of running for mayor, he was a defund the police are wicked, the police are evil. These are his words, his tweets, it's sort of in the record. That's not a guy who's going to be able to motivate the police. He's talked about, shutting down Rikers, right? So I would say affordability, safety, his policies are wrong. He's accurate in identifying the problems with the city, but his policies are going to
explain why you think, in your mind, he is doing as well as he is, on track to become the next mayor of this city.
He's a very talented politician. He's charming. He's got a nice smile. Now, I would argue if you watched him in the debate, every time he answered a question, he'd finish with his smile. It's a constructed smile, and it makes me not trust the guy.
So here we are having this conversation. He now uses you and your name almost as a proxy to suggest why he should win, which is to say, interestingly, when you talk to especially younger people, they say, if the real estate industry, for example, if my boss hates him and doesn't want him to win, I want him to win because I think that he's going to help me.
And they're going to come to regret that. I mean, if you, 1% was just a editorial in the Wall Street Journal this morning. 1% of New Yorkers pay 40% of the taxes in the city. And if you attack that 1%, those are the most mobile 1% of New Yorkers. And they can live 183 days outside of the city, and they can take their tax revenues elsewhere.
You've stayed here. You've been in New York this
Yes, I have.
Would this be the thing that pushed you out of the city?
Look, what I would say is, putting me aside, it's a marginal cost decision for everyone who's in New York City. And you weigh the benefits of living here for 183 days of the year versus the costs.
Right.
One of the costs is taxes, and not just personal taxes. Personal income taxes are going to go up. I think the bigger issue is he's talking about taking corporate income taxes for a business located in New York City to 21%. That's before you get to federal, right? And a CEO is a fiduciary for the shareholders of the company. And if you can locate the business in Miami and eliminate 21 percentage points of corporate tax, he's going to do that, right? So the matching New Jersey and forgetting that there's also New York City, New York City and New York State, taxes here. It's just it's going to destroy the city.
There are national Republicans. They like New York, but they don't live here, and they think Republicans win the midterms if this guy gets elected. It becomes that. The Democrats have a real problem, whether they endorse this guy or whether they accept him, because it's just acknowledging all these things that they know don't work. And they're afraid, they're so feckless that they can't say, we don't agree with any of that stuff.
You're right, and I think the Republicans are being short-sighted about this because I think there are follow-on implications for the rest of the country. If Mondami is successful in New York, he's going to inspire other candidates.
Successful in winning.
Winning. To inspire other DSA candidates at the state legislature, in other states around the country.
We'll know where the Democratic Party actually is.
So you're right. If we destroy New York, it will set a bad example.
Maybe it's a sacrificial lamb to out the current state of the Democratic Party and where the geographic center of that is.
It's the current state of the Democratic Party, and by the way, if I were a card-carrying member of the Democratic Party, I would be very concerned about this as well, because it's the party is veered.
What happened to your card?
What's that?
What happened to that card?
I never really had. I was always first of all, I was always a centrist. To be super clear,
you were pretty woke. You were pretty woke for a while. Yes,
I was never woke.
In my view.
And now we're like simpatico. That's clear.
I left the lights on and you came home.
Okay, there you go. Okay, thank you.
And
thank you for welcoming. But in all seriousness, New York City is the most important economic driver for the country, right? President Trump is concerned about New York City.
And he, in his own way, that would be an unbelievable fall for him.
It's terrible for New York.
He wants it. I don't think.
Look, you don't think the National Guard is coming here the day after the election? I do.
Well, if we're shutting down Rikers and there are criminals roaming the streets and people are getting, we become Chicago. Yeah, we should have the National Guard here.
So let me ask you a different question, which is, to the extent that there's 2 weeks left and you would like to see Cuomo win, I think you not just have to convince Sliwa to get out of the election, you effectively have to try to persuade some of the voters that would otherwise vote for Mondami to vote for Cuomo.
Actually, no. All we need to do is get out the vote. Okay, here are a few interesting facts. Typical mayoral election, what percentage of the registered voters vote? It's like 23%.
The minimus amount.
23 or 24%. Right? So if all you do is you say to people, this is the most important New York City election we've had in whatever 100 years. Okay, and it's not underestimating the facts here. And all you need to do is get out of bed in the morning, okay, and show up at the poll. You're already registered. Vote. Vote for safety in the city. Vote for sanity. Vote for a place where businesses want to locate and keep jobs, bring jobs. New York's on actually, people underestimate Adams. He actually did a pretty good job. And the city is economically in a pretty good place. People are actually coming back to the office again after COVID.
Why doesn't Adams endorse Cuomo?
He should. He should.
And you
should
think he
endorse
will?
Cuomo. I don't know.
It doesn't matter?
On the margin, everything matters, but getting people out to vote, that's the most important thing they can do. By the way, every CEO of every company in New York City should say to their employees, I'm giving you, election day, come in after lunch, but vote. vote for the future of New York City. We don't want a socialist candidate who believes in seizing the means of production. His words, right, on a video, right? This is what he believes. He's kind of modified, he's mollified some of his beliefs.
What do you tell the people who say, look, you know what, the mayor can't do that much anyway?
Mayor can do a lot. If you care about safety in New York, the mayor, first of all, he's not committed to keeping Jessica Tisch, who's done an excellent job, right? Why is he not committed to keeping her? Because he knows, he says he's not keeping her, it's going to lose votes, but he's not going to keep her. There's no way. It's going to bring in his own person on crime, and we're going to see more crime.
Let me ask you a slightly different question before we get to the markets and everything else. What do you think happened? You know, this city has been the financial center of the universe for a very long time. Do you think that would shift if he was the mayor? And I ask because Jamie Dimon just opened up a beautiful new headquarters and has invested an enormous amount of money here. And so there is this view, especially among Mamdani's supporters, who say, nobody's going anywhere. Everybody says they're so mobile, but look at what's happened. These buildings are here, they're gonna be here for a very long time. Maybe a couple people move here and there, the city's gonna be fine. I'm just...
The problem with that analysis, look, I think JP Morgan's going to have a meaningful presence in New York City, but also, look, if you focus on hedge funds for a moment. Hedge funds are a very important taxpayer and employees who work for them in New York City. They're the most mobile businesses in the world. Ken Griffin, left Chicago because he was upset about everything from people getting killed on the streets to the way that dysfunction, the way that city was run. And he went to Miami. And Miami's becoming a financial capital, and it's becoming a more desirable place to live. And they're opening, a lot of the New York City restaurants have opened. Right. Duplicate examples there. The weather is very good most months of the year. I don't think JP Morgan is going to leave in the next 4 years. And no. Do I think many hedge funds will go? Many financial services businesses? I mean, what happened post-COVID? Post-COVID, people figured out that they could actually do a lot by Zoom. And that made it a lot easier to, used to be you had to be physically in New York so you could go to a meeting and see someone. Zoom, it's still good to see people in person, but a lot of meetings that you used to do in person, you now do by Zoom, which makes other places like Miami much more viable, Palm Beach, etc.
You've been asking for a conversation, a meeting on X with the person who may very well become the next mayor. Unsuccessfully. Do you ask that? I imagine you're asking it genuinely, but do you believe that he would correspond with you?
Well, look, the guy's attacked me personally, so I'm like, okay, let's have a real conversation. Are you afraid to have a discussion with me on X, an open mic discussion where I can ask you about your policies and I can challenge you about your policies? Why not? As opposed to having I would say open mic. Give me a couple of hours and let's understand who you really are. I'd love to do that. The fact that he's unwilling to do that, he's not responded to do that, I think speaks. He's afraid to do so.
While we have you here, got to ask you about your take on just where we are in this economy and where we are in the markets. What do you think? We keep talking about, we say there's a bubble in conversations around a bubble.
Yeah. I would say there's a lot of positive. Let me be optimistic for a moment. I'm negative on New York if Mamdani's elected, but I'm positive on the country. Clearly we have the most pro-business president we've had in a very long time. And we also have a lot of, very significant things that have been announced, but the effects have not yet really taken effect. So one, infrastructure bill from the past. We have the more recent tax bill, which gives 100% depreciation for investment. We have this massive AI, infrastructure investment that's like building the railroads of the early part of the 20th century. We have the productivity effects of AI that are only just starting to have a significant effect. We have interest rates coming down meaningfully. They're 10 years below 4%. We have a Fed that's accommodative, likely to sort of cut interest rates. So these are all, I would say, very positive for the economy and for markets.
Bill, there was a time when I think you wouldn't have called Trump the most pro-business president. And when a lot of people were worried about tariffs, a lot of people worried about tariffs, obviously, in April. Is it that those tariffs never really the worst case scenario, obviously, didn't happen, and probably at this point most people think are unlikely to happen.
No, actually, I think Trump has been the most pro-business president we've ever had.
But
that's
even when we're going to hurt the markets at one point.
I was a little bit concerned about the scale of the tariffs and how quickly they were about to be implemented.
Yeah.
My suggestion to the president was to take a 90-day pause, and to his credit, he modified that position.
Oh, he is pro-business, even though people say these tariffs are.
By the way, he doesn't care if the stock market goes down in the short term. He cares in the long term, and I trust the president, and I think he's done an excellent job.
What about
I think he's also done an excellent job, by the way. The other factors that affect markets are kind of geopolitical risk, and I think geopolitical risk is coming down. Right, the whole Middle East. The Middle East has been reset.
If he wasn't Donald Trump, I don't know what his approval would be if he wasn't Donald Trump, given.
If you actually objectively look at his accomplishments, it's been an incredible presidency.
But what about the Chinese trade talks that are coming up again? Because we are reaching the end of that kind of extended pause.
Look, you can't bet against the president and his ability to negotiate deals. I mean, you can't. And the Middle East, the Israel-Gaza situation, a peace dividend from the Middle East could be massive, right? We have these countries with incredible resources. Only thing holding back the Middle East has been Iran, terrorism, the sort of axis of evil. Well, the axis of evil has taken a major, major blow. I think that's a great, that brings down risk premium sort of globally. So again, I think there are a lot of reasons to be, optimistic about the world.
Where are you on the relation with China?
I wish we had a better relationship with China.
You do?
Absolutely. I think it's really unfortunate that two of the most important powers in the world are at loggerheads, and I just think we should make peace with China. I think that'd be very, very good. That would be an incredible white swan. Let's put it that way.
Let me ask you a slightly different question about maybe capitalism on a different front, which is this administration has been uniquely taking stakes in businesses. They're interested in switching grants potentially at universities to effectively take stakes in patents and all sorts of things. What do you think of that?
What I think is that the United States allowed other countries to control, to use a Mondami term, the means of production, right, and make the United States vulnerable. Whether it was chip manufacturing or active pharmaceutical ingredients, or rare earths, and that created a lot of vulnerability for the country. And I think what the president is doing is trying to solve that problem by, enhancing the competitive position of Intel and sort of anointing these companies. If Intel failed, and by the way, if you look at the stock price chart of Intel, it was on a very negative trajectory for the business. That's a threat to the country.
It's not a perfect way to do things, obviously. Maybe Intel should have failed.
I think that would have been a mistake.
Right, but
first of all, what the Biden administration did is it gave money to Intel.
Right.
What Trump said is, I want to get a return on my investment. So
picking winners and losers, solar, picking any, renewables or electric cars, none of that stuff.
Now, look, I think you should be cautious about the government stepping in and becoming a capitalist force. At the same time, if the government is going to provide some form of subsidy to an industry, getting something back so the taxpayer gets a return on the investment, I think is a very smart strategy.
AI, this AI boom?
It's incredible.
Incredible as
for the
long
world.
as the eye can see? Or, do you think that it's indiscriminate spending? Do you think that it's...
I think it's a bit like the railroads, a bit like fiber. The worst case scenario is we have excess capacity. But I think what we've seen is, intelligence is not something that you're ever going to have excess capacity for. So if and when we achieve AGI, right, this is a Lollapalooza effect for the world. We're going to, will enable us to. We're already starting to see impacts on, cancer discovery, so imagine a world where we can, address every disease, right? Imagine a world where we can, the power of superintelligence is worth a meaningful investment. Will some of this money, will some companies go bust? For sure. But I wouldn't have bet against, the alphabets of the world have the resources to make these investments for a profitable business.
I was going to call the Post New York paper. I won't do that, obviously. We know about the great lady. But they do say this effect, be an angel and go away, Curtis. And then they say, for the sake of the city you love so deeply, Curtis, please swallow this bitter pill and drop out.
Yeah, I mean, I think
That's a pretty good.
I respect the guy. Okay, I have nothing against him. I know he cares about the city.
He's not going to win. So what's the?
He's not. All he is doing right now is handing the city.
It's
It's an ego thing. I don't know what he's thinking. Okay. And by the way, if he were at whatever 31% and Palmer at 19, I'd be supporting him.
Slightest chance. But do you understand Perot? Or I mean, people do this. Look what's happened over the years in the national elections.
Yeah, this is.
Joel, whatever her name was.
Remember, he's not the first time he's running for office. He lost to Adams. He got 28% of the vote against Adams. So he's already failed to become mayor in a much less competitive situation.
Bill Ackman, I want to thank you for joining us this morning. Really
Vote.
appreciate it. It's great to see you.
Incredibly important election. If you're a CEO, let your workers, let your employees.
Vote early and often.
And by the way, vote early. Critically
vote
important
early and
election.
often.
Really important for New York.
You don't need an ID.
For public safety, for business here, for the country.
From New Jersey, I'm going to vote.
For the country, for the future of the country. We do not want a socialist leading the most important financial city in the country. We don't. Someone wants to seize the means of production. Okay? This is bad stuff.
Thank you, sir.
Thank you.
Great to see you.
Up next, the stories making headlines right here on Squawk Box. We're coming right back.
Welcome back, everybody. A deal that has been rumored is now official. WholeLogic is being acquired by Blackstone and TPG for $76 a share, plus a contingent value of up to $3 a share, depending on certain revenue milestones. That purchase price represents a premium of about 46% to the closing price on May 23rd. That was the last day before a deal offer was first reported. The transaction is expected to close in the first half of 2026, and that deal includes a 45-day go shop period. You can see the stock at $72.58. That's up about 1%.
Okay. Happening on Squawk Box this morning, more price target hikes for Apple. Goldman Sachs and Wells Fargo are on board this morning after Apple hit an all-time high yesterday. GM and Coca-Cola both beat earnings estimates. GM also raised guidance. Both stocks are up. GM by more than 10%. That's pretty much going to do it.
Except for where the futures are. We'll take a quick look after that big session that we saw yesterday. not much being added to those gains, but we're not giving back any gains.
We were
Yeah,
down 100 points when we started.
down triple digits,
Coca-Cola
I think,
reported, and that helped things on the Dow.
Coca-Cola, GM, obviously, make sure you join. That was a good show today.
It was. It was. A lot of great guests.
Yeah.
A lot of great news.
Yeah, make sure
Interesting
you
stuff.
Make sure you join us tomorrow. Squawk on the Street is next.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 of the New York Stock Exchange. Favors at the 13D Monitor Active Passive Investor Summit in New York. We'll get more on that in a moment. Speaking of David, he's got some breaking news on WBD. David?
Yeah, Carl, a story we've been following closely, of course, has been Paramount's interest in trying to buy all of Warner Brothers Discovery. As I've reported previously, those talks have continued for quite some time privately, in which Paramount has made an increasing number of bids. Unclear to me exactly where they ended up, but here's the news this morning. Warner Brothers is putting itself up for sale, saying that it has evaluating or will evaluate a broad range of strategic options that obviously will include selling the entire company. It doesn't mean they're abandoning the plan as well to split the company. That, of course, has been the plan that's been in place for quite some time, and one that many expected they might continue to pursue even with Paramount's interest. But that being said, citing what is interest from multiple parties, my belief, my reporting indicating all those parties other than Paramount have been interested in buying the streaming and studio business, but nonetheless citing all of those multiple parties, again, not naming those parties, but citing multiple parties, the company has said that it will initiate a review of strategic alternatives to, of course, what they always say, maximize shareholder value. And so that process will begin. Now, they already have in hand a bid from Paramount. I reported previously, perhaps a range of 22 to 24, largely made up of cash. At some point, I expect to be able to sort of get a sense exactly where Paramount ended their bidding, so to speak, privately. But now this will become a sort of a public story, if you will, as you can take a look at Warner Brothers stock moving up a bit. Remember where it came from, of course, before all of this speculation began with the Wall Street Journal story discussing Paramount's interest in mounting a bid for the company. Stock was somewhere around $12 a share. This also would involve potentially a change in the structure of the spin itself, so that any company that did want to buy streaming and the studio would be able to do so with a bid now, while Global Networks would be spun off at before the close of that deal. It gets somewhat complex, but it basically would involve making the RemainCo streaming and studio, as opposed to the current structure, which under which the RemainCo, so to speak, would be Global Networks, made up by, of course, all of the linear cable networks. In doing that, you might be able to avoid a lot. You would get some tax, what we call leakage. In other words, there would be some losses to taxes, but the belief is it would not be significant, and therefore would enable, well, you name it, Jim, I don't know, would Netflix be interested? Our parent company, at least for the next couple of months, Comcast, in that structure, would it be interested? Would the likes of an Apple or an Amazon?
Comcast would be nuts not to
or
be
any
interested.
of them.
Because at least they'd have something that goes up. You got the lowest PE multiple in the S&P 500. You're not going to go lower than that, you see, because there's 500 stocks in the S&P. If there were 600 stocks, that'd be a different story. But there's 500. So you go by that, your PE multiple goes up.
Conceivably, that's the case. Now, of course, you do run into the regulatory side of it. And Jim, this administration plays an important role in a lot of deals, particularly when it comes to media, given the president's preferences. And there has been an outstanding belief that obviously Larry Ellison and his son David Ellison, who runs Paramount, Larry Ellison, who is a lot of the money behind any said bid for Warner Brothers Discovery, is in a favorable position with the Trump administration. Not so for Brian Roberts. We know that. I can't speak to whether Netflix is in a somewhat favorable position or not, or any of the other bidders. And so you do have to wonder, in terms of a regulatory path, who would have the easiest time? Perhaps Paramount would. When you think about, some of the others, even with the spin of global networks, in other words, so it wouldn't be a part of it. So if you were Comcast and you were coming, it's not like you'd be combining, with anything that you've just spun off, by the way, in the form of
That's
person.
why I think it's
and likewise for other potential bidders.
It's not the stuff that the FCC would regulate. It's a studio. David, whether it be Jeff Dugas, or whether it be David Zaslav, these people think that the studio is worth 27, which therefore makes it sound like that linear is worth what, -3? I'm not. By the way, that is not a joke.
Yeah, no,
okay, it's not a joke. I am seeing that linear is. It's like I worked at the Tallahassee Democrat and I worked in radio. It does happen. You can have negative.
Well, listen, when it starts its life, again, and it may well be that they continue to pursue the split of the company and the so-called spin-off of studio and streaming. And to your point, there are those who said that the global networks business starts its life almost as insolvent, given its debt load and its cash flow projections. Now, to be fair, Global Networks will own 20% of studio and streaming, again, under the scenario that has been pursued, approved by the board and pursued by the company with the plan of taking place, let's call it in April. But all of that now is set aside while this company is obviously going to have its advisors talking to any and all potential interested parties in buying both Holdco, which is one name, Paramount, or pursuing studio and streaming, which conceivably will bring a lot more potential suitors. And Jim, we'll see where the value ends up. It's, it's far from clear. And again, I'm going to try and figure out exactly where Paramount ended their private pursuit. But we'll see whether they think they obviously think they can get a price higher than wherever that was, and we'll see whether they're actually successful in doing that.
Right, but isn't it natural, David, to assume that the reason this wasn't strictly a Paramount story was about a dispute over price?
Yes, you'd have to imagine, Carl, that was the case. And as I pointed out any number of times, though, it's if you polled shareholders, I think many would say, listen, if you gave us a price in the mid-20s that was largely made up of cash, we would be quite happy with that, given where this stock price came from. You can take a look at Warner Brothers and see where it came from. That said, it's not clear to me where the CEO may want a price that's in the high 20s or even higher, and not completely clear to me where the board would be, Jim, and whether there was space between the board and the CEO, Warner Brothers Discovery, in terms of their price expectations. So, that's why I'm very curious to see where Paramount actually was. The reporting from others had them as low as 20. I think they probably had moved up from there, but clearly not enough. And why not, though? Why not? Listen, you can always come back to it, right, Jim?
Right.
Take a look.
Right. Well, look.
Publicly pursue everything you can. See if you get a number that's way bigger, and you can put this new structure in place that allows somebody to buy, make the bid for the whole company with knowing that Global Networks is going to be spun, let's call it this summer, and go from there. Why not do a public auction? And that's where we are right now.
Exactly. And I think there are multiple players who are seriously interested, David. I think a number 26, 27 does actually not get it. I think this is an incredibly exciting story. Multiple buyers, because the studio is one of a kind. When you look at Apple, people don't realize it, but most of the things you watch are done by Warner Brothers. I mean, it's just hidden how great this company really is, David.
Yeah. No, it well may be the case. That said, it's not as though Global Networks is not going to have any number of its challenges, given its place in the linear cable business. And Paramount seemingly was willing to take on those challenges to a certain extent, in part because of the cost savings, of course, that would be presented to them, given the ability to combine their cable networks and those of Warner Brothers Discovery, whereas others are only interested in studio and streaming. So, we'll see. You can see Warner Brothers stock is going to be up, let's call it 7-8%. Paramount's down a bit, but hanging in there, and certainly going to be a lot to follow in the days and weeks ahead, Carl.
That's big, yeah.
Yeah.
Nice to have a big media story going on.
Right, and I do think that, Comcast has just a huge amount of cash, but it's king minus in reverse. I like them to go forward.
Yes. That's generally how it works. Speaking of which, a lot of earnings to get to today, including results from GM, one of the S&P's biggest gainers in the pre-market after this quarterly beat. CEO Mary Barra says, quote, in the U.S., we achieved our highest third-quarter market share since 17. Strong margins, restructured the China business, profitable once again. Based on our performance, we're raising our full-year guidance, underscoring our confidence in the company's trajectory. Paul Jacobson was on Squawk this morning, Jim, talking about the EV market. EV adoption will be lower than planned.
Yeah, look, I think one of the themes that we're seeing, and particularly today, is that we have a president who's very pro-business, but pro-business in a way that is dramatically different from the way we've had. When you decide that EV doesn't matter and there's no restrictions, you can go full bore, especially if you think that there's going to be a Republican administration for as far as the eye can see. Then you can just shelve that EV and go for ICE. The internal combustion engine back, trucks are back. Look, I don't want to politicize this, but when you're speaking to RTX, when you're speaking to GE, when you're speaking to any number of these munitions companies, although Northrop may not be that good, you say to yourself, it's happy days are here again, and you better own that without feeling that by saying that you're necessarily pro-Trump. But when you have, Ford, if it didn't have the aluminum, I tell you, they could print a number and get stock to 15, because all the indecision is gone. We're a country that is not as focused on climate change. We're not going to be, if you're a company that is in the business of doing something that pollutes, it's not that important.
Well, in the case of GM, Jim, this is a double beat with a raise, which they've done 9 out of the last 12 quarters. And that would take it deep into Biden years.
Yeah, it does trade down typically after it, because that's been the pattern. But I just think, it's like we're all kidding ourselves. Look, if you're talking about data centers, no, you're not going to be talking about Trump. But when you're talking about the idea that you're not going to have to be focused on California, say, you're not worried about what the CAFE standards are, you're not worried about the EPA, you approach your business very differently. You approach your business the way we used to in this country. Not necessarily the way we want it, some of us, but it's not political. It's just full bore out. And EVs cost a lot of money, they're losing a lot of money. And they all hoped that they'd make a lot of money, but it wasn't. This takes it off their hands.
Yeah, David, it's true that EVs depreciate faster. By the way, it's not like there's any huge urgency to graduate to EV with gas price average now below $3.
No, it's interesting, guys. And Jim, Toyota's the one I think that pursued the hybrid strategy to a good amount of criticism for quite some time, but seems pretty smart at this point, doesn't it?
Yeah, and Ford's huge hybrid strategy. Jim Farley looks like he backed into something really great because he spent a lot of time talking about the EV Mustang, the Mustang E. But, David, we're in a period that we haven't since kind of a renaissance of companies not having to spend a lot of money on the environment. And it turns out that a lot of companies really did have to spend a lot of money on the environment. And it's a time when we make missiles, and it's time when we beat plowshares into swords, my friend.
You're right about that. Lockheed raises the low end of the sales guide for the full year, better F-35. Free cash flow, $3.3 billion.
Oh, Takelet, good for him. The guy has been trying to get that team to turn around. It is going to turn around. But the things that's most impressive, the one that's most impressed this morning is still GE Aerospace. Larry Culp is putting up numbers for commerce that are for the real revenue is service for them. Okay. But the commercial's really good. The military is incredibly strong. And then RTX.
Yeah.
We got to talk about it. Look, I thought that Greg Hayes did a great job. He picked this guy, Chris Callio. We're talking about Collins Aerospace, which is a lot commercial. Doing the growth here is organic, double-digit organic. David, we are seeing blowout numbers. And one of the things that I think we haven't mentioned, which is wrong, there's a total collapse of silver today. Total collapse of gold, total collapse of nuclear, total collapse of quantum, total collapse of all that stuff that doesn't have any earnings, that has just been in Sherwood Forest. Thank you, Robin Hood. That stuff is just being it's like a redheaded stepchild today. It's getting beaten around the head. And the stuff that's moving up it's kind of Nixonian.
Gold, spot gold down 5. You see futures there. But that comes after one of the best days in years yesterday.
Yeah, but they all traded together. That's what we found out, that gold was the leader in this thing. Yeah, Dave, what? Dave?
Jim, can you say total collapse maybe for when we actually have a total collapse? Can you just rephrase?
Do you think that silver down 5%?
How about down 3.5%? All right.
No,
I'm not saying it's not meaningful. You're right. It is meaningful, but total collapse just sounds a little much. I'm sorry.
It's somewhat of a collapse here.
So I imagine this is the kind of market you like. Some of the froth getting brought out of momentum into the industrial economy.
Yeah, I want the Oklos of the world down. Okay, there's a small new scale power. I mean, come on, enough. Nuclear power plants are not going to be built in this country unless they're built by the U.S. government. It's just you can't get them permitted. And take a look at what Southern did. I mean, Southern had some kind of overrun. We all act as if because a couple of hyperscalers went nuclear, they're going to get nuclear. No. By the way, devastating piece about Sam Altman today in the Wall Street Journal. Saying that, look, we've got too much money, too big to fail. They used the too big to fail term.
Right.
That's too big.
Well, Goldman has a chart out today, David. AI spending boom, not too big when compared to the railroads of the 1880s, telecom of the 1990s. That's not the right chart. But just as a percentage of GDP, nowhere near what those eras were about.
Yeah, we didn't have a lot of GDP back during the railroad days. Listen, I think the numbers are staggering. I think they're understated. We talk about it all the time in terms of the CapEx numbers. That's not even worth adding up for Microsoft or Meta or Alphabet, because they're the ultimate creditor on so many data centers that they're leasing that they don't own. It's OpEx, not to mention private credit, which is financing all of this. Oracle is basically the credit wrapper for OpenAI.
Some of it, David. Not all of it.
Some of it. Some of it.
Well, I like the editing. You guys are editing each other in real time.
We're good.
It's the most exciting market.
And by the way,
and you're
to
passive.
the benefit of our viewers, because Jim is absolutely right. Some of it. But the numbers are enormous, and I do think we got to spend more time exploring the circularity of it and just how much debt is going to ultimately start to be piled up here in terms of in the data center, buying the chips and everything else related to the increase in compute that's going to be needed to take AI forward.
And no logic, nothing. Yeah, nothing.
Yeah.
Big.
No, I got
logic.
You got it?
All right. We did something.
Hey, you said it. You said it. Hold on. Hey, thanks. Hold on. I'm talking now. Yeah, I'm here at the 13D Monitor Active Passive Investor Summit. I'm going to have an exclusive. We're going to talk to Starboard Value's Jeff Smith. That'll be this hour. His firm, by the way, just taking a big stake in the construction company Fluor. We'll talk to him about why he's done that and
I'm gonna
a
let
number
it
of other
shine.
names that he's been involved with as well. We got a lot more Squawk on the Street for you straight ahead.
Okay.
Apple shares stabilizing in pre-market a day after hitting that new record high. Company's valuation now moves closer to $4 trillion, sparked by these reports of strong demand for the iPhone 17. Jim, today it's Wells going to 290, Goldman constructed 2.
Now, look, these two firms had buys on it, so it's not like they sat it out like some of the people who are going to have to eat a lot of crow. I love the Goldman mention of this.
Eat a lot of crow.
It's going to be better. That's the second time because the retail services revenue was slowing down. The ecosystem is stressed in the Wells. In the Wells.
Bind is moving.
I love when I see sustainable double-digit growth to services. What that says is give me a higher multiple. Now, everyone was worried about this is something the bears have been harping on, which is that the multiple's gotten too high. Well, no, not if the earnings explode. Now, do I expect the stock to be up big after the stock was up 9 yesterday? But there's a lot of stocks that are so exciting today that they could steal the thunder of Apple. But I do think that the idea that Apple's an expensive stock will be revealed as a canard when we get this quarter. When I was with Tim Cook and
You went to Kentucky, the Corning plant.
You know, we were sitting there saying, okay, like, he was saying to me, Jim, walk me through why our stock is. I said, no, I don't understand it at all. I mean, I think that these phones are incredible. You're making the greatest stuff. And we were joking that, like, wait a second, everyone thinks that Siri's the problem. Siri will be fixed. Gotta always have to be careful. Siri will be fixed. And, you know, and that'll be another reason to own it. But the main story that no one talks about is the value of your used turned out to be bigger than you thought. Right. And when you go...
People are going to eat crow, Jim Cramer says. I have a feeling he might be eating crow one of these days. If he's pumping something, you know what usually happens. It's not good. Oh boy. Take off my shoes. I'm Washboardjim with a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. Woo! Oh, man. Today I'm having hot chocolate. Sugar-free. I haven't kept sugar in my house for years. I do have some in here, but I used it on one thing and I forgot what it was. Excuse me. Look at something. I have to go take a slug of water. People are getting rich on Bind. Okay, I got that. You can Vimo this, you can Vimo 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 that. Don't call me mister. Call me by my name. Oracle getting ready to break the hall of shame. Well, they were really pumping Oracle, remember that? I want to ask everybody in here, please don't get as bad as my sweet Nancy. She has to have a shot of vodka every morning when she wakes up. Let's go to Walmart, fill up the shopping cart. Amazing Grace. Well, we have less than 3 minutes left. 3 minutes. Well, I almost made a big mistake this morning. Woke up thinking it was Monday. Oh, I can't do that. And I went to my first job, and so shit, today's Tuesday. I had to run back home and get my key and zip over to the other job. So I was working at double pace this morning. Meta's breaking out. Watch AMD this morning. We got an inverse head and shoulders, maybe a double bottom. NVIDIA's at the 200 SMA on the 1 minute time premise. IWM, I don't know about it. Definitely no support there holding it up. We have less than a minute. I hope everybody's ready for a glorious day. My platforms are all ready. Let's look at the SPX, see where I think it's going to open up at. Well, I'm going to say we're going to open up right down here at 6/7/2434. $24.50. Means that's an even number. That's a pretty big dip. Give Randy kudos for yesterday for being bullish when I was bearish. Slash ES just broke the VWAP. Here we go. Well, we're flat. We opened flat. $67.42.48. Bind has dropped here. People taking profit on the bounce. We're coming to the 200. We respected it this morning a couple times. The 200 SMA, not the EMA. We're at the EMA right now. Biden's got to deal with Walmart. So they'll be selling fake meat at Walmart. There's our king, President Donald Trump. It's big news for Bind. Tweedly, tweedly, tweet. All this living life for me. Just call me Elvis. Elvis the pelvis. Federal Reserve Governor Waller says the Fed staff study payment accounts to firms that currently rely on the third-party banks, whatever the heck that means. Oil stocks haven't been seen this cheap in years. That's because we don't have a Democrat in office. Burn, baby, burn. Today's the 21st. I paid the IRS again. I just started paying them online. It's a lot easier, I guess. As long as I don't screw it up. We're at a double top resistance on the SPY. Randy. Could be, if you want to get anal about it, could be a triple top. 671.82 to break. Man, I haven't had a hot chocolate in a while. Tastes good. Okay, the 672s. I'm watching real close right here. Yesterday I took 6 trades. And the 7th one would have been a game changer big time. I applied a lot of patience. You know what side of the street I'm on. Biden bounced up off the 200 just like Jimmy called. Before we got there, look at that. See it? You have to see it to believe it. Oh, drinking that hot chocolate made me exhausted. I gotta see what Tedolini's wearing today. Now tell me what kind of day I'm gonna have. This Marley's on here. That's not gonna be a good sign. Dang, Oracle dipped again. TSM knife. Oh, NVIDIA knife. Right to support NVIDIA. There's Oracle knifed again. Tesla not holding up. Let's see what Tesla did here. Well, a little more volatility today than yesterday. Applied is down 134, Oracle down 381, Google down 313. You know, they keep bringing up bubble. General Motors at 64. Now that's a bunch of bull crap. They said the PE ratio on this thing was cheap. I find that hard to believe, but they say it. Okay. SPY 672s are at 108. We just had a breakout on Tesla. Tesla just broke out. I gotta turn on my air conditioner. I have a Washboardjim. What? What about Amazon 230 weekly? It's Christmas coming. It's one of my Christmas plays. Definitely a Black Friday play. And how they rip you off on that Prime. 71 degrees in here and I'm hotter than hell. The hot chocolate did me in. NVIDIA, more new low. I gotta watch NVIDIA here close. Spy at a double bottom. Oh. Okay. Opportunity has came in amongst us. Are we going to get another crow? That's the question I want to ask. 672s. There it is, third crow. Now we got to watch this next candle. Get ready, Randy. We got two hammers here. Now. 88 cents, 85. Okay, get ready. $0.86. Picked them up at 90. I wanted cheaper. Amazing grace, how sweet the sound. There's my 84 right there, damn it. Huh. .82. .86 average. So far, it's not looking too good. China reinsures foreign firms to export controls of huge meeting Bloomberg. Not a good start. NVIDIA. We've got a double bottom on AMD. SPX is at the bottom of the orb, retesting it. The 6750s. $67.50s. Go, baby. I'm up $100 a contract on the, and I'm getting back closer to my even point here on the SPY. I say we have to break the 21 to get back up to the 200 or the 63 or the 50. Oh. Come on. We got a megaphone on the SPY. And we got a shoulder line, inverse head and shoulders we need to break. So I'm going to be looking, instead of the VWAP, I'm going to look at that shoulder line. And that'll give me a positive momentum. Straight across. Doesn't have to be straight across. But for right now. Six, 7, 6, 8. Up, there we go. There we go. Come on. Get that body above it. NVIDIA's moving up. Not saying it's a buy, but we got a hammer at the bottom. And we're inside the Kettner channels. Ugh. Slash ES could hit the VWAP. No, I should take profit. We're at the shoulder line. Got a symmetrical flag. There's a hammer on the video. Retesting the orb. IWM puts see if IWM holds 145.16. AMD new low. Markets woke up bearish this morning. SPX about to hit the support channel. You did hit it. The major support right here. I gotta go check my phone. $310. Go, baby. Now I'm talking. Bind has a double bottom. Interday. Damn. Baba's pulled back. Well, shit. This ain't looking good for Jimbo. Bassett confirms economic stabilization deal with Argentina. SPY pulled back to my first support, 670.06. Slash ES is on a 5-minute orb support. $6,763. $67.50s. Let's go. We got a triple top right here. We could get up here to the 200. Three white soldiers coming out with a hammer and another hammer. Now we got a head and shoulders. Got a couple of them. Kind of choppy. Had a triple top right there. One of my laptops went out on me last night. I'm gonna have to go out and buy a new laptop because both of them are bad shape. I don't know how long I've had this one, probably 12 years. Yeah, it's fucked up. It's been a mess, but definitely got to get a new one. I'll need one for travel. Hopefully I can get one I can hook another monitor on. Anybody got any ideas on what kind of laptop to get that's good but reasonable? I don't know nothing about computers. So it has to be user friendly. Let's break. This is the 4th attempt. Don't know. It seems like I've been kind of bearish this morning. Either get out even. See if we can stay above the orb. NVIDIA's at 180. AMD new low. Unbelievable. How strong they were pumping them things. WM hit my support and bounced up. $245.60 and held above it. I mean, we're at the 21 right now on the 5-minute. Ugh. Come on. Finally. Come on, Spy, you got to do the same. Spy has a tweezer bottom on the 5 minute and still holding up above the orb on the 5 minute, but the tweezers are below it. We hit the 63 and almost hit the 200 on SPX. We broke the triple top, quad top, and we're above the 9 with a crossover over the 21. Do I get out and save my guts, or do I hold? That's the question. And retake it on a dip. These are desk lights above the desks. They asked me to get them some. I'm going to check Home Depot out after hours today around 3. See if I can just get a couple single ones a piece. Or do you want to get cases? These are upstairs lights, so there's not that many desks. The guys with the guns. $3.90. Yay! I'm going to take profit. Out at the 200 EMA. Come on. Give it to me. 390. Boom. It's another win on the chin. Yeah, oh yeah. Had to stick that one out. this damn thing's acting funny too. We're at 81 on the SPY. 82. What do you got to say about that, Randy? We're at the 200 SMA right here. Fuck. $5.10. Oh. Damn it. SPY at 94. I'm out of them. I got quite a few of these. I was worried. God darn, man. Can I do anything right? Jesus Christ. Out at 94. I sold. I ain't playing games. Oh. See how my day's been? I want to go to bed and roll up in the ball. That's funny. Woo! Shit. You dare me to buy back? We're at the 200. I almost want to wait for the VWAP on the SPY. Let me look at the SES/ES. Yeah, I'm gonna wait. I wait. I'm not taking huge chances. Good morning, 50 foots. These lights go under the desk up there, stairs next to CSI, the guys with the guns. Going to go to Home Depot or order them online for a couple lights, unless you want to buy cases. 32-inch and 48-inch. I think those are only desks that have them kind of lights. I'm going to see if I can just pick up a couple single bulbs a piece. There we go. I'm glad I didn't take your dare. Ain't all right, Randy? Say yes, Jim. You're the best trader I know. Say it. I'll be walking into the kitchen and preparing my soup for today. There, I guess, make another hamburger. And have soup tonight. Sing grace, how sweet sound. $670.60 on the SPY. Get ready, prepare ye. I'm gonna show you how I see this, but I don't know if I'm right. This is going to be a tough day today, so you got to be extra patient. We just hit it. We just hit it. We just hit it. Red alert, red alert, red alert, red alert. Code blue. Are we going into the next day? Do you understand? The 22nd, the 673s, or the 672s? 672s at $1.30 some cents. We got 38. We could do a double bottom, but this is an inverse head and shoulders. If you know what side of the street I'm on, say yes. Very choppy day today. I want to make that perfectly clear. S- 672s at 138 tomorrow. And the SPX might even be a better trade. This is the month of October, cannabis harvest season. If you grow outside. Jim, have you ever grown cannabis outside? Yes, I have. It's not an easy day. Tight stop. Bad news Bob in here? God darn it. It's a toughie. I'm going to go shut off my air conditioner. Let's go. Let's go. We're at the VWAP. $156. 200 SMA coming up. Oh. Randy, did you take the trade with Bobo? Jim, my grandma wants to know if she can come over and have a bowl of soup with you today. She said how delicious it was. And if you weren't in the mood, she'd even take a cider. What do you mean by that? You know what I mean. When you're magnificent hangers. And don't think dirty with my grandma, whatever you do. She's not that kind of woman. Bad News Bob. That's how you do it. Lights in the desk. Ceiling lights work great since you put them in. Do you want me to pick up a couple of bulbs at Home Depot if they got them? Years I've cleaned it for, let me see, the 14 years. I cleaned the place. I've never had to replace them. We're at 171 now. back to the VWAP. I'm gonna go make lunch. And I did this without even checking out Nicole's breast today. I'd say that's pretty good. And I want to say nice things about Marley today. I promise you. I will not let Marley ruin my day.
Stocks, meantime, hitting a record high for a sixth straight session. The rally building momentum on hopes of a trade deal with the US soon. The Kospi has outperformed Asian markets this year, up around 60% or so year to date. Meanwhile, over in the UK, government borrowing hitting the highest level for a month since 2020, while borrowing over the first half of the year was the second highest since records began after the pandemic. This underscores the headwinds facing Chancellor Rachel Reeves ahead of next month's budget. We're speaking about this with Richard Flynn yesterday. Over the summer, long-term borrowing costs in the UK reached their highest level since '98, but have since backed off. Here, where things stand in Europe in the final hour of trading over there, we've got the FTSE just on the line to the upside at the moment. We're looking pretty quiet out in the German DAX as well, just to the downside right now. And the French CAC is sitting up 0.4%. So a little bit quiet out there in Europe. Coming up, it is time now for Inside Out, and we will take a closer look at Netflix ahead of earnings and bring you an example trade when Morning Trade Live comes back here.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters, Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Netflix will be in the spotlight this afternoon when the company reports earnings after the close. Analysts are expecting adjusted EPS of $6.89 a pop on revenue of more than $11.5 billion. So Netflix shares
Livid goose.
60% over the last
Bingo.
12 months. So let's go inside out on that name ahead of earnings. Joining us now, very pleased to say, sitting beside me is Melissa Otto, head of Visible Alpha Research, S&P Global Market Intelligence. Thank you so much for your time. Good morning.
Hey Sam, it's great to be here.
And it's always nice to have you. What are you expecting?
Based on Visible Alpha consensus, we haven't seen too much movement in the numbers coming into this
fine,
quarter.
SPX.
So I feel like that is an indication of fairly stable sentiment. So coming in around $11.5 billion in revenues. I think where we're seeing some controversy is around the ad revenues.
Right.
There's a pretty significant spread there in the ad revenue expectations. Based on consensus, we're seeing anywhere from 500 million to 2.5 billion in expectations. So that's kind of rounding out, giving us a median consensus of around $1 billion, but I mean, it could go either way. And then what's really interesting is that next year, consensus is expecting $6.5 billion. So I think kind of between now and this time next year, the market is really expecting that business to ratchet up.
Okay, $11.5 billion though, I suppose, in revenue. I mean, what's going to be
Oh, here they go with Raw again.
because obviously we've seen this foray into sort of the live business as well. We want to see some of
Pumping
the
Netflix.
numbers coming from that female boxing match that we saw over the summer as well, K-pop demon hunters, etc. too. So like, what is it? What's it going to be composed of, do you think? Where's the strength going to come from?
I mean, the backdrop is very interesting at the moment. There's a lot of movement around media companies.
Yes.
There's some interesting M&A on the horizon. And I think that, that some of the content's up for grabs. So it'll be interesting to see who grabs it. Is it going to be Netflix? Is it one of their competitors?
Yeah.
And, where does this all shake out for them? I mean, the company's been an astonishing stock over the past 3 years. It's been essentially a six-bagger. I mean, is it going to continue to do that for the next 3 years? Investors may be saying, where can I get, maybe a little bit better risk-adjusted return? I don't know. But, that's, I think, some of the questions that I'm hearing out there. I think based on Visible Alpha consensus, $1,400 price target, it's about 15-20% upside from here, so that's kind of where we're at with it.
Yeah, and I suppose you were referring obviously to some of the news we're hearing out this morning. I believe it's CNBC sources who are talking about Netflix and Comcast potentially being sort of interested partners in this whole Warner Brothers Discovery sort of spin-off that we're talking about. So let's see how things go, but I don't suspect, I mean, it could be brought up on the analyst call, who knows, but, as far as moving into the future, you mentioned, where others could be, looking for value. I mean, it feels like a lot of the commentary around Netflix is that they sort of clearly won the streaming wars. So, I mean, what happens next?
I mean, YouTube TV is out there. I mean, they've also got decent market share.
Right.
But I think this advertising piece is a really important component to how their business model is shifting.
Mm-hmm.
The advertising is potentially going to add a significant amount of profitability for the company over the long term. So that
Well, I'll be back.
$6 billion consensus ad revenue number that I explained for next year, I mean, as we think about that over the next, say, 2 to 5 years, what's going to be the impact to margins and earnings growth? And, I think it could be substantial provided that they execute.
Right, it's all about that execution. Okay, we'll be watching out certainly for that commentary as well as how they do in the quarter. Thank you, as always, Melissa Otto, for joining me here on the trading floor here at the New York Stock Exchange. Melissa Otto, head of Visible Alpha Research, S&P Global Market Intelligence. Okay, let's trade it now with Tom White, host of Fast Market. Your first example trade for Netflix, looking neutral to bullish. Tom, what's the approach?
Yeah, a little bit more conservative, maybe a little bit more passive, but you can still take that directional bias because implied volatility levels are really elevated going into this report. Option market pricing in over a 6% move either way. So looked at this a little bit more passive where I give myself a better probability of success. Using that October 24th weekly option series that expires in just 3 days. So this is really short-term positioning, earnings type of trade, where I'm going to sell the out of the money 1170 strike put. And then against it, because you want to stay risk defined, anything can happen in these stocks. Buy the 1150 strike put. So a short $20 wide, neutral to bullish put vertical. You're going to collect roughly about a $5 credit. That credit you collect is what you can profit on this trade. So $500 per spread, but you've got $1,500 in risk. But that's all the way below 1150 on this. Now the break even, if you collect that $5 credit, goes down to 1165 to the downside. That's about 6% below where the stock is currently trading. So you've given yourself that big cushion of success on this one. And you've got a probability that that short 1170 strike is going to be out of the money at expiration, which is what you want, of about 72%. So the probability is in your favor on this one, risking 1,500 to make 500, but you've got that big cushion to the downside.
Okay, and second example trade for us on this name, looking more bullish. What are you seeing there?
Yeah, if you think this stock's going to get a pop, I mean, the option market price in that plus or minus $80 move in the shares. We see this stock move post-earnings. So if you think it's going to go higher, let's take advantage of the vol dispersion between option series. So I looked at a call diagonal here where I can buy something in the October 31st weekly options that expire in 10 days. I'm going to buy basically the at the money 1240 strike call, and then against it in the near term options in the October 24th weekly options, I'll sell the 1300 strike call.
Boom.
Bullish $60 wide call diagonal, where you're going to pay roughly about a $29 debit. So there's your risk, $2,900 per spread that can expand to 60, right? You can see here from the risk profile, you want it to go towards 1300, but anything above the break-even level of about 1250 is going to be profitability on this one. Now, why is this cost less than half the width of this bullish $60 wide call diagonal? Because you're buying about a 60% implied volatility, selling about a 97%. So that vol dispersion really lowers the entry point price, but you do need to move to the upside on this one to get above that 1250 break even.
Okay, good look at Netflix there. And I do see that UBS, Wells Fargo, Bernstein and KeyBank analysts all rate the stock as a buy or overweight, very much citing some of that content strength and solid engagement. So let's see how things go for this name later. Thank you so much for that, as always, Tom White and your example trades. Thank you for joining us here on Morning Trade Live as well. I'm Sam Vardas. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. We've got Trading 360 with Marley and Hayden coming up next, and I'll join you again at 3 p.m. Eastern for Market on Close. Have a good rest of your trading day. I'll see you a little later on.
Gnarly. Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Good morning. We're 90 minutes into the trading day, and welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up in today's show for you. In our 360 Spotlight, we'll look ahead to Netflix earnings and talk about what key metrics you should be watching in their report when they report after the close today. Today's disruptor is Texas Instruments ahead of its earnings after the bell today. We'll see if one of the laggards in the chip space is poised for a breakout after its report. Then in our 360 round, we're going to dive into the earnings from General Motors, which has rallied to a more than 3-year high and is on pace for its largest percent gain it's seen since March of 2020. Lots to get to, but before we do that, let's take a look at how the markets are performing so far today. On the S&P 500, trading up about 0.2% at 67.48.55. The Nasdaq just below the unchanged line at 25,137. On the Dow, trading up 0.7 higher right now at 47,030.95, and the Russell 2000 at 24,97.88. As we take a look at some of our futures products, how the 10-year is faring so far today, down below 4 at 396, down more than 0.6% this morning. The dollar slightly higher, up 1/3% at 98.71. As for gold, we're seeing it trading down almost 5%, 41.4620, well off of those 4,300 plus levels we've seen the last couple days. Crude oil also trading down 56.76 a barrel. That's down about 0.5% right now. And Bitcoin slightly higher, 112,555, up 1 1/3%. Now, I do want to kick off our show with Alex Coffey, like we usually do, co-host of Next Gen Investing, and talk about another earnings report we got today, Coca-Cola.
Yeah, nice little rally in Coca-Cola brewing under the surface here post-earnings. Nice numbers from Coca-Cola. Not the most volatile of numbers or performance when it comes to the beverage maker, but comp sales, nice from a comparable EPS standpoint, though. 82 cents was above the 78-cent estimated. From a revenue standpoint, it was largely in line, $12.5 billion versus the $12.48 billion that I saw, which is still okay. Again, a company that's largely pretty consistent in its performance. Some under-the-surface numbers, though. Adjusted organic revenue growth of 6% was better than the under 5% that was expected. The price mix segment, which is important, up 6%. Best the sub 5% expected there as well. In terms of unit case volume, up 1%, largely in line. 0.75% was what was expected. They still see their CapEx at $2.2 billion. Margins were better than expected and have improved year over year to 31.9%. Most importantly, though, they kept their guidance where it was for revenue growth, 5 to 6%. Basically where the street was as well. So there wasn't a ton of disappointing things, but it wasn't a perfect report, and I'm sure we can talk about some of those things too.
Yeah, not a perfect report, but trading 3% higher, still showing some resiliency in the consumer, which I think is really what the street was looking for. Are we going to see continued spending? They did. The street is okay with it. Alex, thank you for breaking down Coca-Cola for us this morning. That's Alex Coffey, our senior equities contributor here on Schwab Network. And I do want to bring in our next guest, Jim Urio, joining us this morning, Managing Director of TJM Institutional Services. Jim, great to have you with us as always. I'd love to just start with your thoughts on market performance so far this week.
So I think it's interesting. I think one of the clues we got last week was when we heard from Jerome Powell, and he hinted about ending quantitative tightening. And that was a little ahead of what I think the market was expecting. So for me, that's kind of the cousin of quantitative easing, and we're getting less quantitative tightening than we thought. So me, it leads toward a dovish Fed. Now, as part of that, is he morphing into more dovish because of the lack of any government data that he's seen, which means he has to err on the side of caution? Perhaps that's part of it. But I still think the Fed liquidity is one of the biggest drivers of markets, and then couple that with the broadening AI trade. Remember, for the last couple of years, it's been NVIDIA and Microsoft that people have been rushing to get exposure to the sector. And I know there's other players than that. I'm just being a little oversimplistic. But now within the last week, it's been Micron and AMD that have been carrying the torch for the NASDAQ. And I think the fact that the NASDAQ is staying at these elevated levels, even though it's broadening out within the space, I think is interesting and somewhat. I need to see it take out its all-time highs from a couple months ago before I get too excited about it, but I think it's interesting.
Jim, I think a lot of the conversation surrounding the Fed has been on the rate cuts, and then we get to balance sheet runoff, and people just start tuning out. Like, they're just not into that part of the conversation. Can you sort of walk me through what your expectations are for the markets when we start to see some of this, especially in the wake of Powell's comments last week?
Sure. By the way, this is a source of huge frustration for me. This is not boring stuff, and everybody gets put to sleep when we talk about it. So talk about with quantitative easing is real quick. It's just when the Fed creates money and they buy bonds from the Treasury, essentially jamming more money into the system to float around and lower rates, increase expansion, etc. The opposite is when the Fed lets its balance sheet run off, which is a quantitative tightening, taking money out of the system. Right now, they've stopped quantitative tightening. As far as the eases go, you have to ask yourself what he's watching, because literally on Friday we have a CPI report coming out that's expected 3.1% increase year over year, and we're still pricing in 2 more tightenings to the end of the year. So we have to think that Jerome Powell is looking at something, and it's obviously the labor market. He said so himself, and we know that the data we're getting for the labor market is either incomplete or messed up. I'm trying to think of a nicer word, or messed up. It's not reliable data. So he's kind of flying blind. It's a really interesting time.
It certainly is, and you mentioned tech before as well. Tech seemingly carrying the market, really driving this rally along. But how sustainable is this leadership that we're seeing in tech?
Well, I think the fact that it's broadened out and it's still continuing, to me, means I'm not ready to call it. But I'd also like to point out that the metals markets were getting so strong that you could say that they were involved in the risk-on rally as well. But both of them were probably reflecting, at least to a degree, liquidity and the dovishness that we're pricing in. So I think the tech rally is still relatively heavy. I'll say again, you can go all the fundamentals you want, but we will be able to tell technically at these all-time highs. If we can go above it, close a couple days above those all-time highs, then I'll be a lot more emboldened than I am now, because right now that acts as overhead resistance. And everyone who watches who is not a technical trader thinks that might be some sort of voodoo, but it's not. It really measures market sentiment, appetite, and positioning all in one.
And so in this tech AI story, it still feels very exciting. There's rarely a guest we have on the show that doesn't mention tech or the AI trade, but is it also starting to feel a bit stretched?
Oh, I don't think there's any question about that. I believe we are in some level of a bubble, but that knowledge and that opinion is worth essentially nothing, because that bubble can increase for years before it pops. We said, I think it's the Friedman quote, the markets can stay irrational longer than you can stay liquid, and that absolutely accounts for bubble creation. But I think they're completely stretched. I think the enthusiasm for AI is a little bit over its skis, but that doesn't mean there's still not more juice in the orange, which is a very difficult time to trade. But to your point, I think it's absolutely stretched.
All right, so let's talk about some of the earnings that we've gotten, particularly around the regional banks and a little bit of this scare that we got in terms of, credit loan concerns here. We saw that spark and we saw the reaction from smaller banks. Do you think that was just a quick knee jerk, or is this indicative of a bigger problem and a potentially larger market catalyst?
So everybody's looking for this bigger, huge systemic problem. And as it turns out, what we saw last week was mostly about fraud up until this point. Which, by the way, and I wrote in my note, I don't know if you read it, is that when you see something like this happen, and even if it's fraud related and not something that's built into the system, you see what the appetite is for risk and what market positioning is. Because it can be something that, and I thought that those headlines were serious, but not serious enough to bring the market down, and they didn't bring the market down. But you always have to watch things like that, because you can see it turn around quickly if the market's positioned such. But also remember too, when SVB started to go out of business or whatever the heck happened a couple of years ago, the Fed was very, very quick to open the window to them and increase their balance sheet to keep them liquid. Now, Janet Yellen came out and said, we'll save the big banks that are systemic, but we won't save the smaller banks. But I don't believe her. I think don't believe them. I know she's not Treasury Secretary anymore, but I don't believe them. I think they will. They've shown in the past the knee-jerk for the Fed is to extend a helping hand if there's a problem. So I think the market's either seeing that or seeing the fact that it doesn't feel like it's really a systemic bad loan sort of issue.
And Jim, of course I read your note before our conversation. And in that note, you said that you think it's time for investors to be tactical and not greedy. How does one go about doing that?
So again, this is we have a saying in the markets is that bears can make money, bulls can make money, but pigs get slaughtered. When you've been on a trade and making money hand over fist, and you're not covering some of that, and I'm talking about the NVIDIA trade, the NASDAQ trade, the gold trade, and you're not covering some of that and putting in hedges, you're exposing yourself to a great amount of tears if the market turns. And it always does. When gold goes up parabolic, it has a tendency to come down parabolic, is what we've seen today. So I like options protected strategies or just periodic rebalancing with a rules-based sort of rebalancing. So again, greed is what gets you killed. You can't be shooting for the retirement home that's right on the beach. You gotta be a little more strategic, in my opinion.
All right, so strategy, diversification, hedging. But bottom line, though, are we in a healthy pullback here, or is this going to be indicative of something more serious?
So everyone who's my age, when the market starts to pull back, thinks of 2001 and thinks of 2008. I know you're a lot younger than that. Every time we have a pullback, it doesn't mean that everyone's completely levered out of their skis and we're going to go down 40%. I think the next pullback we have is going to be extremely healthy. I think we're stretched, like I said. I think we're in the early stages of bubble creation in AI, but that can be fixed relatively quickly. I think there'll be a 30% haircut.
You've been saying that
in
for a
the
year.
AI names within the next 15 months. And again, I don't even think that's a bad thing. I think that's just a reflection of the enthusiasm for these names. You can go up parabolic, you can come down parabolic, and at that point in time, I think it'd be a great buy. Because I think the AI story is very, very real, by the way. And they are making money, except for
Well, that's any storybook.
They are making money.
I was saying buy Tesla at 110. Nobody believed me.
Just the tech bubble where you just slap that.
Hello, Marley. You're such a sweet lady.
3 stocks and 3 charts. Rick Ducat will walk us through the technicals, and Jessica Inskip will take us through the trades for PG&E, Bank of New York Mellon, and Alphabet. That's next on Trading 360 on Schwab Network.
Marley. New high. Do 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 do. Do 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 do. Oh yeah. Cancel, cancel. Marley, you're such a fine woman, yeah. Do 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 do. It's really pretty clean this morning. Do 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 do.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As
Just the trades that matter.
Real time, Opening Bell, live at the NYSE, right when it counts.
I love you.
When it comes to investing, you'll love
Believe me.
Carl's Way. Take a left here, please.
But there's a
Carl's Way is the best way.
It is the best way.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No.
I'll get out here.
Where are you going?
Come on.
Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big 3. We've got 3 stocks.
Marley.
Rick Ducat will take us through the charts today, and here to take us through the trades is Jessica Inskip, the Director of Investor Research at stockbrokers.com. Great to have you both with us, Jessica. Lovely to have you as always. Would love to start the same as we usually do, with just a big picture thought on market performance this week.
Absolutely. I think the markets are actually looking rather constructive. We have some good earnings thus far, and even though the lack of economic data...
And they said earnings weren't going to be that good.
In this environment...
What the fuck is going on here today?
...cuts into an accelerating economy, and we don't want anything that would disrupt that narrative. Certainly something that we saw last week that could be of concern, but it looks like markets are shaking that off. The big thing that I'm watching right now, aside from earnings, is just where we are in the S&P 500 equal weight to make sure that we maintain key support levels, which is the previous high. So that is still being maintained. That's a good sign for me. If something breaks down there, then of course I'll be cause of concern. But as of right now, markets are looking rather healthy. It's still broad from an earnings perspective and that technical view utilizing the S&P 500 equal weight.
All right, so with that, walk us through your first pick today, PG&E.
Yeah, absolutely. So this came from my technical scan. I've got multiple scans I run weekly. This one is looking for a crossover of the 13-weekly moving average and the 26-weekly moving average. The reason why I use that, 13 weeks represents 1 quarter, 26 is 2. So I'm looking for prices increasing quarter over quarter. So this is where this stemmed from. They are digging deeper, transforming from a post-bankruptcy recovery that happened around 2020 into more high-quality growth utility that's fueled by California's clean energy mandates and a favorable rate structure. That's extremely important. So their post-bankruptcy transformation, that was from around July 2020, that restructured their operations, settled some liabilities, maintained some shareholder control, and then from there, they've got this investment outlook where they're aggressively utilizing energy and environmental mandates, and that's around $13 billion annually, which is going to support 9% in annual earnings growth. So I like this from the technical view. I like the regulatory advantage that's there because of the constructive California regulation and renewable infrastructure tailwinds, in addition to the technical setup that I see with the bullish crossover.
All right, so we've got that technical setup with the bullish crossover, which Rick will look at in a second. Since that bankruptcy, up about 60%. So, certainly a move to the upside. But walk us through some of these technicals that Jessica's mentioning.
Sure, starting with a shorter term 1 year picture, we can see that this is one of those charts that kind of has two phases. If you were to backtrack a little bit here, you can see we had this significant gap down. That gave us some boundaries to watch. You can see our darker red line is about where things topped out again near that $18 level. So 18 to about 1877 is a potential upside zone to watch. In the shorter term though, we formed a inverse head and shoulders type pattern here. You can see we had our shoulder, head, shoulder, and this was the neckline area here, our green line near about 1430. This, unlike its normal counterpart, this is more of a bullish type of pattern here. So we did get a breakout above that neckline area. Now we have transitioned into more of a rising wedge type shape here with a rather widely spaced trend lines here, both pointing upward, but the top one is more modestly sloping. We are close to potentially breaking out here around that level near 1725 or so. If we were to look at some of our other studies here, we can see that we have crossed above our moving averages here in pretty quick succession. 21, 63, and 252-day exponential moving averages here on our daily chart. We can also see RSI presents us with kind of a conundrum here because on one hand, we are out of that overbought area. We have trended lower here. We are showing a little bit of divergence here in terms of our prices here. Prices on pace for a higher close. RSI is trending downward. However, we're also breaking through our trend line, making a new relative high. So in the shorter term, it actually seems like it's more bullish, and we're still following our green trend line here to the upside. Finally, when we look at our volume profile study, we've crossed
Marley,
heavy volume.
you're such a
here.
sweet lady.
This one comes in around this 17 level, so look for this to be a potential.
Are you dating anybody special?
Potential breakout area on the road up to 18. A quick glance at our
Let me know
chart to show Jessica's visual scan here. That's our moving averages 13 and 26 crossing over each other, signifying more of a long-term bullish shift.
If
All right,
not,
yeah, this is sort of back at the end of their bankruptcy.
I'd like to ask you out on a dinner date.
2020s, you can see some of that upward
A little bit of
movement
smooch
there.
smooch.
Thanks for walking us through those technicals. And Jessica, let's move on to your next trade. Bank of New York Mellon, sort of on the heels of their earnings, some positive notes about consolidation and potential upside involving AI. Why did you pick this one?
Yeah, the AI narrative is certainly a piece of it.
Spy respecting yesterday's orb. She's a fox too.
Market dynamics shifting around, which is tokenization and digital assets, and I do believe that
I could trade with that chick any day.
a beneficiary of that. Now, this did pop up from yet another scan. This is more on a fundamental basis that's looking for growth in value. So really, Bank of New York Mellon's combination of higher returns, structural growth, and efficiency gains makes it this outperformer for large cap finance, but I look for high profitability, so ROTCE. We sometimes look at return on equity, but if we're looking more in the financials, ROTCE stands for return on tangible common equity, which is a key profitability metric for banks. So it measures how directly and efficiently a bank generates profit from tangible common equity, excluding intangible assets. So that's at 25.9% year to date. That signals strong returns with low credit risk. There's growth ahead with leveraging tailwinds in treasuries, wealth management, and digital assets as we see that transformation. And I love the valuation. It's trading at under 15 forward earnings. It's expecting in the longer term about 10% earnings per share growth. So from a valuation perspective, the metrics that I pull and that key theme of tokenization and the transformation that I see within the markets, I really like Bank of New York Mellon.
All right, so Bank of New York Mellon, as I'm looking at the charts, pretty flat on the month, but up more than 40% on the year. Rick, what are the technicals showing us for Bank of New York Mellon?
Yeah, so a nice move to the upside in the longer term, but range bound, as you say here. And the boundaries that stick out to me on this chart here, this rough area here, this darker green line, like 103, is around where things formed a notable intraday high. They struggled to overtake that level. Then after the breakout, that was roughly where we hit support multiple times here, around 103. If you're looking for exact stop on a dime price activity, you're going to be disappointed a lot of the time. We're trying to just kind of describe general areas of interest and general trends here. Similarly here, 99.50, this was around where we hit lows a few times here. You could extend down to 98 if you really wanted to go to the absolute intraday lows here. But again, just kind of general areas to watch out for. So that would be our supportive zone. To the upside, you can see that we have broken through our blue trend line here that was trending upward for a while. We topped out near 110.87. We hit resistance around 110 a second time here, giving us this shorter term downward sloping trend line now. So that would be one shorter term area to keep an eye on there. Our moving averages that we follow, we have crossed above our yellow 21 day. We found some support at our orange 63 day that roughly coincided with that 103 level. RSI also continuing to trend downward. We are out of that overbought area.
Now that was good.
Day spent above that threshold of 70. Now bouncing around and struggling to stay above the 50 midline here. That would signify a shift to bearish momentum if we were to cross lower. Our red downward trend line is still in play. When we do incorporate our other studies here, the volume node this time is around 106 to 108. That's around where we're trying to work our way through now. +1 standard deviation channel comes in near 116. To the downside, we have our support zone with our confluence there. And notice as well, the volume node is here near 101. So this seems like the area to hold for the bulls to the downside.
Yeah, and trading right now sort of in that upper volume area right around 108.03 right now for Bank of New York Mellon. Jessica, your last pick here coming off of a big day yesterday, a new all-time high for Alphabet. Why is this one on your list?
I still believe in the AI theme. I was pulling and doing my research and understanding the big macro picture. So if we're thinking top down, and we're now in the midst of earnings season, going back to last earnings season for the Magnificent Seven, we expected around 13% growth for the Mag 7. That came in at about 26%. So there's still more upward momentum, even that's being priced in. If we just compare to last quarter, the past is not indicative of future results naturally, but I do think from the AI narrative, Alphabet is a huge piece of that. And we need to remember when they're reporting earnings, which is on October 29th, that's also with Meta, which means there's going to be some comparisons on that day. But I think they're really positioned for another solid quarter. We are looking for strong search execution, expanding AI-driven efficiency, more cloud growth as well to reinforce that dual engine that it has of profitability and innovation. But more importantly is elevated expectations that are there for any ad growth. If there is a miss on that, that could weigh on sentiment, but that could be a buying opportunity. We saw an uptick even in the App Store for Gemini. So it's really, for me, the focus is core AI, which is Gemini, and how that leads to them being an advertising leader, poised for multiple expansion if that momentum continues. And I do believe that they will be. We saw that with Gemini, but that's what I want to pay attention to. There are some risks, of course, but also that comparison with Meta on the same day. So October 29th is going to be a spooky day.
Yeah, it certainly will be. And you bring up such a good point that the timing of your earnings matters so much, because if you're going up against a fellow behemoth, you are going to be met with the comparisons, and that is going to impact the market action. So a very good point there. But as we look at Alphabet on its own, Rick, what are the technicals standing alone telling us?
Once again, more of a range-bound, shorter-term period here. We can see that the highs came in around this area, 256, 257 or so, double top type of pattern, giving us almost an M-type shape here. But now we have also a low point here, 236 or so is where we hit some lows, sort of around the highs first as well, too. We also have this upward sloping trend line here. You could have said it was more of a rising wedge type shape initially. That has been significantly kind of blown away at this point. We never even really came close to retesting our gap lows here near about 225 or so. So a longer term, if things really fall apart, that could be one area to watch here. But now trading close to our white trend line here that you could have drawn off this series of low points. So moving averages that we can see, we are right on the nose with our yellow 21-day EMA here. So that coincides roughly with that trend line, a break below 246, 244, around that general region there. That would be where we would start to think that the trend perhaps would be interrupted here, and a retest of the support could be the next step. RSI, we have seen it trend downward, a brief dip below the 50 midline here, but we've broken through that downward trend line now. So RSI perhaps maybe looked a little bit better than the price activity until today. Now we are sinking back toward that 50 midline here as a price was rejected at those old highs. So volume profile, we can see our biggest node near current price right about here where we are now. We're on the lower end of that range, centered around 250. Our +1 standard deviation channel just below lines up with our trend line as well, near that 240, 245 general region here. That's kind of the supportive theme. Very little volume as well until you get all the way down here near 195 to 190 here. So that's the next downside heavy importance area.
Yeah, and right now trading right near that key support level you mentioned, 245, 246, trading 246.34 right now, about $10 off of that all-time high we saw yesterday in advance of their earnings on October 29th. Jessica, thank you for being with us today with your picks for Big Three. Jessica Inskip from stockbrokers.com, and Rick Ducat, of course, our lead market technician here on Schwab Network. Thank you for always being with us.
Do such a great job, Marley.
Going to spotlight Netflix ahead of its earnings after the close today. Trading 360. We'll be right back.
You're so cute in your little pantsuit. I mean, skirt suit. Uh-oh. Handshake. A tricky handshake there. I don't trust that. Bad news, Bob. We love you. If you're out there listening. Okay, now it's time for my coffee after my dinner. That was very good. I paid my IRS payment online last night and has already taken it out of my bank. I like it. There'd be times where I'd sit like a week or two, maybe 3 weeks before they'd finally do it when I sent them checks. And a little bit of uncertainty that goes in that. Did they get it? And you always have to keep looking at your checking account every single day, see if it went through. Then you'd have to call them up and say, did it get there on time? Because it didn't show up until a week after it was due. And I sent it 3 weeks ago. I write a lot of money to them people. If I quit trading, my taxes will go a lot lower. Importance of live sports. No, not really.
Scott, HBO Max's numbers, they posted 20% growth in terms of their users globally compared to Netflix's 1%. You know, how does that tell us where Netflix is stacking up in the streaming race?
Right, well, there's two things with that. The one thing is that on an absolute basis, Netflix is by far the largest, with about 45% of monthly active users for the cohort of streaming apps. So while their growth might have been only 1%, it's off of a very large base. Max, on the other hand, is off of a smaller base, but also has been expanding into international markets where Netflix is already established, right? So that's making that growth number appear faster than Netflix. But Netflix is still by far the largest streaming platform on an absolute basis, and compared to all its peers, has the highest level of engagement and what we call retained users that continue to be on the platform month after month after month. It's about 72%
month after month after month after
60%
month.
for sort of the average cohort of streamers. So what they have an advantage is they have their local language content, and they have this huge breadth of audience that is significantly larger than any other competitor.
And so, as we bring in the competitors, there's sort of a new category of competitors to talk about, these free ad-supported services like Tubi and Roku starting to see a big uptick
Jesus.
here. Do you think that they're going to become any sort of threat to the paid streaming services, or will they remain in separate silos?
I mean, I think it depends if they're able to continue to improve the content that they have, right? As they get more live sports, or they get better content or more tentpole content, which we call it, like a show like a Stranger Things, for example, which has a huge audience and an audience waiting for it, it could become a threat. I think the bigger issue is that the non-fast streamers have to continue to develop their content pipeline, because if you look at the macro environment, and as these services eventually go abroad, where there might be a less affluent customer, price becomes an issue, right? So people might be willing to watch an ad to get this free content. right? And so that is what I would watch for. I don't think it's an immediate threat to them. It's just something to look to going forward, right? Particularly if there was a macroeconomic event that sort of tightened everybody's wallets and you can't pay $18 a month for no ads or even $8 a month for, you know, a regular streaming service with ads, then you might be willing to sort of trade down to a fast service.
And so with this ad spend, obviously ad revenue, an important metric for Netflix or any of the streaming services when they're reporting, you know, that's a big battleground here. Hulu dominates from the research that I looked at. You know, how much, what's driving ad dollars the most, do you think, for Netflix and for some of the competitors? And also, as they're all competing for the same viewership here, do you think that we are sort of on the cusp of any sort of consolidation in streaming?
Great.
So, basically what drives...
Great question, Marley. Your questions are so to the point. I can't tell you how much I love to listen to your voice every single day.
Has become an increasingly attractive advertising platform for a lot of sort of top-tier advertisers, like some of the beer companies, InBev, and others like that.
I'm on a roll.
Recently partnered with Amazon to allow, you know, more programmatic ad buying and placement. So those types of initiatives and brands joining make Netflix increasingly attractive. But I can't say that there necessarily be consolidation in the streaming space because advertising is so competitive. Because they're actually competing not only with each other, but also linear TV for ad dollars and also socials and other digital channels, which are also trying to grow via advertising revenue. So I don't necessarily think there'll be a consolidation because of advertising. I think there could be, if there was going to be consolidation, it would be to reach a different demographic.
Well,
you know, to expand if you don't want to have, you want to lessen the production costs of input.
They didn't do it too good.
A better program that you would like to acquire, but I don't think it will be because of advertising.
I think I'll extend this line out here.
Part of Netflix sort of move now to expand is in this gaming sector, and they're seeing a big
Marley, keep up the great
game
questions.
downloads up sharply. Squid Game
Smooch,
Unleashed, I think,
smooch.
was the top one that's being played when I was looking. Do you think this is a meaningful growth area for Netflix, or is this just brand extension of users they already have?
Yes, darling.
I think it's an opportunity for them to expand their brand.
We're at the
Gamers
200 right
are
now.
The same people that are watching all of their streaming content. So this is a way to take the most popular streaming content and really monetize it, either through branded merchandise, through games, right? So you continue the experience for the user. Let's, for example, we can talk about Squid Game, right? And they can time the launch and promotions and in-app in-game events to the TV show, right? When a new season comes out and they see a huge lift. So it's a way to continue bringing your user into your ecosystem and continue to engage with them. So while it is a small part of their revenue right now, it's a way for them to grow and to continue to be engaged with their consumer outside of the
Spy at the 200.
right? So again, and it allows them to further monetize the IP they have and also
I'm not in it yet.
licensed content, right? Like Grand Theft Auto. So there's a lot of opportunity there, but really what it is being in touch and having more touch points with their end consumer, and I think that's what that really provides them at the moment.
Well, Seema, we'll have those earnings right at market close today, but we appreciate you being with us to preview Netflix. That's Seema Shah from Sensor Tower. And coming up next, we've got the Disruptors. Kevin Green will join us to take a look at Texas Instruments ahead of its earnings after the close. Trading 360, we'll be right back.
You do such a great job, Marley. I had a lot of thought yesterday, and I listened to what the good Lord told me to do, and he said, words can hurt people. And sometimes it's best to keep your mouth shut. So I've decided to have a new leaf about you, Marley. You're so insightful and gorgeous. And every time I hear your voice, I don't have to worry about the mice in the house or the roaches because they all run. Bounce off the VWAP. Yeah, I think I would have took that trade if I'd have paid more attention. Respected the 200 and then the wick hit the VWAP. Oh, you took it for me. Very good. I'm going to have to go out and buy a new laptop. I'm not sure what to get. Anybody want to buy me a laptop? I'll give you my address. I'm going to go make my coffee. Nicole's on, and she's got cleavage.
That has been a little back and forth. So
Beautiful
that's
woman.
The latest on GE Aerospace. Back to you.
She's
Nicole,
real
thanks for
sexy
breaking
today.
that down for us. Like you mentioned, about $10 off of those highs that we saw, but still trading
God.
well into positive
Hello,
territory,
Marley.
up 1% in the third. That's Nicole Petalides. And now it's time for the disruptors. Kevin Green, our senior market
Speaking of
correspondent,
disruptors.
is here with today's company, Texas Instruments, ahead of its earnings that we
Woo!
talked after the close. You know, KG, as far as what to expect from Texas Instruments, they're sort of the laggard in the chip space. You know, what are we looking for in their report?
Well, they are the
You got a hammer here.
And the reason for that, they have actually a
Doji
lot more
hammer.
exposure when it comes to analog chips.
Long leg
that has
doji.
been a market over the last
Bullish.
3 to 4 years. It has been lagging for the most part and still kind of in recessionary territory. We did see a buildup in inventory for a lot of their customers throughout COVID-19, and they're still trying to work through that inventory, and that has actually kind of pushed demand.
That's a
back
bullish
little bit.
candle
Every
there.
time that they do report, before we get to the numbers, they always talk about in the next 6 months we are expecting demand to go higher. So they've been pushing that can down the road there for a couple of quarters here. Let's see if that's going to be the same case. The revenue estimates right now sitting at $4.65 billion here. That's around 11.9% increase on a year-over-year basis. The market is also looking at adjusted earnings per share at $1.47. Once again, another 11% increase on a year-over-year basis. And obviously, once again, we kind of talk about the semiconductor space as a whole, but they're focusing on the analog business. Now, some analysts are actually expecting automotive to actually gain a lot of attention in this earnings announcement because some of these automotive companies are actually seeing pretty heightened demand, and that should also then create a little bit of a draw on the existing inventories, which obviously Texas Instruments is going to have to backfill. But the big issue with has been also kind of clouding this company here is their expansion. Their CapEx spend and their plans over the last 2 years have been very aggressive, and they haven't been able to see the demand really kind of fill that need. And so they have been pulling back. Do we see another guidance to the downside when it comes to CapEx spend, trying to work with the capacity that they have right now in order to fill orders? I think that's the biggest question. They also have a little bit of exposure to...
You got to turn on the clip function
really going to really shape the narrative
on your stream. What's the clip function?
So this has been a stock that's been lagging, looking at around a 5% move to the upside or downside. That's what's being priced into the options market. Let's see how they do after the close.
And Kevin, how much of the conversation do you think is going to be about their exposure to China? I was reading a note from Mizuho. They lowered to underperform from neutral, reduced the price target to $150, which is about $30 below where they're trading right now, because about 19% of their sales come from China. So how much of the conversation will be about that exposure?
I'm sure they're going to discuss that several different times here. The exposure that they have for China is on consumer devices, and so if we are actually seeing a refresh cycle, like Apple is kind of signifying here, if that's also happening in other consumer electronics, Texas Instruments could actually be a beneficiary of that. They're not so much impacted when it comes to the tariff policy. Obviously, that's going to impact a lot of these semiconductor names, but once again, you're kind of looking at those consumer devices, the industrial machinery that is out there.
I don't know what it is.
Which is what they actually do service. Analog segment is around 78% of their total sales, so that'll be interesting. But I'm not sure if that's going to be the crux of the the determining factor if the stock's going to pop 5%, 6% to the upside, or if it's going to drop 10% to the downside because of China. I think it's really going to be based on automotive as well as the industrial application
function
that really drives the revenue for this company.
And KG, if we wanted to trade this one, knowing it's the laggard, down about 4% on the year.
Allow the voice to be recorded on clips.
Space is up about 30% on the year. How might we structure an example?
By turning on this setting, your voice will be included when someone in the same voice channel uses clips.
This stock could actually move to the upside pretty aggressively.
It was on.
Here. So this example trade is actually looking at the January 2026 monthly expiration, the 190 calls. Just buying this one outright for a debit of $7.50. So the max loss on this trade is going to be $750. Max profit unlimited because the stock can go up. Break-even point at $197.50. You're also looking at a little bit of a breaking up technical structure to the upside, which is another reason why this trade is structured in the way that it is. That 195-ish area is an area of resistance, considerable resistance. If it's able to break above that, that's where this trade actually becomes pretty profitable here. So once again, about a 5% move implied to the upside or downside, kind of holding a key area of support. Let's see how they do. They might be able to shock the street with a very low bar going into this report.
KG, we appreciate you being with us for Disruptors today to talk about Texas Instruments ahead of their earnings and also for structuring that example trade for us. That was Kevin Green. And it's time now for our 360 round. For that, let's bring in our panel to discuss General Motors earnings. Shares considerably higher today. Joining us to discuss, Ivan Feinset, the Senior Partner and Chief Investment Officer and Director of Research at Tigris Financial Partners, and Carl Brower, the Executive Analyst at iccars.com. Carl, we'll start with you. Takeaways from this report and the reaction to it.
Yeah, well, I think things are looking good for GM because we've seen some cooperation from
the administration on the tariff situation. We just heard about them extending the reduction in potential tariffs on parts, which could have really hit a lot of the manufacturers, the domestic manufacturers who have assembly outside the U.S., Canada, and Mexico. So I think that was a positive move for them. And also just, of course, the removal of the requirements to hit the aggressive EPA numbers and the CO2 numbers. They're still in place, but apparently there's no fine if you don't meet them. So it just looks like the door's open for General Motors to continue to cash in on their high-profit V8 and large truck and SUV vehicles.
And Ivan, same question to you, takeaways and thoughts on us being up more than 15% on the heels of this report.
Well, it's not only a great quarter for GM, it's a great quarter, highlights again the strength of the U.S.
I don't trust GM's numbers.
Consumers are buying the full-size pickups and SUVs. They're willing to make a significant financial commitment, which shows consumer confidence. It shows consumers willing to pay up for the industry-leading GM trucks. And so this is not only great for GM, as I said, it's great for the economy, and I think this will continue GM's positive momentum. We have a buy on the stock and $86 price target.
86.
And I think that this will, confirm our position, and I think that there's more upside in the stock.
And Carl, you mentioned that tariff impact. They were able to raise their full year guidance thanks to that smaller than expected impact. Do you see that as a structural improvement versus a one-off relief?
I do. I see a lot of structural improvements for GM. Again, the requirement not to produce as many EVs, which never are going to have as good a profit per unit as the internal combustion vehicles, the shift in tariff that we've already talked about. There seems to be plenty of people, despite the average price of a new car passing $50,000 recently, there still seems to be plenty of people who can afford these higher end vehicles. And we've watched a lot of the automakers reduce a lot of their lower cost, smaller vehicles for sale in the U.S. I think there's a new assumption that those buyers are just used car buyers now, and the new car companies, they're focusing on the higher income, higher profit vehicles, and buyers are buying them. And that's why you're seeing these kind of numbers on this latest report.
And Ivan, how sustainable do you think that this pricing power is in the face of some potential economic headwinds?
Well, I think that even with economic concerns, consumers are willing to make the commitment to these high-priced vehicles. And this not only is driving the sale of these cars that consumers want, full-size pickups and SUVs, but GM also benefits from ongoing subscription services. I mean, consumers, they want cars with the GM Super Cruise, they want advanced infotainment systems, they want advanced safety systems, and these are the current lineup is probably the best lineup of vehicles in GM's history, especially in trucks, SUVs, and crossovers.
And Carl, talking about the lineup, we saw that one-time charge with EVs in their numbers, also mentioning they're going to scale back some of that, change their production priorities, try to make them more affordable. Do you see that as more of a pivot that will be reflected in the entire industry on the whole? Are EVs still a long-term bet?
I think EVs are a long-term bet, but the near-term crunch that all the car companies were under has been removed, and that's why they're all feeling better and looking better on a financial basis. So we will see EVs continue to evolve, and I would like to see them get less expensive and have longer ranges. Some technological breakthroughs in battery design would be fabulous to cut costs and increase charging speeds. But that can all continue in the background while the car companies focus on vehicles that will sell today at a higher profit.
I'm debating if I got to get me a new keyboard and mouse.
Ivan, we heard GM say they're investing billions in U.S. manufacturing.
I use this computer a lot.
I think it was 2 million vehicles annually here in the U.S. How do investors view this trade-off between the CapEx and then the near-term profitability?
Well, I think that they are investing for the future. I mean, President Trump's tariff initiatives are very consistent that he wants what's sold here made here, especially with vehicles, and the fact
that's right.
And the fact that GM is investing in U.S. production will give them a competitive advantage versus imported cars.
And Carl, we got this impressive report. The market clearly likes it. As far as your read on vehicle demand heading into next year, what's just sort of your general outlook, and then also specifically for GM?
I think it's going to be tough. I think what happens when this is going on when we're hitting kind of one of these cycles where there is some consumer leverage. You see kind of medium and lower priced cars often have it worse because those are the buyers who are the most impacted by these economic cycles, whereas more affluent buyers tend to not have much impact, and they're the ones buying these larger full-size trucks and SUVs where the profit's made. And I feel like GM and a lot of the car companies have controlled production over the last few years. They've seen what happened with COVID, and they kind of learned that fewer vehicles at a higher profit per vehicle isn't a bad way to go. And so, as much as I feel like demand
how'd you do that
in the near term, I feel like production has been kept limited and profit per unit remains high.
And Carl, I'm sorry, Ivan, last question to you, off of what Carl just said there, that there could be a potential default or
what the
Yeah. Beautiful woman. She's real sexy today.
like you mentioned, about $10 off of those highs that we saw, but still
Oh my
trading.
God. Hello, Marley. Nicole's on, and she's got cleavage. Beautiful woman. She's real sexy today.
Like you mentioned, about $10 off of those highs that we saw, but still
Oh my
trading.
God. Hello, Marley.
look at my face.
Speaking of disruptors, Nicole's on, and she's got cleavage. Beautiful woman. She's real sexy today.
Like you mentioned, about $10 off of those highs that we saw, but still
Oh my
trading.
God. Hello, Marley.
And now it's time for the disruptors. Kevin Rayner, senior
Speaking of disruptors, Nicole's on.
Speaking of disruptors, woo! Oh, that's too much.
Nicole's on, and she's got cleavage. Beautiful woman. She's real sexy today. Oh my God. There's Marley. Speaking of disruptors. Nicole's on, and she's got.
Oh, that did make me laugh. I don't know how funny I am. I'm funny. Oh boy. Oh. Oh, that's too much. I am a funny guy. Vegas should say that's unprofessional. Woo! Oh my. I can't take it. AMD bounced, NVIDIA bounced. Jimmy liked that pullback on NVIDIA and AMD today. Woo! You're one funny guy.
And then you look at the volume, case volumes, those rose 1%. Now remember, that's coming from minus. That was a negative number in the year-ago quarter. So that's an improvement there. They're divesting a 75% stake into their Africa business to one of their biggest bottlers there. That's probably a positive. There's a lot of impact from currency headwinds and tailwinds. But I think one of the key things was high-income consumers are still willing to pay more for premium drinks like Fairlife, Smart Water. Those were some of the bright spots.
Smart Water.
Moving forward. So even though maybe we're seeing slow
good idea
sales maybe on some of the legacy parts of their business, consumers are still paying up for the premium brands that they have under their umbrella at this point. And if you take a look at their organic revenue,
I don't drink the stuff.
6%, they expect that to continue to grow 5 to 6%. So pretty good report here out of the beverage maker. And if you get some tailwinds, maybe from currency headwinds. Maybe they divest some other businesses overseas into the major bottlers. That would also be a positive for this company. But seeing a nice jump here today.
No, that's a good point that you made, Tom, about kind of the demographics, because that came up on the earnings call. That overall the consumer is doing fine, but there is some weakness. So maybe those who are willing to pay up kind of make up for where the weakness is, especially because one of the things I know they called out in their earnings was the price mix, right? And it wasn't so much basically. The price is not, people aren't balking at the prices right now. Ken, what's your take on this for Coca-Cola?
I think it's interesting. This is a zero sugar or Diet Coke boom that's going on right now. There's a big anti-sugar take, and the good news is, their CEO said, we've stayed flexible. And so they're offering zero sugar drinks and, of course, Diet Coke. So, having products that the consumer wants, remember, unlike Pepsi, they don't have any food. They're all liquids in one way or another. So they've got to get liquids right. It appears like they are. Yeah, anything sugar-free or diet, that's what seems to be driving their earnings right now. So, yeah, pretty good. It's amazing how these companies adapt to the consumer. And when the consumer sends them a message, like their CEO said, they stayed flexible and adapted to that. Pretty solid numbers on the Coke.
And then of course the guidance, the street seems to like the guidance and the CEO saying, quote, they're confident they can deliver on the 2025 guidance, also working on the longer term objectives. So the view is that things will hold up for Coca-Cola, but it is interesting to see this pivot away from the traditional, because the traditional name, say, the brand only grew 1%. All right, guys, let's pivot and talk housing. Pulte's out with its earnings. Actually, the stock's turning around right now. Had been under some pressure earlier in the session, right? Showing that just there are still challenges. They did meet expectations on both the top and bottom line. $2.96 for per share for adjusted earnings. That was a beat, but earlier the street was like, no, we don't like this because it's still a decline in profit on a year-over-year basis. Tom, what's your take when you look across Pulte and what it says about the state of the housing sector?
Well, I think we've talked about this. The housing sector has basically been in a recession for the last couple of years. You need a 30-year mortgage rate above 6.5% up to 7%, even a little bit above that over the last year. It's finally starting to come down as the 10-year yield has started to pull back. We've got that back below 4%. So that's a benefit. They beat on EPS. Their backlog is solid at this point, but then you start looking at some of the key metrics that were worse than expected. Now, the stock you mentioned is rallying back. We're $9 off of session lows. This thing got down to $115. Now about 124. Gross margins contracted 26.2 from 28.8 in the same quarter from a year ago. That's down 260 bips. Then you look at incentives, were up 8.9%. That's up 190 bips. So they're using incentives. They're using the fewer closings that they're having. They're impacted a little bit better by the fact that they saw a 3% increase in the average selling price, but at the same time, until we see those, and I've been stating this, until we see 30-year mortgage rates below 6%, these home builders are going to struggle at this point. It's a question about affordability at this point. Those monthly payments.
Starbucks has hit their resistance levels.
People are getting into those homes. It's the third largest of the home builders, so they may continue to struggle in the near term. I think the positive
They're saying 94
is that the economy is still doing well. The unemployment rate is still 4.3%, but interest rates are coming down. And if we get that cut next week from the Fed, and then we get another cut in December, maybe that's going to benefit.
Said it'd probably be a good buy back then.
The housing market in general, if you look at it, maybe not a direct pullback in this space or a recession. It's definitely down near that because of the inactivity that we've seen from some of the home builders and the incentives that they have to use to drive sales.
I'm so glad you mentioned incentives because that's a big part of what's happened here. Because for Pulse, profits down 16%, revenues down 4% on a year-over-year basis. So it's still, kind of stuck in the mud, stuck in a rut when you think about housing and just how sluggish it's been for the past, honestly, just a couple years now. And to your point about what's driving it, they're having to continue to offer all of these incentives, and they talk about that. Ken, what's your take on this for Pulte and just housing in general? I know you're often across what mortgage rates will continue to do and how that dictates rates.
Yeah, I think the reason that this stock opened lower and is now recovering is the continuation of the hope that housing will recover. Remember, we're 8 days from interest rates going down more, but their earnings, this stock is up despite revenue down 2% year over year, financial services income 55 million to 44 million, closings down 5%, new orders down, wholesale revenue down. I mean, this is a company that had all smaller numbers, but the stock is rallying. Why? Well, it's been higher. And the perception is that housing has a chance to rally. Remember, if rates continue to come down and the housing sector opens up, this stock isn't going to be trading anywhere near here when that happens. So people are buying the dip as they have since $88 in April. And so I think this is just a continuation of people expecting the fourth quarter and next year to be better in terms of interest rates. We need interest rates 6% or lower in terms of mortgages to get that next tranche of people into the market, Diane. And I think that's what you're seeing. Remember, stocks are forward-looking, and I think this stock is looking to better times coming up in the future.
Yeah, and that's certainly the hope because there are so many people who have been priced out of the housing market. Think about millennials, especially elder millennials, who just haven't been able to have like the traditional American dream and trying to wait for it or feeling like they've been potentially priced out of that. So we'll see if it does turn a corner like the stock is turning a corner right now, or when it does turn a corner. I want to remain optimistic there. Let's talk WD, Warner Brothers, Discovery. That stock is rallying today, so it's not just about earnings today. We have all these individual stock stories that are happening. After saying it's open to a sale, not surprised to hear this one. Tom, what's your take on it?
Yeah, the company's already rejected multiple inquiries from Paramount Skydance at this point. Those were rejected. I believe the CEO of Warner Brothers last week came out and said if he wants to get serious with the bid, he can put it out there, but basically pushing back.
Disney bounced back up. Just hit my resistance.
Strategic alternatives, and then you're hearing Netflix and Comcast might be interested in buying this entity at this point. That's why you're seeing it at 3.5-year highs.
This just reinforced my opinion that anytime you think there's drama in the market, don't even expect another rebound, because I called this out the other day at 109.41 and it hit 108.72, hit above 108.27. Looks like it hit 108.50, 108.61, 62 right in there. I'm tempted to shut this down and reboot it. $108.65, double bottom. Now we're at resistance again, so that's a $5 bounce in 3 days. Called out Oracle yesterday, and then it dipped a little bit more again today. Now it's about $3, up $3 from when I alerted it. Oracle. I think this is a good buy too. They were really hyped up about Oracle when it had that huge run, that huge breakout off earnings. They were really hyping it up. I said, no, don't be buying it here. Not at that all-time high. It jumped like, it was incredible how much it jumped. Let's get to a different time frame, different chart. It went from 224 all the way to 345, $120 bounce, just like after hours. I mean, to me, that was way too much. And I told Vegas yesterday, I said, we either hold this 276.21 or we hit 270.23. And that keeps it in that channel of support right there, that Darvis box, that pullback support. Inside of that, and we almost hit that bottom support for a 68% pullback, or 62. A 62% pullback from the top. And that's pretty reasonable. So it could go a little bit lower, hit this previous high, but I mean, it stays in that channel of support at double bottom, triple bottom at 276.21. Go away, little girl.
Even though they're more analog, their AI side of their business grew 50%. Now, it's a small portion of their sales, but at the same time, that's the growth engineered. But as Kevin mentioned, the bar's pretty low on this one, down 3%, 3.5% so far this year. You know, smartphones, they're in those. They're the building block of a lot of stuff out there. Internet of Things, automotive, industrial, smartphones. So, yeah, if you're seeing positive numbers not only on the auto side, but everywhere in tech, then it's pretty surprising that Texas Instruments lagging not only the overall market, but its sector in general.
All right, so let's get right to these example trades. Why don't we start with yours?
Good. Yeah, I put on something a little more bullish in nature here. Something in the calendar spread family, just a 1 week diagonal. The expected move for Texas Instruments right around $9.70. Let's round that up to $10. And I just did. I bought the October 31st 180 call diagonal time, and then I sold this week's October 24th 190 call. Just a $10 call diagonal, 1 week wide, play the earnings play. I put it in for about 445. It's rallied to about almost 470 now, so it's rallied a bit off those lows, but I just think this is a chance when the news starts to come out, you get a little trigger. I think that Tom's right. I think the bar is low here. The stock is sold off. It just got downgraded today. So I'm going to be a little bit bullish here on this name just because it's already sold off. A lot of the bad news probably already in. Bar is pretty low down, so a $10 call diagonal.
Yeah, I'll go ahead and take here, Kev. Yeah, this is the bullish example here. And Kevin taking advantage of the vol dispersions here because this is a $10 wide call diagonal that you're paying less than half the width of it. And that's because of those different vol levels in the different option series that this calendar or diagonal spread is in. But let's break it down. October 31st, weekly options expire in 10 days. Buy the at-the-money 180 call. And then, as Kevin mentioned, that one standard deviation move the option market pricing in about that $10 level. Sell the 190 call in the October 24th weekly options that expire in just 3 days. You're going to pay roughly, we got 445 debit, that's where it was trading earlier, trading closer to 465, 470. But the debt you pay is going to be your risk. So if you do pay 445, $445 in risk. And anything above about 182 is going to be potential profitability on this. You can see here from the risk profile, the apex profitability at or near that 190 strike. you'll have one opportunity to roll that short option over the next 3 days also into the next series. That might collect credits, that might increase potential profitability, but this is definitely a bullish trade. And I mentioned those vol dispersions that we always talk about in diagonals like this. Out in the October 31st weekly options where you're buying the 180 call, that's about a 56% implied volatility on aggregate in that series. And then you're selling about an 82% implied volatility on aggregate in that October 24th weekly options where you sold the 190 strike call. So bullish call diagonal that is taking advantage maybe of the low bar on this one with the bullish sentiment. But Kevin, I got something a little bit different. It's bullish and bearish, but it takes care of the bear discussion here on this particular segment here. So went out to the October 24th weekly options here, Kev. And I'm just looking at buying an iron condor. And this is a need to move type of strategy here. Where let's break this one down. October 24th, we're going to buy the 187.5 strike call and sell the 192.5 strike call. So you're buying a call vertical that's out of the money, and then you're buying the October 24th weekly 172.5 strike put, selling the 167.5 strike put. So you're buying an out of the money put vertical, combining that with buying an out of the money call vertical. You're going to pay roughly about a 220 debit for this package. The debit you pay is going to be your risk. And you can see it from the risk profile. This is what I mean by need to move types of strategy, right? You need the stock to go below 170.30 to the downside or above 189.70 to the down or to the upside here on this one. So while Kevin's trade would be a winner on the upside, so would this. But also, if the stock falls post-earnings, this is also a winner. You can make potentially 280 bucks on this, but you need it to move. And Kevin, if you look at this, if you look at some of their past earnings events over the past couple of years, this stock does tend to move. Doesn't mean it's going to this time, but this is playing for an outsized move in a low bar environment.
Yeah, you're buying a call vertical on the upside, buying a put vertical on the downside, and you make money on a big move, and Tom, you don't care which direction, you're hoping it gets some type of move, and with this trade loses money, all you can lose is the debit paid, in this case, 220, 225, something in that range, but you want movement. And this loses money if the stock stays right here. But remember, you have this on all the way till Friday's expiration. So
where's that ticker TXN?
The max you can lose is whatever debit you pay for the spread. You're looking for a move towards those short strikes. You want 220, 225, go to $5.
And those moves on those break-evens are about that one standard deviation. So as Kevin mentioned, you need more than a one standard deviation move to start to see some profitability on this. And you want the price of this iron condor to expand so you can sell it at a higher level. Diane, so there you go. Bullish from Kevin, bullish and bearish.
Yes, exactly. All right, we got things covered there. Good stuff, guys. We got cash tags coming up. Taking a look at Netflix ahead of its results. Got earnings due later today. So stay right here on Schwab Network. Fast Market will be back after this break.
Well, they're really pumping Netflix today. Oh, earnings, that's why. Man, it was in my box too. Of support. One of these days I'll be able to trade this with confidence. I just think it's way overbought, but I'm biased. Well, we got a new high on SPX, up to 200. Inverse head and shoulders. I give myself an A+. That's how you do it. It's weird how the first of the morning always gives a little bit of uncertainty to me. But this is actually a real good setup down here. Snake, breakout, double top, pull back, higher low off of yesterday's Darvis box. So, I mean, a beautiful little setup. Didn't feel like it this morning. But I am quite impressed in how I handled it. Nicole, are you back on? You look like a God-turned fox this morning.
The supported tier is very important. You want to see acceleration in that, not any form of deceleration in any of the metrics, frankly. And now my question is, when are sports coming, right? That's the next frontier for Netflix. They've already dipped their toe in, but you got to think that's on the horizon. And then finally, Landon, address the cancel Netflix. Did it make any difference? Did it make a dent in any type of Netflix momentum, or is it something we should be just ignore completely?
Yeah, good question. So that was a pretty big move that we saw. I like to compare it to the two other biggest negative sentiment moves that we've ever seen were a Snapchat rollout and the Bud Light marketing campaign. And the Bud Light was the worst that we've ever seen. The canceled Netflix, which was children's shows upsetting conservatives, basically. That was a very large spike. Elon Musk led that campaign, I guess, and it lasted maybe 2 to 3 weeks. And so it did not have the staying power that the Bud Light marketing problem had. And so I think that it probably had a minor effect. But I don't think that they're going to come out today and, well, they're definitely not going to say we lost a lot of subscribers, they're going to report those numbers, but I don't think that it had a huge impact. And as long as it kind of stays in the rearview mirror, I think that investors can put it behind them. For a while there, the data at Lightfolio was concerning, but it spiked, it ran up really quickly, and then it pulled back just as quickly after about 2 weeks.
Let me ask you this. You said that Netflix is losing digital mind share. I'm curious to know who, I know your charts show that there is, it seems to be greater attention to web visits to Disney. But even when we look at the share
Disney
performance,
sucks.
Disney barely got its head above water year to date. Netflix has been a big outperformer compared to the S&P 500. And then what I hear about, for people who do celebrate Halloween, the costume is all about this K-pop Demon Hunters, which is a popular show on Netflix, or a movie on Netflix. And yeah, I mean, this is probably out of our lane in terms of the actual content, but I know it's out there in the ecosystem. The kids are watching this stuff. So I'm just curious to know, who are they actually losing market share to?
Yeah, I'd say Disney is the one as far as our data is concerned. Now, again, this is year-over-year data. So Disney was lower a year ago, Netflix was higher. So it's all about that comparison. So we're not saying that Disney's getting more viewers than Netflix. We're just saying that they change on a year-over-year basis is better. Roku as well. Hulu not doing as well. But you can see here where the digital mind share, if you will, is moving. And again, Netflix has such a high bar. It's going to be tough for them to maintain that, but I think investors want that. They want to see a very high level. They want to see positive, obviously. They don't want to see anything negative. And it's, I think this is just a bit of a warning sign, a yellow flag, that, hey, this report may not satisfy these extremely lofty expectations. We think this, again, we think Netflix is priced to perfection. With that 4P ratio of 52, it's extremely high, 53. And anything negative at all is probably going to be very poorly received and could, with multiples, it goes both ways. It could really impact the stock negatively. Whereas, as we saw last quarter, like I said, they beat on everything and then they sold off 5% the next day. So if I'm trading this, I'm definitely leaning to the downside. Risk defined, of course, but I don't want a lot of exposure to, I don't want to have a lot of risk where if it goes down, I lose money, because I think that's the more likely outcome for Netflix. But again, they're the best, no doubt about it. They're just priced too high, I think.
Okay, that's a good point. All right, well, like that video that we just saw, we got to get our popcorn ready for the results after the bell today. Thank you, Landon. And that is Landon Swan, co-founder of Lightfolio. Some good insight there. Now for the trading perspective on all things Netflix, we want to get Tom White back in here with Kev. We got some good insights there. Kev, you take it away. I know you've got the example trade in this one.
Yeah, I mean, the Lightfolio data, the Lightfolio presentation, and the realization that even when they put out good numbers last quarter, the stock still sold off. Makes me defensive on this name.
Well, don't be defensive.
What I looked at, I measured the expected move one day, about $84. I rounded that to about 80. And what I looked at is the 1 week, again, similar to the last trade, except this is a calendar spread, not a diagonal, same strike. So I looked at the October 31st and then the October 24th, 1160 put calendar. So that's just measuring the expected move, rounding it to about $80, putting my strikes about $80 below where the stock is trading right now, Dan. It was trading about 320. It's trading about 330 now. Tom, looking at this, you want to move at or near 1160. You don't want a 2 standard deviation move. And obviously, this is a bearish trade, so upside is problematic as well. The risk on this trade, as always, is the debit paid.
Yeah, Kev, I was looking at some of the option premium in the near term, October 24th, weekly options that you're selling in this calendar spread. The 1160 strike has about $13.50 of extrinsic option premium. It's basically $80 out of the money, which is about just below that standard 1 standard deviation that the option move is pricing in. So you're setting up right where the option market thinks it's going to go if it goes 1 standard deviation to the downside. $13.50 that could go to zero if it stays above 1160. But let's break this one down. October 31st weekly options that expire in 10 days. Buy the
You're not allowed to do that, so if you're looking at anything, just remember it. And remember, they treated us very badly. They treated us very, very badly, so I think you're allowed report the truth, including the confirming of my cabinet much faster than first time. I mean, we went so fast that I gave John Thune and all of you credit for that. It was amazing. All of a sudden, I was calling John, I gotta get him approved. Come on, John, because I was getting like one every 2 weeks. And you know, I had people, they left their job and they left everything and it looked like they were, all of a sudden, it was like an avalanche. They walked in, James and James, my double James, I call them. They walked in and they had like so many of them. I said, you gotta be kidding. Is this like, are you for real, right, James? John Thune did his job and you got them all done and have all those people out there working now. And instead of being very upset with the fact that we couldn't get them approved quickly. So I really appreciate it. You used a method that I wish you could use on U.S. attorneys. You know, I have 10 U.S. attorneys who are phenomenal, phenomenal. A Harvard, a Yale, a this, a that, all top. And the problem is they're not going to ever be confirmed, I guess. I put them in. They'll be there for 3 or 4 months, whatever, and then they have to leave. Because anytime you have, as you know, anytime you have a Democrat senator, not even 2, just 1, they'll say because of the time we're in, we're not approving that person. We're not approving. They never do. They won't approve. And therefore, because of blue slip,
Donald Trump speaking. Amazon up $6.61. Okay, I'm going to take a few minute break. The 6750 calls are at $6.
What are you watching here?
Yeah, so just recently, I will touch on that downgrade. That comes from Redburn. And so recently they sort of came out, Diane, ahead of this earnings report, suggesting that they're actually moving now to a sell from neutral with a $475 price tag on this name. And the analyst thinks that basically this current stock price is too high. So what they're getting at here really is that the shares are materially overvalued in their eyes based on what they say is its reverse discount cash flow analysis. And so there seems to be some skepticism certainly coming from these analysts, my read on it, about whether the company can really sustain right now the kind of performance that would justify its current price. I mean, this has rallied up some 80% or so year to date. I've just checked that. Yes, 81% year to date. And so basically they're saying that the upgrade cycle also coming from Siemens Energy and GE Vernova could actually be reaching a late stage and downside risks exist. So they believe that as far as momentum going forward, they're less positive on that and they are turning more cautious on this name ahead of these earnings. Now, what's interesting is that I'm so fascinated to hear from companies in the business of electricity, power. We need so much of it for this AI boom, and that's certainly been part of the narrative, hasn't it, Diane, about the conversation? I mean, you've seen that GEV is expected to be a beneficiary very much of the electricity demand. I mean, I've seen Wolf Research, for instance, crunching the numbers. I mean, they're looking at significantly more US power supply coming online over the next 5 years because of this massive AI boom. I mean, you've seen the likes of Dan Ives, for instance, adding this name. You and I were talking about this a little bit earlier to his AI 30 as the company continues to capitalize very much on this demand that we're seeing for electrification and the continued build out of all these data centers. Now, the big question, the caveat is going to be whether we see an overbuild and whether that could be an issue for this company moving forward. But as I mentioned, really as far as what a lot of the researchers see, I mean, they are telling clients that they continue to see an outlook for sustainable sales and EPS outgrowth for electrical power-levered industrials, and this does include a name like GEV. So it is very well placed to very much take advantage of that. So it's going to be very interesting to also hear about the commentary.
It would be interesting to hear. I see what Redburn is saying about where it is, because like to your point, the stock is up 80% year to date, so are all of the gains essentially baked into where it is? And you know, when you look at the PE ratio, one could argue that it's expensive.
Yes.
So then the question is, one, how much more room could it run, right? If this demand story holds up as it relates to AI and what GE Vernova can provide. Any final take you want to leave us with as it relates to analyst thoughts?
From what I'm seeing as far as the commentary is concerned, Diane, I mean, the focus for investors right now is very much about production capacity versus, you know, the supply and demand out there. It's just economics 101, as, you know, people have been sort of saying. And, you know, when you look at the profitability of a company like that, it really just comes down to, obviously, what they're seeing as far as pricing power and margins. And in this company's case in particular, they are seeing strong demand for the gas turbines. And it's actually expecting to see a backlog equal to 3 years of production. Now, there is a view out there on the street that this visibility is very rare. It's very unusual. So now they've got to basically play this balancing act as far as my interpretation of protecting its pricing power and also trying to balance that production as well. So as that analyst also mentioned, you've got the likes of Siemens and also Mitsubishi who are ramping up their production, which could affect that strategy as far as pricing and margins is concerned. I think that really seems to be the focus for investors right now.
All right, thank you, Sam.
Thank you.
That is Sam Vadas, host of Morning Trade Live and co-host of Market on a Close with the breakdown on GE Vernova. All right, let's get Tom and Kevin back in here to dive into this one. Tom, you got the example trade in GE Vernova. So what's the approach you're going to take?
Well, the stock's kind of consolidated after that parabolic rally that we saw. Remember, last July when they reported earnings, they saw growth of about 12.4%, or $12.4 billion in their electrification and power divisions. That's good, right? It was 4% organic growth, $5 billion added to their backlog also. So that was a positive, but the stock continued to rally. I saw some downgrades after that earnings event, and the stock has continued to rally. It's caught the tailwind of this push into anything energy based on AI is going to get bid up, and I think that's why you saw it hit its all-time high post-earnings, about $677. But like I said, it's pulled back about 12.5% from those levels. So I looked at a strategy that, hey, if the stock goes higher, I want to still give myself a chance to profit on this one. If it goes lower or consolidates where it is, I'll profit also on this one. So looking to take advantage of higher implied volatility on this one in this October 24th weekly cycle. So just 3 days to expiration. A passive neutral to bearish position here. I'm going to sell a call vertical that's out of the money to the upside. The option market pricing in about a plus or minus $31 move in the shares with the stock trading at 590. I went up to the October 24th weekly option, sold the 615 call, and then against that, because we want to stay risk defined in high price stocks like this, buy the 625 strike call, short $10 wide, neutral to bearish call vertical. You're going to collect roughly about a 350 credit on it. Might be trading closer to 325, but the credit you collect is what you can make. If you collect 350, you've got $650 in risk per trade, but that's above 625. I think one of the key things, Kev, when I look at a strategy like this is, hey, I can be wrong and the stock can go higher and I can still be profitable. But that 615 short call that I'm selling in this strategy, about a 69% probability it's going to be out of the money at expiration, which is what I want, Kevin. High probability, but I still have $650 in risk, Kev.
Yeah, exactly right. Short, high probability, short call vertical, collecting theta and risk defined, Tom. What we talk about every day on this show. All you're doing, looking at the move on G even over for the year, betting after earnings. It can still go up. It can still go up.
Oh, yeah.
$30.
Here we go.
$20, and you're still.
That's a 200.
Straight, Tom. So
Knife.
625, collecting a little over $3 on this. So the risk is the difference between $10, the width of the strikes, and whatever credit you take in, Tom.
Yep, and that break even $618.50 to the upside. So you've got that big cushion of over $25, nearly $30 to get above that break even. So you do have the higher probability. Kev, real quick here, with these big red and green candles that we're seeing post earnings, if this stock opens up at 605 or 600 or 590 and this thing contracts, you just close it probably, right? If the market's open.
What did this happen for?
Yeah, it depends on your opinion and what you perceive the expected move is. If it opened up and it looks a little weak, yeah, I think you're putting. Think about this. If the stock's up and you're still profitable, you should probably look to close it out before it gets away from you. Manage your risk.
Yep, watch those red candles, Diane, on this short neutral to bearish call vertical there.
I like it. I've learned a lot about watching candles. I can't say that I can read it all, but I have. This has certainly been an exercise in education here. That's going to do it for us today on Fast Market. I'm Diane King Hall alongside Kevin Hinks and Tom White. Download the Schwab Network app. It's in the App Store. Tune in 24/7 on SchwabNetwork.com. Stick around. We've got Next Gen Investing coming up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching.
6750s. From Washboardjim, the sneaky snake trading strategy, I talk about chart patterns, moving averages, being in the now. We got a double bottom coming up. We failed the 200 SMA. Prepare ye in the name of the Lord. Take off. Remove. Oh, my darling. Oh, my darling Clementine. Perfect spot. When Trump speaks, the market dips. There it is. Double bottom. We got one more little channel right here. Jim, are you going to take the trade? Yes, I will. Okay, get ready. We could go to the orb. Okay, we're getting close. We're getting close. 643759. There it is, right there. Prepare ye in the name of the Lord. Now this can definitely get momentum here. Come on, give me 190. Might take $2. There it is, 190. There's no confirmation yet. So if I jump in this trade, it would be too soon. We got a hammer. Come on. There it is, 190. $190. A little risky. We get one more candle to the orb. We could do a double bottom. BA. Yippee-yi-yo. I think this is going to be it. There's definitely people stuck in this trade. $165 and $190. From Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy. We're at a pivot point. What's that? Somebody mic on? Wait 2 seconds. Ricky, you're on. $280, baby. 200 SMA takes them off the table. You know the rules. $3.30, my folks.
some reps. Back out some reps. Back out some reps. Break out some reps. Buying the dips. 3 black holes in the market scripts. Gold flag waving, profit saving. Washboardjim keeps the trade winds blazing. Break out some reps. Buying the dips. 3 black holes in the market scripts. Gold flag waving, profit saving. Washboardjim keeps the trade trade winds blaze. He teaches dummies, yeah, you and me, how to ride the waves of the S&P. Moving averages, patterns bold. The man's got wisdom worth its weight in gold. He don't stress, he don't shout. Jim knows what it's all about. Yeah. Back out some rips. Back out some rips. Break out some rips. Buy in the dips. 3 black holes in the market slips. All flag waving, profit saving. Washboard Jim keeps the trade winds blazing. Break out some rips. Buy in the dips. 3 black holes in the market scripts. All flag waving, profit saving. Washboard Jim keeps the trade winds blazing. Break out some rips.
Yeah. Break out the rips, buy the dips. Washboard Jim is real hip. That was a nice trade. Well, my baby's up.
Consider its exposure.
She looked hot yesterday.
Consumers, it's been a pretty nice formula this year.
Today, she looks like a schoolgirl.
More recently, though, the past 6 months or so. And this is one of those charts that illustrates how technical analysis,
Bull flag.
specifically trend line support and resistance, these horizontal.
But I have a problem.
Be a bit more subjective. I think you could perhaps draw one would be trend lines.
I have a problem with his trend lines. He's got a megaphone here.
245 connecting these subsequent highs, and then you could put a
The body there to the body there, and the body there to the body there. That's a megaphone.
You could also draw horizontal
glute.
lines, though, you could start here at these old highs that are green line here, and then you could see that these were around where we found subsequent lows near about 2.
Dude, none of them are even. How in the hell does he chart that?
Here, 217, we've topped out there.
The only
Times, possibly even breaking out.
I mean,
today,
I wouldn't chart it
and
like
also
that.
Around here near 230. So these are some levels that would stand out, I think, to most
I'd
people
bring it
who
down.
attempt to employ these technical analysis techniques here. If we were to look at our moving averages,
Capital
we can
One,
see that
you never
the
heard
moving
of
averages are clustered
Cough,
together
GOF.
212 to 213 general area there. Clustered moving averages that are trending sideways suggest weak to no trend direction.
Okay, get ready again.
That the price action is so choppy and volatile that it's
Get
not
ready
really
again.
able to find much of a directional bias. In this case, it seems to be more of the sideways movement here that you can see that we have formed.
Get ready
after our
again.
push above that 204 level. So now, if we were to also look at our relative strength index study, our RSI, we can see gradually lowering momentum here, trending downward with our red line here. But more recently, we have crossed above that 50 midline that separates bearish from bullish momentum here.
We got a head and shoulders, inverse head and shoulders, inverse head and shoulders.
To the downside, we have our cluster of moving averages for potential support, as well as 217, our old highs. So to try to assess this move in a couple of other ways here, we have our volume profile study
From
which is our blue
Washboardjim,
bar graph
the
on
founder
right
of the
side
Sneaky
screen
Snake trading
that shows
strategy,
that we are within
where I talk
a
about
heavy
chart
trading area
patterns
right now, centered
moving
roughly
averages
around that 250,
and being in the now.
216 general area here. So
What time is it?
even more emphasis on this.
I'm
as
gonna
a,
look see what time it is here
potential
before I start
tipping
this
point
trade.
here. We can also
We're
see
now
our
at
blue linear
12:20.
regression line here,
1:20 Eastern time.
219.70. That is our fair value line. Our line
Which
of
way
best
is the
fit
wind
based on
blowing?
Closing prices. So a push above this area.
Right now we're at a still
absorb those
pattern.
old highs near
We have an
230.
inverse head and
To the
shoulders right
downside,
here
if
that
we were to break
Washboardjim
down
is getting
through
ready to mention.
204, the point of control for our volume profile here comes in
And
around
I'm looking at the
197.
calls. Where are
Our
they?
-1 standard deviation
Calls
channel, pretty close, near about
at
200
170.
as well.
Okay, and so we will be watching, of course, for these numbers after the close today, but appreciate it to Rick, of course,
5
for
of
that
them.
technical help. But now to shift gears and take all this information and look at
Prepare ye in the name of the Lord.
ahead of that earnings event for example purposes. Walk us through your thoughts here, Alex.
Yeah, the last thing Rick said there was open the door back to those highs near 230, and that's what this trade is really looking for happening post earnings. So it's a
There's
call counter
150.
spread, looking for upside towards the 230 level. Not much beyond that, not much below it. Really, that would be ideal given the calendar spread's desire for
Get
being
ready.
precise and accurate and potentially projecting where stocks
We got to
may or may
need.
not
We need
go.
a. We
So
had
this
kind of a little
particular example is
confirmation
looking for
here,
a
but
bullish
it didn't
reaction,
work.
and one that would be just outside
So I think the next one
expected
coming
move
up
to those
will be
old
the
highs
one.
around 230. It sells this Friday's October 24th. It buys next
It's awful
Friday's
windy
Halloween
outside.
October 31st expiration.
I can hear that winter
Looking
wind
to,
picking up.
Basically spend $1.25, which creates a risk profile that has 125 in max loss potential, as you can see over my shoulder. And then it's got that risk profile that
Here, I don't want to put that in yet.
230 with risk in both directions. Now the nice thing is, Jenny, you can move that around to better reflect whatever.
Prepare ye in the name of the Lord.
Projection may or may not be, whether that's on Capital One or a different name, but this one's looking for a move towards those highs around 230.
Yeah, and obviously more of that pure play into some of this earnings volatility.
$1.50.
The end of somewhat this week to stretch things, and obviously
Okay, here it is.
volatility fares on the back of this earnings.
We want it to
event.
hold
But
right here.
Next is now
So I'm going
GE
to put in my
Vernova,
first trade at
which also has
145.
earnings out tomorrow morning. And this name has also been, I will say, not to, compare to, of course, GE Aerospace, now totally different entities, but also has been a really solid performer this year, now stuck in this range, but at least at a range that we're, closer to highs than we are definitely lows.
Hey, don't forget GE Healthcare, too, to add to the confusion. There's actually
Don't
3
even
of them.
mention
Yeah.
another GE to me right now.
Yeah, for sure. But same deal here as our last chart. Range bound, but also exhibiting some of the subjectivity of drawing these trend lines and horizontal lines here. By one measure, you could say around 665 or so to around 575, around that general point. That could be a broader range in which price has traveled here, but you could also say perhaps it's more of a symmetrical triangle type shape here, connecting these highs to the subsequent lower highs and these lows to the higher highs here. So you could look at it a couple different ways here. So maybe if we were to include our moving averages here, we could help make some sense of things here. But unfortunately, once again, much like our last chart, they're exhibiting this sideways behavior here where they're all kind of clumped together. In this case, we can see that they're around 605 to 600 or so in that general point right around here, lining up with our trend line more or less, and the orange 63-day EMA, which was pretty much on top of our trend line. They've both been breached concurrently here. When we also look at RSI, the green short-term trend line has been broken as well. So perhaps a bit of a bearish turnover potentially here. These are the early warning signs of potential trend change. It doesn't necessarily mean it's going to happen. That's one of the tricky things here is you want to get in on the trend.
Remember, Trump tweet is just a Trump tweet.
Possible when you're sure it has started to shift.
It doesn't really make me real bearish in the market. Just gives me opportunity.
Below that 575 level, that would be perhaps further
185.
That things could be taking more of a turn to the downward side. When we look at our volume profile study, we are slipping out of the heavy volume concentration area that's right here. It also includes our linear regression line as well. So that's around
$2, baby.
Upside. Volume is pretty thin until we get back down here around 490 or so. So there could be a long way to fall here if the other potential supportive area, these recent lows near 537, were also broken.
Yeah, and so this time, of course, we do have those earnings. We still have the entirety of the session then tomorrow mornings when we get those numbers. But definitely some big shoes to fill here, as this has been in a pretty nice uptrend, and we'll have to see if we can, of course, touch some new highs on the back of hopefully upside catalysts. But appreciate it to Rick for all of the technical help as always. And now as we do look to trade GE Vernova now, I mean, of course, a name with earnings ahead and also a very different world that it operates in versus, say, Capital One.
Definitely, and obviously you guys are talking about the confusion of all the different GE tickers. Imagine the confusion as an analyst who used to have to cover that all as one company too. So probably best that they have broken it up into its different conglomerate, into its different components. That said, I'm going to preface everything I'm about to say with each one of these examples independent, and they are examples, but you might start to see how a portfolio construction might combine some different things. So neutral to bullish strategy, GEV, October 24th, 565, 560 short credit spread. So selling, a put vertical below the market. And what you'll notice is the credit is $1.25. This is a higher probability of success. You should know that by seeing, hey, you're risking 3 times more than you can make. So just that alone should indicate, hey, relatively high probability of success. Your break even also lower than the current share price. What you'll notice is we're collecting $1.25.
Man, I'm done.
As long as the stock
A little bit overtrade.
Keep that to the end of the week. We spent.
But here we go again, inverse head and shoulders up to the 21.
But you may see how that was a little bit lower probability of success, a little bit more speculative, needing a move. You can see how these two trades.
I really like my moving averages. I really like them. Now we're retesting the right shoulder the second time.
And should be thought of as completely separate.
So this could be another scalp right here.
Positions and trades, and of course they're all just examples anyway.
Then we come up
sure doesn't help me
and we do the symmetrical flag.
Typically
So
around
somewhere
the same
around the
time, but
orb.
yes, very different entities, and of course, GE
Unless we come to a double
in its
bottom.
own right, I mean, has been a pretty
So if I was to go in, I'd go in
and
small.
Of course, we've also seen with the other various GEs, but we'll leave it there for all of our GE conversation.
Knowing that maybe you could double bottom and then triple down on the double bottom. Better.
After the bell.
Just take the risk and put a good tight stop.
We'll have to see if they can continue to really pave the way as a streaming force and the streaming dominant player on the back of now these third quarter report, which is coming today after the close.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X.
145 to 160.
And connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Time to discuss all things Netflix as we are seeing earnings report today after the closing bell in Netflix, and after seeing, first quarter price increases, the monster fourth quarter subscriber additions last year, I can definitely safely say growth is expected, if not anticipated right now by this market. But joining us now is Diane King Hall, the host of Morning Movers, for some more context on what to expect. And so Netflix always has, I think, the difficult but important job of being really one of the first, the first major tech name in the U.S. to report. So what are we watching? What is the street saying, Diane?
So
205.
Let's do the setup for what expectations are for both the top and bottom line. Adjusted EPS, the consensus expectation that the street is looking for is $6.89. There are some expectations for a little higher than that, but around that number. Revenue is expected to top $11.5 billion. The big question is, if it beats again, will it beat? Does it matter if it does? Because it has sold off before off the back of a beat. Guidance, of course, will matter. They posted big earnings beats in the first and second quarter, so can they keep up that momentum? The revenue gains they had earlier this year, they increased subscription prices.
Hey, for the monkeys.
Well, that's a big part of what's been fueling growth here. People are
145 to
still signing up
185.
ad-supported tiers.
This is my second round, folks.
More member sign-ups, even in the
I'm going to show you a trick here.
Password sharing breakdown.
They don't.
So
nobody talks about this on.
Here,
I'm going to show you a fact.
Tier as well, because it wasn't anticipated to be as popular as it is, but
I want you to look at all these head and shoulders, inverse head and shoulders.
Looking for some visibility on that,
look at them all.
In the context of
they just have that one right shoulder.
That we don't get the subscriber numbers anymore, so you
all
like to have that. But the ad-supported tiers, we've seen those reach millions of monthly users. In the most
they just have that one right shoulder.
Period, there was 94 million monthly active
I'm going to tell you a secret that nobody talks about.
Basis. So that reflects that there is some demand there. Even again, people are willing to deal with the friction of ads and have to suffer through that.
Not a one.
Favorite shows, and then of course the sports component has
been you see that?
Part of drawing viewers in, and we know Netflix
I want you to pay real close attention to what I'm about to say.
Sports, for instance, you had that Canelo fight,
so here's your left shoulder.
Some eyeballs.
Here's your head,
and I know you
and here's your right shoulder.
About this too, the big hit, the K-pop Demon Hunters. My child.
I missed the head and shoulders, man.
He watched that apparently.
The thing broke out.
Friends, hangout.
Just relax for a second.
Had some momentum there. So
let me show you a trick.
It appears to be on the top
I wanted to take that trade so bad, but I was in there taking a big shit, and when I came back out, it already bounced on me.
Year to date, so an outperformer compared
just
to
hold
the
on.
S&P 500, I should say.
Just hold on.
Again, a big part of what investors
wait for it to come back down the second time. Let it hit that shoulder one more time. You got your first hit, and then it came back and hit it again.
The ads, guys.
So when it comes back that second
they
time,
don't really give us those numbers.
I want you to look at that candle.
In their words and how they talk about it. Do you think
And
with the
and I've
less
said this over and
visibility
over and
true
over and
numbers,
over
not getting
and
the
over.
subscriber figures, for example, it makes the conference
Let it
call
come back the
more
second
important
time
than
if
it
you
used
missed
to
the
be?
first time. I jumped out of this trade at the 21 because I got these moving averages down to
questions from analysts
to a
and
nice
you
T.
can kind of parse through how they respond to those questions. It will be interesting.
So as it
also
started
see
to
what
come
they
back
say
down,
about
I alerted it again. I said, I'm going to jump back in it. Right back at 145, and I run it up to 185
some new sentiment data
and jump back
showing
out. That's $40 a contract times 5, so it's easy $200 bucks
Netflix, whereas now they did say that the comparison was tougher on a year-over-year basis
in less than 5
there was
minutes.
so much, leadership from Netflix.
So remember that second pullback on that shoulder.
When you think about streaming, that's at
If
the
you
core,
miss it the first
you add on
time,
other things. That was what it looked like last year, but this year.
and sometimes
they've
when
noted
it
there's been
second
an
when
increase in,
it resets the second time, you could get a bigger bounce than you did the first time.
Again, that's comps on a year-over-year basis, so the comparison is tougher. But content is still king, and Netflix has still been at the top of the list in terms of the content choices that viewers are making and
Do you understand?
watch. It does tend to be on that platform, and of course, note we should add they're in this conversation.
But you're still in scalping mode. I mean,
Around what's going to happen with Warner Brothers Discovery, which is said today that they're open to potential.
Now we
buyers.
respected that first support that I had on
Or
here.
they've made it clear that they really don't want.
This thing could break out again, then look at the clock.
We'd seen
Pay attention to the time frame, because after a certain period, everything gets weak again. In most cases, not all the time.
Buyer, they tend to be a builder, so they would build in-house rather than
Between 2 and 3 o'clock Eastern time
Really quickly before we let you go,
is where you got to really be
seeing
patient.
headlines regarding the
Here lately.
K-pop demon hunters. I mean, craze right now. That could actually be a huge lift for them. I mean, I'm curious if you've watched it.
So I'm
your
going to do a
thoughts.
video on this right
Not,
now.
But I do know that Rick Ducat, he's well versed in K-pop demon hunters.
Yes, I mean, I hear it's really interesting and fascinating. When I heard demon, I was like, what is that? I don't know.
I'll go over it one more time.
But it's certainly drawing interest. It's definitely up there in terms of top viewed streaming content on the streaming platforms. I believe it's in the top 5. It's either, at the last time I checked, it was either 1, 2, or 3. So it was up there, and there is a lot of interest in it. In fact, like for those who do celebrate Halloween, for instance, it's one of the top costumes that people are trying to, so be aware that that's what you'll see, some characters from that.
I mean, Netflix does tend to have these moments of pop culture relevance, so I do commend them for that. And this is definitely taken on pop culture by storm, as we were talking about it every day at work this morning. So we'll be watching for any nod on that, but of course, just the broader numbers from Netflix as they do report after the close. Appreciate it, Diane King Hall, for of course always giving us some more clarity on what we can expect ahead. But now, as we do now look at trading Netflix, Alex says this is hugely one of the most important earnings events of the week, and I think that without these key numbers that we're used to seeing, that will be somewhat disappointing just from our own reporting perspective. But they'll have to put up some pretty big numbers based on what we've seen from the last several quarters.
We talked about in the past lower volatility names that have low stock prices, really condensing the strategy playbook. In the same way, when stocks become high priced, it does the same thing. You just can't, unless you're willing to take a little bit more risk than a lot of the trades we talk about, do a lot of different strategies here. But the one thing that is nice about Netflix is there's a ton of expirations and there's a ton of strike availability. It's also a quite volatile stock, so you can go quite a bit out of the money here and still collect premium even on spreads. But right now, Netflix trading around $12.40. I looked at this week's $11.75, $11.70 put vertical, looking to collect around $1.50 credit. That'd be 30 cents on the dollar. So if I'm being straightforward in sort of the example how it was built, this is more of a function in my mind this time around of where can I go to create the risk reward that I want. So using that 30 cents on the dollar sort of guideline to guide me, I went to where that could be achieved. In this case, it was $11.75, $11.70 put vertical for $1.50. You do get $1.50. Their max gains $150 on max loss of $3.50. Break even's $11.73.50. So you do have some cushion, but this is a neutral to bullish strategy, Jenny. It's looking for the stock to either be unchanged or higher. It's not really hoping to utilize that I guess, $60, $70 of cushion that it has.
Yeah, and Netflix will have to see if they can, obviously perform within market's expectations, or we could see an outsized move. Or I always think the biggest risk to some of these names is just a whole lot of flatlining. But obviously, we'll be watching these numbers very closely as they do come out, and we'll be following along again tomorrow to see how the market moves in reaction to Netflix reporting. But we'll leave it there today for FOMO. Coming up next, though, we've got a fun conversation for you all planned as we're discussing leadership lessons and ways now to avoid corporate drift, as we'll be joined by the author of Now Phone, which is they're seeing publication day for this book, and we'll dive more into the key lessons now from Jeff Tuff coming up next.
I missed an opportunity right there. 115 to 140. I wasn't thinking. Didn't pay attention.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best
Hello,
way.
I'm Washboardjim with a Sneaky Snake trading strategy, where I talk about chart patterns, moving averages, and being in the now. And I'm going to talk about a play that gets misrepresented sometimes, or could give you a second chance on something that you might have missed out on and no one ever talks about, but I see it happen all the time. So I'm going to bring it to your attention right now. It's called the inverse head and shoulders.
Wherever you are.
And we just called out another pullback right here.
Morning Movers brings traders the biggest.
So this is called your inverse head and shoulders. It's a reversible pattern that can go into a bullish trend that has a head and two shoulders on it, a left and a right. So I want to talk about something. In most cases, all they talk about is just it coming down and dipping once and then running up for the breakout. Well, that's not always the case. Sometimes it's misleading if you go that route. Let's say you get a knock on the door and, oh man, Jim, I just missed that inverse head and shoulders. And I say, just be patient. I got a secret. I'm going to tell you about it. Something that nobody ever talks about. And let's get right to it. None of these pictures will talk about what I'm talking about on this inverse head and shoulders. It's usually just one shoulder with a head and a dip. Left shoulder, head, and right dip, breakout. Almost every picture of it is like that. Almost every picture.
Schwab Network, streaming 24/7, any screen, any
So I'm going to show you a secret.
free. SchwabNetwork.com.
And I just called this breakout right here. Here we are to the 200. I should have took that trade. It got down to 115. Now we're at 185, 195. So that'd have been another $900 trade right there.
Principal at Deloitte Consulting. And Jeff, first and foremost, today does
So here you got your left shoulder, and you got your head, and you got your right shoulder. I took this trade right here on the double bottom, higher low, running on up, and got out of the trade. Then it came back down, and I alerted the inverse head and shoulders. Jumped in that trade, run it up to the 21 EMA, and got out. And then it came back down for the second time. This is the secret. It's the second time that that touches that head. So usually, that's the last dip you're going to get.
defying drift.
and then it'll go ahead and break out to the upside.
In our books,
But
we use
this
a lot of
market's
metaphors from
reacting
the
to a
boating
Trump
world,
tweet
and
right now
when you're
about
boating,
China.
Obviously, it's easy to drift off course a little bit, but you have
They're trying to make
usually
some
the
kind of deal with
coordinates or the
China.
point on land that you're aiming towards, and you have
Trade
the
deal.
instruments to steer yourself
And
back
China's a
on
little
course.
stubborn,
In
so
business,
this
it's
can
not
go
quite
back
that
on
easy.
for
There are
months,
lots of ways that
and
you
it
can
has
drift
gone
off
back and
course
forth
from
for
your
months.
elemental purpose and actually lose sight of
But
the fact that
that
those
second
small
dip,
bits away from
and to me, a
your
Trump
original
tweet is
intention,
nothing
whether
but
it's due
opportunity to take a good
regulatory
trade.
shifts or competitive moves
So you
or
got to
new
be
technologies
patient,
or what have
look for
you can
the
wake up one
setup.
day and suddenly find out
Then
you're way off
my
course and you
my
have
strategy is
to,
all about
quote,
chart
unquote,
patterns,
transform, which is the
moving
thing we're trying to help
averages,
companies
and
avoid.
being in the now. So
Jeff,
all
as we
three of
kinda
them
look at this as a
ingredients
broader
was
trilogy,
in here
you
to
start
take
with
this trade.
detonate, I believe,
So when
which
it
is
comes
sort of
back and
shake
touches
things
that
up,
right
be
shoulder, you
willing
want to look
to,
at the
have a
candle.
beginner's mind.
See what kind of
You then
candle's
go to
popping off that
provoke,
shoulder
and now
line.
we're honing
The right
things
shoulder the
in.
second
Is
time.
that meant
And in
to
this
kind of
case,
follow that
the right shoulder
progression intentionally of like,
was
hey, you shook things up, but you
this
also got to
hammer.
make sure you're still
Then I
on
just
track,
called
and
out
that's
this
the
other
honing
trade with a
aspect.
tweezer bottom, and I didn't take it. Wish I would have,
love to claim that we had this
because I'd
plan
got
all
in
along,
that
but
at
we didn't. So we
115
wrote
and
the
sold
first
it
book,
at
Detonate, just
190,
intending to be one and done,
just
and
like
we really
that. In a
felt
matter
quite
of 4 or
passionately
5
at the
minutes,
time the companies
bought
had
10
to
contracts.
defy conventional wisdom, blow up the
So
playbook
that's
to succeed
part
in
of
the
my
face of
strategy.
exponential
Just
change and
remember,
increasing
nobody ever
uncertainty.
talks
But
about
once
that
we'd
thing
blown
coming
everything
down
up,
and hitting
we
the right
realized we had
shoulder
to
the
talk
second
to
time.
our readers
And let's say you
and
missed
some
the
of the folks that
trade,
we work with about
you could
how to
come back
then,
and say, okay, I got
think
another
about
chance.
driving a
Let's see what
future in
happens
which
when
you
it
have
pulls back to that
advantage.
right
And
shoulder
after
the
the
second
book,
time.
It then felt just right to bring it home with this book, Hone, which is all about how
Inverse head and
we would
shoulders,
recommend
one of my favorite
senior
chart
executives
patterns.
in particular at some of the world's
You got the
most
snake,
scaled companies
break out,
get really
pull
involved
back,
in the nitty-gritty
2
details
right
every
shoulders,
single day to
boom,
make sure they stay
right
on
to the
course and avoid
50
that drift I
SMA
talked
and
about
the
before.
63.
Okay, and you mentioned
With
this
a
term that I love,
bearish
that's
candle
rock
right there.
band rule, which
Came
is
right back
basically
down.
passion, of course, can
You have
create
higher
hit.
lows.
Purpose, though, will keep that band together.
Back up to the
So I'm
200 and
curious,
out
your
of the
takeaways,
trade.
why
200
passion is not
SMA.
enough to sustain some of this long-term success?
This is the sneaky
Well, so we
snake
had the
trading
great
strategy
benefit in
where I talk
Hone
about
and,
chart
working with
patterns,
4 different
moving
artisans,
averages, and being in the now.
trying to pull together some of the ideas to be applied to the corporate world. So we spoke with a great chef, we spoke with a film producer, we spoke with a famous photographer, and we spoke actually with a good old-fashioned rock band. One of mine and Steve's favorite bands from Canada called Our Lady Peace, a huge indie band from the 90s that actually made it worldwide to worldwide fame, and they've been able to keep themselves relevant for over 30 years at this point. As we got to know the 2 members of the band, Rain Maida and Duncan Coots, the lead singer and bassist in particular, we realized that there's actually a lot of what they've done over time in keeping their band on track and staying relevant for completely different music landscape, completely different audiences that can be applied directly to business. And if I had to boil it down to one essential lesson from each of these guys, it's to have the humility to understand that passion will not take you all the way there. They are super passionate, great rock stars. We love them both, but they realized as the streaming hit the music industry that, you know, having the big record label, having the multi-million-dollar record production was not going to get them to the next phase of things. So they had the humility to say, you know what, we don't need to continue to own the rock world. We don't need to continue to aim to be the biggest band on earth. What we need to do is be relevant to our audience. And so they were totally fine with scaling things back a little bit, with playing to slightly smaller audiences, but playing to audiences that were ever more passionate about what they were doing. And that was just one small lesson that we took from Our Lady Peace that we think every executive can learn from.
Jeff, as a consultant with 30 years experience, now a 3-time author, obviously leadership is where you're focused on many of the books here. As educators and people in media here, we oftentimes talk with analogies and trying to illustrate things to get the message across. Is that what we're trying to do with the rock band rules? It's a lot easier to show you these lessons than go in and just tell you, hey, here's the definition, this is how you do it. You need to see it in action for those messages to really resonate.
I think that's exactly right. And to be quite honest, it's kind of more fun sometimes to read about rock bands and photographers and chefs than it is to read boring old business theory. And so what Steve and I have tried to do from the beginning in all our writing is to make our books as readable and as approachable as possible, not just for business readers, but for all readers, and to use real stories from real people
Back to the
help
200.
learn these business lessons. So that's spot on what we're trying to do with the rock band chapter and all the rest of the book.
Okay, so really as a broad takeaway, what's one small move you recommend for some of these leaders who want to start this honing right away to really really strengthen some of their team's alignment and, frankly, performance, as you do write about in your book, of course.
don't overthink it, don't overanalyze it, just get in there and start doing things. And you know, the whole premise behind Hone is that a lot of senior executives think that their job is, when it comes to defining strategy, to really thinking about the big vision and setting out the path forward and then giving it to other people to go and execute. But actually, that's exactly the wrong way of thinking in a period of time where we have no ability to predict what's going to happen in the future with all the changes that are impacting us. The best way to stay on track for senior executives all the way up to the CEO is get in there, work with your management systems every single day, know the behaviors you're trying to drive in your organization and outside, focus on those, and you'll be successful.
Yeah, I mean, absolutely. And really great way to leave it, of course, on a positive note. But we so appreciate your time today. And again, congratulations on all your success. And of course, publication day, as I'm sure you've been pretty busy today, I can imagine. But thank you so much, Jeff Tuff, Principal at Deloitte Consulting. Now, coming up next, last but not least, it's time for Under 30. Today we're discussing Warner Brothers Discovery with a pretty big pop today on news that it's expanding its strategic review of its business and is open to a sale. We'll dive more into that coming up next.
Opportunities don't stop when the market ends. So when night duty, Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk one of our biggest movers of the session, which is that of Warner Brothers Discovery, which is now up over 10% on the session here. On, of course, some developments regarding a potential sale. So joining us now is Sam Bosch, contributor and host here for the Schwab Network. And so, Sam, walk us through the latest, because we've talked headline after headline regarding this strategic review and their business and being open to a sale. We finally got some updates, at least today.
Good afternoon to you, Jenny and Alex. Yes, well, we are seeing shares flying high today, as you say, in Warner Brothers Discovery, coming off the back of the company actually issuing a press release, coming out with a statement earlier today, and I'll read some of the lines from that. It said it's going to continue to advance previously announced separation and is reviewing its options right now. So what's new about this and what seems to be helping out the stock today is the fact that it's basically publicly come out to say that it's received unsolicited interest now from multiple other parties for both and the entire company and also Warner Brothers. So basically Warner Brothers is saying that it is open to a sale now. It comes after it had previously announced, as you mentioned, that it's going to be splitting between the streaming and studios business. So it had actually come out previously and said that it's going to be in the process of splitting itself into two. So one side would be the TV production studios, HBO, the streaming business, and then the other side would be the cable channels, CNN, TNT, Discovery, Food Network, TBS, etc. Now, there have also been reports, well, in recent weeks about the fact that Paramount, Skydance, Finance has been throwing its hat into the ring as well, interested in buying the whole thing. But then you've also had the CNBC's David Faber out with some deep sourcing today and some reporting around the fact that there has been some back and forth actually between Paramount, Skydance, particularly on the pricing, etc. It's not clear where that's up to right now, but basically Warner Brothers seems to be putting itself out there to look for other parties who might be interested beyond just that name. So there is indication of interest, according to Faber, from the likes of Comcast and also Netflix. That would mean what that would mean and what it would look like is the big question, because remembering that Comcast is actually spinning off its cable networks as well right now. It's in the process of actually breaking apart. Netflix, on the other hand, will likely be asked about this on the earnings call when it comes out with its report card later on. Obviously being number one in the streaming business, there has been some suggestion as to whether something like this would then catch the attention of the regulators, so that's obviously something to keep in mind as well. The CNBC reporting has actually pointed out that it's not clear how serious these other bids, or at least this interest, actually is. Netflix, they pointed out, is not interested in buying legacy media assets, but didn't want Warner Brothers Discovery to go to another buyer at a low price. So yes, it's very interesting as far as what this company is actually saying in this press release about how it continues to make strides with the business right now, particularly because of this evolving media landscape, and it's trying to basically put itself out there, find other options, see if there's other interests. Fascinating that it's actually been talking about how it's got unsolicited interest from other parties as well. But they said that it's basically no surprise that the significant value of their portfolio is receiving some increased recognition by others in the market. And it's been fascinating, just as far as what some of the analyst commentary has been today, just around, what something like this would mean as far as, the entire media landscape as we continue to talk about, the shifts and, the changes that we are seeing here, that everyone's basically trying to figure out. This is what one analyst said earlier today, the sort of Goldilocks scenario here, with obviously the legacy cable TV networks and then also the streaming in the best way to try to get value out of something like this.
Yeah, and this sounds like it's not our last time, of course, discussing this deal, but definitely has provided some overall interest in Warner Brothers Discovery as we're up again another 10% today, just fueling its gains. And I know it's been volatile, but hey, we're up 92% nearly on the year, so it's definitely been a catalyst for shares hugely. So appreciate that, Sam Vadas, host here for the Schwab Network. And very quickly before we go, I just want to check in on markets here, which actually looked a bit stronger about a second ago. I was excited to say maybe we're ending on a bit of a brighter spot, but things are
no doubt it's a brighter spot than it was when we started, because when we started, we saw the market actually had a little bit of an intraday sell-off, but there's green on the screen at least for 2 of the 4 indexes here, as the S&Ps are up 7.
Yeah, so closing things out on a bit of a brighter spot here to close out, of course, our show for this Tuesday. We have the watch list, though, coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
Hey, Dad.
Dad, why doesn't Grandpa sleep with me anymore?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me and my advisor Jennifer. She was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome to the watch list. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're live at the New York Stock Exchange at the corner of Wall and Broad, financial capital of the world, and we've got you covered during this earnings season. We'll talk about a little bit of everything, right? The state of the economy, some potential headwinds on the horizon, and several investment areas to watch. Well, the government shutdown, of course, day 21. And we'll discuss where the AI trade could be headed and how Asian tech stocks could be poised for growth. We'll explain. And we'll bring in our panel, talk all about these quarterly reports and some of the names that can be more defensive plays, protect you from some of the volatility. The geopolitical landscape, granted, and you've even had the CEO say it's calming a bit, but still, where should you park your money? In the meantime, looking at stocks, look, we've had some back and forth action throughout this day, but right now you're seeing up arrows, right? Not too far off the unchanged line, still searching for direction. And granted, we've already run up a lot since Liberation Day. The S&P is 67.44, that's up 9 points. The Nasdaq 100 is up 6.7 points, 25,148. The Dow is gaining 305 points right now, 47,011. That's more than 0.5% for the Dow. So that's some good news there. And the Russell is pulling back down 1/3 of 1%. We look at oil and gold. I mean, gold has had complete profit taking, complete sell-off. There was anticipation of lower rates. The lower rates are here. People are just after the record we saw yesterday. It is now down $232. It's at $41.28 a troy ounce after being nearly
$2.30.
57.75 the barrel on oil. 10-year bond yield $396.9869, and Bitcoin's back above 110,000. Now it's at 112,000, gaining 1.2%. Kevin Hayes is with me, host of Fast Market here on Schwab Network, and you're there live at the CBOE. I think, are we on day 21?
It's day 21 of the government shutdown. Where do we stand on this?
Day 21 of the government shutdown. They tried to vote yesterday for the 11th time. It failed as it has in the past. It's interesting. You're starting to get some other ideas, like John Thune, the Senate Majority Leader, is trying to pass legislation that would pay federal workers and military who stay on the job during that. But even that needs Democratic help to pass. And they did reject a similar offer than that a few days ago. So we stayed at stalemate. President Trump made a comment about it this morning, urging Democrats to vote. Remember, it was Kevin Hassett that came out on Monday and said maybe something will happen this week post the rallies from last weekend, but nothing yet. I'm checking the wires. There's no agreement yet. The vote, there's no vote.
So here you go with the second shoulder. Boom. Boom. Now you're holding up the 9. So we're going to know any second if this thing wants to break up to the top of this here resistance channel. And it could go higher. You got a real nice trend moving on up. You got a double top. Third resistance, second resistance, and first. So we're about to the first resistance. Do you understand? And then you got one right here. You just run a trend line from the body of that one to the body of that one. Man, she's hot today. She's really hot today. I couldn't do an interview with her unless she give me a hug first.
Pivot to an intense focus on those questions, but so far we have really been patient in giving them a wide swath to report.
Nicole, can I have a hug, please?
And when the discussion comes to what are you going to be doing with the AI, so far that has been a very thin discussion, and I'm hoping that that will pick up, but it's so hard to predict this thing. You know, for instance, this could go on for several quarters. I'm not saying that this quarter is going to be the make-off quarter where it actually does focus, but I also wouldn't be surprised if we woke up.
These idiots keep calling a bubble in AI. They've been doing it for almost a year now. They keep they mention it over and 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 over. Their tangents don't work. I listened to a guy that I listened to about politics. He had some stock guy on there from Goldman Sachs that used to work for him. And he talked about the bubble. He said, you know, top 7 stocks own 35% or more of the market right now. And that's all he could mention was the bubble. Overbought, uncertain times. Leon Cooperman, a month ago, I'm out. We're in a big bubble. Warren Buffett out about 3 or 4 months ago. I'm out. We're in a big bubble. They've all been wrong. They've been wrong. These analysts have been so wrong from the rate cuts 3 years ago, saying we were going to have 6 rate cuts when we had that big in 2022 into 2023 that we were going to have, and we didn't. They're wrong about high inflation over the tariffs. We're actually bringing money in. They're not mentioning about the fact that the Democrats want to raise the budget up to $1.4 trillion, $1.5 trillion just for illegal immigrants. The illegal immigrants is costing this country a lot of money, and it's going to cost us a lot of money from down the road. I mean, if you have children, they better get out and get their ass to working, because inflation is going to be so high because of all these illegal immigrants. Healthcare, food stamps, housing, I can just go on. They'll probably come up with some bill where we'll pay for their own car. I wouldn't doubt it. A $7,000 down payment to give to illegal immigrants so they can buy a car to go back and forth to work on. I wouldn't doubt it one bit. Remember, I said I'm one of the first ones to say that. We got 14 million illegal immigrants in the last 4 years, the biggest increase ever that in my lifetime. Illegal, people that can't speak English. You get free education. I mean, it's going to add up. It's going to add up huge. They don't talk about that. They don't talk about how much it's going to cost our country. Trillions upon trillions. Every single year. Just added 1.5 trillion to the budget. Then in 3 years add 2 trillion, maybe 3 trillion to the budget. And that's not counting unfunded liabilities. People coming over too old to work, getting free health, getting free Social Security, Medicaid, Medicare. So it's just the way I see it in a way. I could be wrong. All just for a vote. Just to help the Democrats get more votes, because they're losing Democrats. They lost me. They lost a ton of us. So we hit a hard resistance right here. $1.5 trillion. I don't want it. I was just now looking at this chart where we had this old resistance right here. I'm going to put a red line right there on that. Look where we pulled right back to the top of that there resistance channel on that right shoulder from yesterday's Darvis box. That was a double confirmation to take that trade. And there's a triple confirmation after you hit the shoulder at the right time and that thing run up almost $160, $170 a contract.
Okay, watch support here. We're back to the orb. Oh boy.
Hello. I'm
Boom, baby. Dragonfly Doji. I'm going to go get me a hot chocolate. So we double topped. We did hit that line of resistance that I had on there.
Beating expectations for the latest quarter. The home builder's CEO saying the company continues to monitor buyer demand that has been impacted by weaker consumer confidence and ongoing affordability challenges. PulteGroup saw some wholesale numbers, the revenue falling 2% in the quarter and closing fall 5%. Okay, let's discuss the economy and potential investment opportunities. And our guest Noah Wise is with me, Senior PM and Head of Global Macro for Plus Fixed Income at Allspring Global Investments. Thank you for being here, Noah. We were just talking about some of the action here. The earnings story has been pretty great thus far. Up through last week, 86% of the names had beat the street on earnings. This week we have 1/5 of the companies in the S&P reporting. Some of your thoughts on the action?
From a bottom-up perspective, corporate fundamentals are in very good positions and strong earnings growth, strong margins. So we're not seeing a lot of issues from corporate fundamentals, broadly speaking.
Yeah, the fundamentals are still looking pretty good. I mean, that's sort of, people were concerned about the labor market slowing, whether or not inflation would rear its head again. But the big picture and what I keep hearing is fundamentals are all right.
So far, that's been the case. There are starting to be some cracks in the labor market. We've certainly seen top-line job growth slow recently. Now we have a dearth of data, but the most recent labor market data, the ADP print, was much weaker than expected. So there are some concerns out there, but broadly speaking, corporate earnings is not one of them.
And, we just haven't been getting prints, too. We haven't had our labor report and CPI on Friday. That would be something that we could sink our teeth into. You did say that, it just seems like it's just right at the moment. Are you concerned that path of least resistance could be bad news?
We don't think that's the case. I mean, we do see some challenges with inflation. Inflation has been sticky. It is still above target. We're going on the 5th year where that has been the case. We think that moderates what the Fed can do. The Fed still wants to reduce rates. The Fed is on pace to reduce rates.
Right.
With the data that they have, they've signaled that they are going to continue to reduce rates, but it is going to be gradual. It's going to be more moderate. So it's a tailwind for the market. We think that does continue to support financial conditions more broadly.
And maybe it's appropriate, as you noted, you were looking globally at China and Europe and just not seeing strength there at this moment.
We aren't. I mean, there again, it's not a disaster, right? China's growth is decelerating, but it's still mid-single digits growth. So it's slower than it was. It's likely to be slower moving forward, but it's not turning negative or even approaching that. Europe, similar, came in this year growing about 1%. They are continuing to grow right around 1%. So they're far from blowing the doors off.
So where are you
it's
getting,
not a big issue.
where are you going to get yields? Where are you going to make money? Is it going to be equities? Is it going to be fixed income? Both?
Yeah, we focus really on the global fixed income markets. We're a global multi-sector fixed income manager, and income is a critical component. When we look at the valuations, it is really important to determine where are you getting compensated for the risks that you're taking. And while corporate fundamentals are very, very strong, we think a lot of that is already in the price. Credit spreads are at historically high levels. We're finding better income and yield opportunities in things like agency mortgage-backed securities in the U.S. When we look internationally, we see opportunities in some European government bonds hedged back into dollars. Similarly, short-dated emerging market local currency government bonds, again, hedged back into dollars, are providing what we think are relatively attractive yields and income in this market.
Wow, that was, you talked about agency mortgage-backed securities here, euro government bonds, but in U.S. dollars. And then the third one, mortgages abroad, but brought back here.
Mortgages here, but emerging markets abroad in local currency, but hedged back to dollars.
How do people get access to some of the things that you're talking about? If you came here and said, I really like IBM and Apple, they didn't know where to find those. These may be more difficult. I mean, is there a way for folks to have access to these kinds of global positions that maybe could be lucrative for them? How do they go about doing this? They want to, do you have a recommendation of something broad or easy for them to grab onto?
So we do manage global multi-sector strategies in a broad array of different vehicles. And we do think that when you look at global fixed income today, there really is a lot of opportunities. Yields are still relatively high. Income is quite attractive. And when you put it together a really diversified type of perspective in a global multi-sector strategy, we're finding that is delivering a return stream that's been attractive to a lot of investors.
You're also looking at FX strategies, looking at the currency here at home, right? The dollar has been a little bit weaker, not necessarily lately. I mean, it's been a bit of a range lately, but it's weaker over the last, say, 6-8 months. What do you think there? How do you play are you looking at the different currencies at home versus abroad?
Yeah, we do. So on the emerging market side, we do see that currencies here are closer to fairly valued against the dollar more broadly. On the developed market side, we do see a few opportunities. We think that there is some opportunity for the euro. As you mentioned, it is done a little bit better against the dollar year to date, but there's been a more recent pullback. And so we do see some value with the euro currently. The yen, I think, is a little bit more challenged, right? We just got some news on the political front in Japan, and that is going to point to what we think is quite likely more fiscal stimulus, probably the central bank hiking rates a little bit more gradually than it otherwise likely would have. And that, we think, is probably going to continue to put some pressure on the yen, so we have a less stability there.
This morning, Sanae Takaichi, the first female Prime Minister of Japan, on the conservative line there. So watching for that. I think the big picture takeaway is it better to be invested versus not invested? I mean, whether you're definitely looking globally. Do people keep doing that?
Yes, our view, if you think about kind of global yields and where they are overall, continue to be quite attractive and are really providing you know, the type of return stream that they're looking for in fixed income. And that's really been the case in 2023, 2024, and into 2025. We're seeing, you know, mid type of annualized returns, sometimes even a little bit better. So it is a good market for fixed income.
And quickly on duration, what are you recommending there?
For duration, we have had a little bit of a tilt to more interest rate risk in our portfolios up until the end of the third quarter. And more recently, we've actually lowered our duration and have a neutral. Our view on the fair value of the 10-year treasury as a proxy is right around 4%, which is what we recently hit. So we think interest rates are pretty fairly valued.
All right, Noah Wise, thank you so much. All Spring Global Investments. Thank you, Noah.
Thank you.
All right, coming up, we're going to take a look here at the big picture, give you more opportunities for your portfolio, the AI trade, Asian markets, much more. We'll be right back.
Sometimes, you know, you could have done better.
You could have.
Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade.
It's now 2:39.
And connect with me on LinkedIn or Instagram for more.
Today's losers was Applied. Ooh, look at Applied. They were pumping this one the other day.
The award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs.
RGTI down again.
And track market trends with up-to-the-minute news and insights.
Now this ain't right.
With Schwab.
Oh, Baidu's getting down there in price land.
Welcome back to the watch list. I'm Nicole Petalivini. As valuations become more extended in the U.S., emerging markets show potential for more growth. To discuss opportunities,
Extended again.
Jason Seuss, the
Overbought.
founder of Brilliant. Thank you so much for being with us, because we look at the AI trade here at home and abroad, and you're going to tell us. I mean, people love
This
tech.
is what-
They love AI. They don't want to hear that it's done or almost done or what inning.
This is my philosophy. Is
you know, they want
I don't think they know what
opportunities,
it's like
and
to
I
have a
know you
president
still think
that's been
there's
in
some room
business
to run.
before.
Tell me more.
So Nicole, that's absolutely true.
Because we've had nothing but socialist president after socialist president.
I know you don't want to talk about innings, but I'm just saying.
And if we'd have got Hillary in there, God, or Kamala,
Some
she's a
of these
dingbat.
moves are expensive, but I think
what we're
She would have
seeing
been
now is
Obama's
earnings
puppet
are
again.
Actually outperforming expectations, meaning earnings are catching up, and with each quarter, it actually makes valuation levels shrink and look cheaper. And that's very
Redistribution of wealth
Look, nice to see
is
some
how they
earnings
look at it.
catching up, but there's
They
no
don't know
way
how
they
to
can
earn.
catch up to some of that capex spent.
They just want
I
us
mean,
to
we see
share.
billions and billions going out the door.
And I share less when
Giant
they're in
it's gonna
office.
be super. At some point, they're going to get really tired. They want return on that investment. They're going to become sort of jaded and say, listen, you know, you're dropping another $50 billion. I don't want to hear it. You know, at what point does that happen? But in the meantime, we've seen some great strides for a name like Alibaba, for example, a name you like, right? Tell us more.
Yeah, so Nicole, names in the U.S. are expensive, like you say, and it's going to take some perfection to make sure you get your capital back. But if you really look outside of the U.S., you look at Alibaba, right? It is no longer a software company, right? It's got its own AI chip, right?
Yeah.
It's got its AI algo. So it is comprehensive as an AI play, but at a third of the
AVGO's down $7.
That is an opportunity at a much
Oh, this looks good too.
When you look at the Max 7 here at home, are you tempted? I mean, are you tempted to say, I really like some of these names, or is it just so obvious to you that they're overvalued and you're not touching them? I mean, what do you do? Or you have to be in on the type of thing?
So I would say the beauty of the Max 7 is if you look back to the internet days, right, the money, the capex, had to come from the VCs. And the VCs do demand return on the capital. But now with the Max 7, the capex is all from retained earnings, and they are the richest cash cow out there. So they can keep throwing money at capex, and they can
Coin down 1.76. Kroger's down today after earnings. Didn't really pumping that earlier?
Oh, that's interesting. So they don't
Oh, earnings ain't happening yet.
It says, hey, I won't do this and I expect this. Instead, it's from their own earnings. And I guess they
Well, I don't know, man. I like that.
how it's done is what you're saying.
Yeah, and it's a lot easier when you're already producing, right?
Grocery stores like insurance company are making a killing because of the markup on groceries. I mean, geez. Thank God for Walmart. For example, if I'd have bought my ingredients for my soup, it would have cost me $45 to $50. And I buy it at Walmart, and it's only going to cost me, well, the second batch only cost me, all I had to do was get carrots, celery, and a green onion, and garlic is what I got last time, and that was less than $17. And the first time, 17 plus the chicken, so it was around 26, 27 bucks. And I split the chicken in half for this batch that I made just the other night. So I made 2 batches of soup for the price of one batch, for less than the price of one batch at my up the grocery store up the street. They want chicken for 5 chicken breasts, the big fat ones that are really tough meat, for 22 to 25 bucks for 5 chicken breast halves. When I go to Walmart, get the same weighted chicken and get 6 chicken breasts, maybe 7, for 12 to 14 bucks. So right there, and then the celery I save $1.20 on, and then the carrots I save $1 on. When I get the bagged carrots, about $1.50, and the green onion I priced one out, 86 cents at Walmart, $1.34 at the local grocery store up the street. And they got bought out by this chain. These steaks are 25 to 30 bucks, a good T-bone, decent not T-bone, but ribeye. Hamburger now $7 a pound when it was 4 years ago about $3.99 on when it was high. So my grocery bill's more than doubled. And I don't think groceries should be up 50% in 4 years. It's ridiculous. Bread, $5-6 a loaf. Eggs were at $11.50. Now they're back down to, that's a 12-pack. Now they're back down to $3.99. Chips, $6 for a bag of chips at the grocery store. So and one of the only benefit about hamburger being so high is I'm making little bitty hamburgers now. They're called sliders, and I really like them a lot better because I make 2 different kind of hamburgers instead of one big one. They are a lot better. I bought some buns on sale the other day, or the cheap ones, and I hated them. So I had to go back and buy the better buns. They were soggy. Kroger's breaking out here past the 200 on the 5-minute. We got an inverse head and shoulders. See, here you go again with that shoulder line. Left shoulder, right shoulder, break out, and then pulls back again and retest. And then boom. None of them will tell you that. Nobody, I don't think anybody ever talk about it. I miss this trade right here. Talking. Nice reversal. Man, I love drinking this hot chocolate. Beautiful reversal on AMD today. Yeah, Kroger's a nice little bounce there. So you got resistance right there. We could probably hit that 68.34 today. Maybe. We got 7 more minutes to power hour. And I'm going to take a nap or watch some videos. I love watching videos on YouTube. They censored us for like 4 years. All my friends, some of them lost their channels. They censored a lot of people I know. Some of them stayed on and fought it out. So I don't understand why they're saying Trump's a king when we were being censored. We want them to talk. The more the merrier. Hello. Not a bad day.
Here with pretty high confidence, and it feels as though the conflicts around the world, while they
We got triple bottom
today, I think will continue over the next several years. So these are places that will be very, very durable from a revenue growth perspective.
Yes, I mean, GE raises their numbers going forward for earnings, for revenue, and free cash flow. I agree. Bill, what name do you like the most? I mean, I know you mentioned RTX and the defense spending that we're seeing there. You like that? Do you like any others?
Yeah, another name that we like is Huntington Ingalls, and just as we're thinking about where the defense is focused, where the administration's focusing spending, so it's missile defense, space, cybersecurity, and then lastly shipbuilding. Huntington Ingalls is it's a shipbuilder. It has a near monopoly, and they basically build nuclear-powered aircraft, and they're a major builder of submarines and surface combatants. We think that just in terms of the visibility, we think it extends out to potentially 2030 or beyond. The company had some supply chain issues. We think that those are starting to dissipate. So we're positive on that one. It has a very reasonable valuation. It's trading at under 20 times our earnings, and we love the long-term visibility.
Well, I'm going to leave it there. And I love how you both knew each other from yesteryear covering these things. So you both have had some great clout and experience in the defense group overall. Joseph Shaposhnik and Bill Whelan, thank you both very much for being with us. Joseph, Bill, thank you. That's going to do it for us here on the watch list. Thanks for being with me every single day here on
You're
Schwab
welcome.
Network. You can download our Schwab Network app. It's available in the Apple App Store 24/7, schwabnetwork.com. I'm Nicole Petalides. I catch you at 9 a.m. for opening bell and right here on the watch list at 2 o'clock. But keep it right here because Market on Close is next.
She's after your job, Nicole. Oh, I broke my silence. I broke my silence. She's after your job, Nicole.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com. I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caton, coming to you live from our Chicago headquarters.
And I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what's coming up on today's show. Earnings will be in focus after the close, as we'll get reports from a couple of heavy hitters in Netflix and Texas Instruments. We'll break down those numbers live for you after the bell. We'll revisit yesterday's AWS outage that Amazon now says is back to normal, and look at how companies can prepare for these events in the future. And in Options Corner today, we will dive into GE Aerospace, which hit a record high today after its earnings report earlier this morning.
morning. But for now, Molly, take us through what you're watching today.
Thanks so much, Sam. Yes, Warner Brothers Discovery says it's open to a sale after receiving multiple unsolicited offers. This announcement confirms the
You look hot, baby.
opens the door to a potential full or partial sale of the company. The stock is up more than 10% on this news as bidders like Paramount, Skydance, Netflix, and Comcast circle the company, potentially igniting a bidding war among some of the biggest players in streaming and entertainment. Also, GM posting stronger than expected earnings and raising its full-year outlook as resilient truck and SUV demand offsets slowing EV growth. GM says it remains committed to its long-term EV strategy despite there being some softness near-term. The automaker also lowered its expected tariff impact for the year, sending shares up about 15%.
Lord.
Also posting stronger than expected earnings for the third quarter, driven by steady
That ain't
global
what we
demand
heard
and
by the
strong brand
Dems.
power, particularly for its Coke Zero sugar products, despite a mixed consumer backdrop. The company says it continues to show pricing strength and resilience, even as shoppers are growing more selective.
Come on down for me, baby.
Its guidance, its confidence in meeting that full-year guidance. We'll break down these full reports for you.
Get ready for the end of the day trade.
Where the markets stand as we get closer to the close today. The S&P 500 trading up just about 1/10%.
Here she goes.
Some of the gains we saw earlier this morning, 67.42.14 right now. The Nasdaq just above the unchanged line at 25,147. On the Dow trading 6/10 higher at 46,982.81, and the Russell R lagged today down 0.5% at 2487.56. Checking in with some of the futures products, the dollar trading 1/3% higher at 98.71. Gold though trading down more than 5% back to that $4,100 level after hitting record highs above 4,300 yesterday. Crude oil trading at 0.5% higher at now 57.33 a barrel. And Bitcoin holding strong about 112,340, but sitting right around those levels for most of the day, up 1% higher than we saw it yesterday. But I do want to check in with Sam and see which top stories caught her eye today. Sam?
Yes, Sam.
Yeah, well, Molly, sticking with the corporate results, RTX, or Raytheon as it's been called, hitting a new high today after a solid earnings report there too. The defense company beating on the top and bottom lines, raising guidance on what the CEO calls
RTX.
strong execution in the third quarter. Sales are up across the divisions of the business.
That's a big company.
From both global defense spending and also commercial aerospace demand. The major defense contractor also reassuring about the ability to navigate some of those tariffs and other macroeconomic headwinds after previously saying it would
RTX.
take a $500 million hit from the cost of those duties. Now, gold meantime crashing today, as you just mentioned, Marley, pulling back from those all-time
Crashing.
highs and heading actually for the biggest daily drop in 5 years. Investors booking profits after the big run-up that we've seen in the precious metal, which has continued to hit new records lately. Silver also falling today after its stunning rally. Platinum and palladium tumbling as well. Now gold has been shining lately, as we know, on geopolitical uncertainties around trade. Expectations the Fed will ease rates in a weaker dollar. Traders are now eyeing this week's CPI report, next week's Fed meeting, and US China trade talks. But for now, send things back to Marley, who's with Jenny Horn in our Chicago studio with some of today's top movers.
Thanks, Sam. Like you said, Jenny Horn joining us here in our Chicago studio, co-host of Next Gen Investing, to talk about some of the top stories, some of which we just teased. Big movers on the day. First, let's start with this Warner Brothers Discovery story. We've been covering the rumors of this. There were some reports that Paramount Skydance had made a bid that was rejected. Now they've come straight out and said we are open to a sale, and we've had multiple unsolicited offers.
Yeah, I think this is really interesting.
See if I missed his support here.
Netflix's report this
Yeah.
afternoon. I tend to think
We got one right here.
It's a coincidence, so we'll see if we get any commentary on that from any spokespeople at Netflix, of course. But right now, we're seeing a pretty nice pop. We've come off of highs a bit here today.
I think I've done real good today.
Reports Warner Brothers Discovery is exploring a potential
Held on
sale
a little longer.
some or all of its media holdings right
We're
now.
coming right back to
And
support right now.
basically selling it.
But I'm going to give it a little bit more time because we're 5 minutes after power hour.
In light of the interest of the scene again,
We got a fallen wedge. We could come back and retest that shoulder line on the head and shoulders, which is right here.
But in a press release that its board of directors
If this
is looking
holds.
to a range of strategic options, including the process of breaking up into 2 publicly listed entertainment companies by 2026, which was announced back in June. But through the current split-up plan, the company would become home to its movie studios and HBO Max, of course, that streaming platform, while the other would include more legacy cable like CNN. But Warner Brothers Discovery did say it is still looking at other options like a potential merger, as well as a spinoff of Discovery Global to its shareholders. So shares have been on a really nice tear. I mean, this name was at one point earlier today, actually still today, pacing for the highest close we've seen in years. And we know that this comes after the Wall Street Journal first broke back in September that they were seeing Paramount Skydance preparing for that takeover bid. So this has been a long-standing story. But what we do know is the IP or the media offerings that this company, as well as Paramount to its credit, have created such a powerful portfolio of really just already existing content that it's seen, I think, as a huge interest right now. But I mean, another major pop, right now this name is one of our best performing stocks of the year.
I mean, this has the potential, any kind of deal here, whether it's a full merger, a full acquisition, a partial spin-off, to reshape the media landscape as we know it. So anything that happens here, no matter how big the sale is going to be impactful, and obviously the street is recognizing that with its 11+% move to the upside today. But we have a lot of earnings to talk about, as well as those were our other big movers today. Let's start with RTX. Raytheon is one of the big defense names that reported today. Walk us through some of their numbers.
Yeah, I think Raytheon was actually a shockingly interesting name of the session. We don't typically discuss Raytheon to this extent, or RTX as it's now commonly known, but I mean, pacing for its best day since November of 2020, and now up 6 of the last 7 trading sessions, popping after seeing, I mean, better than expected, pretty widely third quarter results. Earnings rose about 17% year over year. Sales were up another 12%, but revenues were better than expected at all 3 of their divisions. Notable upside was at their jet engine division, otherwise known as Pratt & Whitney, where we saw those sales advance another 16%. But sales at Collins Aerospace rose about 8%, and at their Raytheon defense business, that was up another 10%. And full year guidance was also raised. So they did say that they remain focused on executing on this $251 billion backlog, as well as increasing their ramp through these critical programs. And backlog did end the second quarter at around $236 billion. That was up 15% year over year. So I mean, not a single number that I just broke down is, I mean, lower than double-digit percentage gains on a year-to-date basis, which I think speaks to, frankly, the favorability we've seen for a lot of these defense and aerospace names now under the Trump administration.
Yeah, certainly, and we've had guests on both of our shows saying, defense is sort of an insulated sector and it will survive regardless of what happens. But, just another company reporting earnings sector sort of out of the conversation with record numbers across multiple business divisions and then raising guidance. I mean, it's a guidance story. We've seen that now up 8%, trading 8% higher. Coca-Cola's earnings more interesting, though. Looking at these sort of to gauge the consumer and the resiliency of the American consumer, and some interesting details coming out. Not soft demand, but slightly weaker demand, but good numbers, driven a lot of that Coke Zero Sugar was a real standout, which I was surprised by. I'm a Diet Coke enthusiast.
I'm rocked by this piece of information that actually, of all of their segments, that was the best performing one. I mean, it was up 16% in the quarter. Coca-Cola Zero, which, to my understanding, that's been around for like decades at this point. So I love to see a revival of like a tried and old reliable brand under their namesake Coca-Cola. But when you break down some of the numbers in this report, you could see why this reaction, I will say, muted relative to what we just looked at, but this is even outside of what options markets have been implying. So actually for Coca-Cola, this is not a muted move, but global unit volume was up 1%. Slightly ahead of expectations, but that is still beneath the 4% increase we saw back in 2022 in the third quarter, which was actually the last time they saw their global unit volume grow. So strength actually in Europe, Middle East, and Africa, that was up about 4% for that segment. North America, Latin America were pretty much flat, and Asia Pacific segment saw volumes decline about 1%. But a standout again was that Coca-Cola Zero Sugar option of 14%, not 16% growth is what we saw. Well, that did help offset some of the slowness we saw within their various other beverages. Like they saw some weakness in like juices and these concentrate type beverages, whereas actually water and more sports-focused drinks were actually a bright spot. And then plant-based beverages, value-added dairy, which I'm not even entirely sure what that means, but we're in the dairy alternative, dairy similar type space. Those actually saw volume drop about 3%. They also maintained their guidance, and so they did say that while the pricing environment has been challenging, they're trying to offer more affordability, but that's the fine line you have to walk right now to get consumers to continue to buy your brands, not trade down to something cheaper, while also maintaining your margins and maintaining this growth trajectory, which I think this report did prove that they're definitely still able to do that. But thanks to, I mean, not what we're doing here in, of course, North America, it's all thanks to overseas.
Yeah, their global sales were very strong. Interesting, too, the consumer picture that it painted, where they said the high-end consumer is still very much willing to pay for some of those premium products, you know, some of their smart water and Fairlife, some of their higher-end things, but they were seeing lower-end consumers buying fewer products. So sort of a confirmation of some of the numbers that we've seen, but in this data blackout, we're looking to earnings to sort of get some guidance on what the consumer is doing. But where we did see a really strong report was GM. Everyone who's talked about this one today, just startlingly strong report from GM, despite a massive charge in its EV unit.
Yeah, because it was, I think the narrative for a lot of the summer was the fact that there would be no space hit harder from these tariffs and the ongoing battle, of course, between the United States as well as the rest of the global powerhouses than automotives. I mean, and GM being one of the tried and true automotives, it was really, I think, a major concern from like a sell side perspective. But coming out today saying they don't anticipate tariff costs to be as steep as anticipated, their benefit.
Yeah, they came out earlier, the last earnings said tariffs were going to kill them. GM did. Next earnings report. Again, they lied.
$6 billion charge in relation to its reassessment of EV production, noting that additional charges would be possible. But Mary Barra did maintain that their EVs are still the company's North Star, that by acting decisively to address this overcapacity, they're actually expecting to.
There's 60,000 EV cars they made in the quarter.
It's amazing that they can say 40% of our EVs are now profitable, which is definitely a step in the right direction, but it shows that right now they're still really losing money on that business, despite the fact that it's a relatively smaller portion of it, I mean, their overall sales. But I mean, they did think that, I mean, directly thanking President Trump for expanding tax credits for automakers that assemble in the U.S. and saying that this can hopefully help offset some of their tariffs on imported parts. So there's a lot of appreciation for President Trump, and I think the real hurdle was the fact that we're not going to see, at least per the words of Mary Barra, the impact that was once feared by the market for hopefully a lot of these automotives outside of even GM.
Yeah, and they're the first of the big three for us to get the earnings from, so it will be interesting to see, you know, when Ford follows, and obviously we have Tesla coming tomorrow. But a number that really stuck out to me with this EV conversation was just that they went from having about 8% of market share at the beginning of the year to nearly 14% at the end of the third quarter. Tesla has a 46%.
Okay, we talk a lot about, you know, where Tesla is losing its real value and growth, but I think it's a really interesting conversation. It's not so much China, maybe. It's
potentially right here.
It's potentially right here.
Well, thank you so much, Jenny, for breaking down some of our top movers today. We appreciate it. That's Jenny Horn, the co-host of Next Gen Investing. And I do want to throw it back to Sam in New York to hear what we have coming up in the show. Sam?
Thanks so much for that, Marley. Well, coming up, we will take a look at expectations for earnings this quarter and look ahead to the Fed as next week's meeting approaches. Market on Close will be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List.
Oh, God.
Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Barnes on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. Let's just get a quick market update, see where things stand with about 44 minutes left to go in the session today, because suffice to say it's been a bit choppy. We are looking pretty range bound. If you look at the S&P 500 today, just up marginally right now. The Nasdaq is just basically on the line to the upside at the moment. The Dow Jones some gains there, however. The Russell 2000 losing some altitude compared to the rally we saw yesterday for the small cap trade, down about 0.5%. We continue to track obviously a lot of the earnings. It's been a big day of corporate results, so it very much is an individual stock story kind of day. There does seem to be a bit of a sell-off happening in the commodity space. So if we take a look at the US dollar, it is edging higher. Crude oil is up today as well, $57 a barrel. We've got Bitcoin, which is catching a bid now after some softness that we've seen in previous sessions. It had been down earlier today. And then that 10-year yield, which we continue to keep an eye on as well, given that we have got the government shutdown in day 21, with hopes that it might end soon. But who knows? The next catalyst being, of course, the CPI report on Friday. But right now it continues to hover just below that key 4% level right now. So let's take a look at some of the sectors as well, because it's been a bit of a mixed picture under the surface. Obviously, we're seeing a little bit of strength coming there through for technology, communication services having a good day. Consumer discretionary is outperforming there, up 1.5%. Consumer staples, though, having not such a great day, down about 0.5%. But the financials are holding up okay today, just marginally higher there. So obviously, we continue to track a lot of these earnings that we've been seeing. And then these are the rest of the sectors, and most of them actually being in the red today. So utilities underwater by about 1.5%. Real estate, materials and energy all feeling the pinch today. However, industrials is up about 1%. So it very much is a mixed picture, a mixed performance very much for equities today. And as we take a look at our mega cap tech as we approach some of these key earnings reports, obviously we've got Apple, which continues to climb, really catching a bid and very much marching towards, as Dan Ives has been talking about, that $4 trillion club as well. Amazon is higher today. We're going to be talking about the AWS outage and that affecting the company as well, but not so much in the shares today, up almost 3%. Meta Platforms is up marginally, and Alphabet as well, like 2%. And but we'll take a look at some of the other names in the space that are key to watch. Nvidia continues to be underwater, 9/10, and then we've got Broadcom lower by 2%, but Microsoft is just on the line there, and Tesla tracking lower off the back of what we've heard from GM, but also ahead of its key report card out tomorrow. Joining me now on the floor of the New York Stock Exchange is Alonzo Munoz, who's the CIO of Hamilton Capital Partners. Thank you so much for your time. Hello to you.
It's good to be here.
What do you make of what we're seeing out there? I mean, it just seems like a bit of caution setting in, but just not a lot happening out there right now.
Well, you said it best. It's a choppy market. I mean, we're floating near these all-time highs. If investors want to push this market higher, it's kind of incredible to see how much momentum we've seen to the upside against the backdrop of a government shutdown, geopolitical conflict, earnings. And so we're going to watch this very closely. It's an exciting time in this market, Sam, as you know, moves very fast.
It does indeed, but you say that you're taking a cautious approach heading into the end of the year. Why is that?
We are. Well, this market's been on a tear since the Liberation Day, or the April crash, if we call it. And technology has done really well, driven by the AI enthusiasm. So we're now looking across the spectrum and seeing gold near all-time highs, commodities near all-time highs, equities near all-time highs. And there's never a bad time to take a liquid profit and be opportunistic as this market gyrates.
Okay, so where are you taking money off the table, and then where are you sort of looking to reallocate?
As we look around, we're really looking at the long end of the yield curve, that 10 to 20-year space where we could be hedged in a very simple format, if you will, capture a little bit of income, but also wait for these opportunities where we can rotate back into the market. We see that as a very simple, fundamental play.
Where do you see some of the opportunities? Because it does look like some of the more sort of value plays.
Yeah, tell us where they are, buddy.
Absolutely, and if you look across all the major sectors, at least in the equity markets, everything is positive year to date. So if you're an investor with new capital, we're getting a lot of calls about this. Where do you allocate money? And what we're seeing now as we go into third quarter earnings is potentially some opportunities as maybe some of the froth comes out of the market. Some of these really strong AI names, if they sell off on earnings, opportunities to allocate capital there. But at the same time, we've talked about this over and over. I talked to Marley about this. There's opportunity in this market. Yields are still high relative to history. There's momentum to the upside, and there's great names out there, specifically in tech, that we still like.
Okay, can you run through some of those?
Yeah, so right now our biggest holding is Tesla.
Okay.
Major catalyst coming up November 6th, the shareholder vote for Elon and his pay compensation or his executive pay package. We saw the release of the Model Y and the Model 3, the standard version or the lower cost version entry model. We get earnings tomorrow.
Yeah.
So there's a lot going on. Google also is a big name for us. Great company. It's lagged a little bit in the AI space. And we have earnings coming up on the 29th with Meta at the same time. So I think Jessica earlier on the program said kind of spooky day.
Yeah.
And then the last one is Amazon. We were all talking about Amazon yesterday. Major disruptions. I myself got caught at the airport, disruptions at Delta. So those are names that we still like, we love, and we're looking forward to earnings and see how things play out.
There's been a lot of conversations around perhaps the fact that the CapEx boom might be sort of tapping out, and this could be the first quarter of perhaps several where the street starts to sort of question, show me proof of all that spend. Do you think that's going to be a concern, or do you think that's valid?
I think it is valid. And what we've seen over the last couple of quarters is increase in CapEx, really strong positive forward guidance, really solid earnings across some of these tech names that justify. We talk a lot about the dot-com bubble and how this compares, and we really don't think we're in that space. I think we're all talking about a potential boom and bust moment. We just don't think that's the case. We're looking forward to earnings and see how that plays out.
Yeah, I mean, so far so good on the earnings picture. I mean, particularly when you look at the banks, I mean, we heard some good numbers out of GM today, particularly with regards to their outlook, particularly around the T-word tariffs, which seem to sort of spook everybody sort of last quarter. But, some of these companies seem to be sort of navigating that, particularly as it sort of eased the pressure on that front when you look at autos. So the corporate results, I'm looking at 12.8% on EPS growth so far, and we're looking at about 80% of these companies that are reported so far actually having beaten earnings. So what's your take on sort of where we go from here and whether we're going to be able to keep this up for the rest of the earnings season?
Well, that's right. If you take everything you just said and you add it to the fact that the economy is strong, we have really good momentum, there's business-friendly policies, we're seeing some deregulation, the Fed is starting to cut rates. We expect for them to cut rates 25 basis points next week. And so these are all positive catalysts as we go into the back half of the year in 2026. Sam, that's not to say that we don't see risk in the market, and that's why we talked about the long end of the yield curve and maybe taking some chips off the table. But ultimately, this economy is strong, and we're seeing it in GDP revisions, GDP growth. We're seeing personal income, personal spending, all higher than expected. And this month, we haven't got a lot of data, and so we're going to be watching that very closely when the government hopefully opens back up.
Right, that's it, isn't it? Because we're going to be getting the CPI, which is likely to be the sort of catalyst for these markets, although it feels like a lot of these events, including the Fed, is largely priced in at this stage. But, you say that you're approaching with caution in a market which has got a lot of pretty good, strong tailwinds right now. So what is the biggest concern on the minds of some of your clients right now? What's the biggest question that you're fielding?
Well, we're seeing a lot of major volatility. For example, we don't invest a lot in crypto, but the crypto market sold off when President Trump tweeted about China, and we saw a lot of people lose a lot of money. And so we're always remembering and looking back at moments like 2022, 2020, where you could have periods where the market just sells off and the momentum shifts to the downside, and people get really nervous. So this is an environment where if we can take some gains off the table and be ready for a pullback, we're certainly going to do so.
And what about positioning around some of the commodities to really capture what we've seen as far as the nice rally in precious metals?
Everyone's been calling me about gold, and gold continues to climb higher. Not today. We've seen a big pullback, big reversal in gold and in silver. And this is what we talk to investors about. You have to be careful when you start to chase trends, and gold got a little bit ahead of itself. And when we see moments where the market pulls back and takes some froth out of the market, there's end up being good opportunities as well to maybe start a position or look for opportunities.
Okay, good stuff. Going to have to leave it there, Alonso. Thank you so much for your time and coming in. It's been a great conversation. Alonso, who is from Hamilton and Capital Partners. I'll send things back to Chicago with Marley.
And thanks so much, Sam and Alonso, for that. Coming up next, we'll revisit the big AWS outage that brought multiple companies to a halt yesterday. Market on Close. We'll be right back.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall, on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden alongside Sam Vadas in New York. Netflix will be in focus after the close today as it will report its earnings for the third quarter. EPS expected to come in at $6.89 on revenue of $11.52 billion. Netflix has topped expectations for revenue estimates in 8 straight quarters. For this quarter, investors will be focused on guidance following the success of its K-pop Demon Hunters movie, as well as its content lineup going into the fourth quarter and its expansion into live sports this year. Shares are up about 40%.
Think I should short it, Marley?
But Netflix certainly not the only big earnings announcement that we have coming our way. There's so many huge earnings this week. Texas Instruments also out after the bell. Capital One, Mattel, Chubb. Tomorrow before the bell, we've got GE Vernova, Vertiv Holdings, AT&T, Hilton and Boston Scientific. Then after that, we've got Tesla after the market closes, IBM, QuantumScape, Kinder Morgan, and Las Vegas Sands. Lots of big names reporting, lots of potential market movers in here. Very much been a guidance story so far this earnings season, much like we saw last season. But I do want to broaden out our conversation, bring Sam back into the conversation.
Oh, she's going to broaden it out.
Joining us now is Daniel Tobach, the CEO of Cipher. Daniel, thank you for being with us on Market on Close today. If you wouldn't mind just starting by telling our viewers a bit about your company.
Of course, thanks for having me on. Cipher is a global digital forensics recovery company that operates across the globe, helping companies recover from incidents and cyber attacks.
I just want to sort of get your steer on, obviously, the news of the week, Daniel, and that was the fact that we saw this AWS outage. I'm just wondering, because you're sort of in the business of these sorts of things, what you thought of that, and what are some of the concerns about, other episodes like this potentially in the future?
Yeah, there's been a lot of speculation around AWS and the how and the why and the where. Incidents such as AWS once again remind us of the fragility around internet connectivity, internet backbones, and just the way we are reliant on it.
And Daniel, in terms of the broader cybersecurity conversation here, as we saw just how vulnerable we are, in fact, yesterday with this AWS outage affecting everything from the airlines to McDonald's to dating apps and Venmo, more broadly, how broad should this conversation be as it relates to the markets overall when we get these glimpses with the CrowdStrike outage and AWS of exactly how impactful they can be?
Of course, when you're seeing where we are over the past 25 years and our reliance on connectivity, there's a lot of things that are out there that are actually causing us to be offline, which is literally putting everything and halting it to a stop. You have cyber issues which take down networks, you have connectivity issues, you have the grid issues, and that is really always the question that we ask. There's things that we cannot control because of overload, but always, the angle that we see out there with very large organizations is what happens if we get attacked? What happens if there's actually a cyber incident that takes down this infrastructure that we're all fully reliant on? Just like you said, from McDonald's, from ordering food to actually running operations to actually providing services to the public. And we see this across the board between organizations and government. We're consistently relying on this connectivity to be up. And I always say there is a plan for backups. Sometimes it takes a little too long. Sometimes it takes a little too far of a plan. But we are all basically dealing with the results of the instability of that.
So what's the investment thesis there then? I mean, how does one approach this? Because I remember when we were talking about that CrowdStrike outage, and some have been talking about sort of in the aftermath of that, how this is actually a good opportunity for the company to actually prove itself, how it can manage to bounce back from such an episode like that. And we're sort of seeing a similar thing with Amazon with some of the commentary right now, trying to obviously reassure the markets about this. So how should one be approaching that?
Yeah, what we've seen, for example, with CrowdStrike was actually the true resilience of organization to bounce back after the matter that happened not too long ago. And at the beginning, like any other company, when there's downtime, there's quite a lot of worries. The market is reacting a certain way to that, but they have been able to bounce back and actually show their resilience of how they're able to handle the problems, and stocks went up since then. And when we're looking at AWS, again, I think they've done a phenomenal job so far. I've been following it very, very closely because, again, there was quite a bit of a shakeup. Why are they down? Is it a cyber attack? Is it the grid? Is there infrastructure issues and so on? So they've been very upfront. There've been lots of communication out there. I think it's very important both from an investor point of view and the fact that having such a large organization bounce back as quickly as they have. I know they're still working on a couple little things out there, like, for example, the Lambada system, but again, they're all over this. I think they had a very resilient plan, and it's very nice to see that some of the largest organizations in the world actually have it together.
Having it together and seeing this quick recovery is great, but how do we plan ahead for the future now, as we've already seen in multiple instances just how impactful this can be, not just for the company being hacked, but all of the companies who are affected, both large and small? How do they prepare for the possibility of this happening?
Yeah, I think that's a great question. I think it's very important to put things into perspective. And I think we expect always 100% uptime in everything that is out there in terms of technology and digital. We do have to have a little bit of a calibration that it will not be 100%. There will be some downtime, and we do have to prepare with backup plans on how we actually mitigate that. I mean, this is just, after almost 30 years of doing this, there's no such thing as 100% uptime. We just try to get to what I call the 99.99%. And then you have to prepare plan B and C and potentially D to make sure it does not affect as many people.
What are your thoughts right now on this whole idea of sort of consolidation in the space? I mean, obviously with a couple of names like Palo Alto, there has been some suggestion that they are looking to be a sort of one-stop shop to address all the customers' needs right now, particularly with the booming demand for artificial intelligence, which is obviously then ramping up the risks that are involved here, so the IT budgets are there. But I mean, what then are the risks associated with being a one-stop shop if you have an incident like this?
There's always pros and cons. One of the pros, we're seeing a major consolidation in the market globally as some of these very large organizations are stepping up and are able to offer more to their customers. Again, the saying is never put your eggs in one basket, but when we're seeing these very large consolidations out there, I believe that they're able to offer more and more services to their clients and actually looking at a bigger part of their security and their planning around the cybersecurity, security operations as a whole. Because what's happening today in the market has been happening for the past 10 years. There are just way too many companies out there that are touching little pieces of somebody's planning and somebody's mitigation plan. So as some of this consolidation happens, I actually believe that it's better for companies as now these original organizations have more insight and are able to help them more with their posture and in preparation for any type of an incident.
Well, Daniel, we appreciate you being with us, especially on the heels of this AWS outage, to talk all things cybersecurity. That's Daniel Tobach, the CEO of Cypher. And coming up next, it's Options Corner. We've got Rick Ducat joining us here in our Chicago studio to take a look at GE Aerospace after shares touched a record high following earnings. That's next on Market on Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risks. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading Schwab is powered by Ameritrade, giving traders even more ways to sharpen their...
earnings, moves to the upside, trading up more than 1%. Have to say I'm in New York, though, and find out who we'll be talking about for overlooked stock today.
Well, the overlooked stock is T connectivity. So Alex Coffey is going to get us across that one heading into the close. Shares touching a new all-time high today and up 60% this year. So he'll break that down on what you need to know about it on Marked on Close coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so. Sometimes, you know.
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your
Bingo, baby.
best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Experiencing technical difficulties.
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Schwab Network. Available anytime, anywhere, on any device for free.
Welcome back to Marked on Close. I'm Tam Barnes, live from the floor of the New York Stock Exchange. It's time now for overlooked stocks, and today we're watching T connectivity after sharing at a new all-time high today. And I'm joined by Alex Coffey, Senior Equities Contributor, to tell us all about that. T connectivity is higher today, as we mentioned. What's the reason behind all of that, Alex?
Yeah, I think first off, this is a pretty big overlooked stock in the sense that we're talking about a company that's got a market cap of about $67.5 billion, employs about 85,000 people worldwide. It is incorporated in Galway, Ireland, which I thought was interesting. But it is truly a global company, Sam. When you look at where it generates revenue, about 37% in Europe, Middle East, and Africa, 34% in the Asia-Pacific market, and then the balance around 29% in the Americas. It's a global technology company that designs and manufactures connectivity and sensor solutions for a wide range of industries. With its biggest being transportation solutions, so thinking automotive and commercial transportation. But this is a company that got a outperform rating and a price target increase from Evercore ISI, increasing the price target to 250. We're expecting earnings next Wednesday before the close, so perhaps on the heels of some of the optimism you saw out of some of the names that reported today, you're seeing a pretty big move today in TEL.
Yeah, interesting. You mentioned that market cap of about $67 billion. I'm just looking at it sort of compared to its industry peers across the space. I mean, it's Amphenol, for instance, Corning, DuPont, Celestica, TDK Corp. And, you know, it sort of sits in the middle of the range as far as market cap is concerned. I'm just wondering, you talked about some of that international exposure, but sort of where does it stack up across the sort of industry peers in this space?
Well, what I would say is in this case, there's several different peers that it would have depending on the segment you're looking at. When you look at its transportation segment, obviously that's going to be different from its industrial solutions segment and even its communications segment, which of course is providing components for data, wireless, and consumer applications when you look at that particular segment. So when you start talking about these companies that are kind of larger conglomerates that serve multiple purposes, they don't really have pure competitors that are easy to compare them to. When you start to think about this particular company, though, companies like Honeywell and others oftentimes pop up. When we look ahead to next week's earnings, I know analysts are very focused on a book-to-bill ratio as a key indicator for its mixed kind of end markets that it has. One of the things that also is going to be important to watch is the transportation sales, as that's been more of a sluggish segment for it. Particularly as Europe has been weak as a region, so it's its biggest segment and its biggest market. That said, though, they do have some decent-sized growth in China, and their margins have been pretty flat to steady despite some of the cost inflations that they've dealt with. It's been a bounce-back year for this company when you start looking at its performance over the last few. Revenue had been relatively anemic. There wasn't really any organic growth last year. That's expected to change for this year as the balance of the year is expected for about 5.4% organic growth and about 8% in total revenue growth, which would be a bounce back from the 1% declines the last 2 years in revenue. So a company that's really starting to turn the corner and really start to assert itself as a key player within its industries.
Oh, for sure, and as you mentioned, quite a diversified business here, particularly when you're looking across the industrial space, and it's also in sort of the business of the
180
as well. I mean, the 60% rally that we've seen year to date. I know you just mentioned, obviously, that it's been sort of catching a bit, but I mean, is this just a general function of the fact that we have seen a sort of good run for industrial broadly speaking, and also off the back of just basically the AI hype and the whole sort of broader technology thing?
Yeah, I think that there's your narrative as to why this company is getting some love, but it also has the fundamental picture to support it as well. I mean, if you look at its performance in its fiscal year 2023, its earnings declined by 8% and its revenue fell by 1.5%. You look at last year's, or its fiscal year 2024, revenue declined still by 1.18%. It had negative organic growth percent of about 1/5 of 1% to the negative. But it started to show earnings growth. It grew its earnings by 12%. It was able to maintain that if it hits its numbers throughout the rest of this year and actually increase that to about 14% earnings growth. But its revenue growth also bounced into something positive now, about 8%. So I think you have the narratives as to why this is a company that is maybe being supported by the market, but the numbers financially also support the rally as well as a bounce back year.
Okay, fundamentals look good, and a couple of tailwinds for this company as well. Thank you so much, Alex. TE Connectivity sitting up 1% right now. I'll send things back over to Marley in Chicago.
Thanks so much. We're nearing the end of the market session. We'll be bringing Kevin Green in to break down the levels he's watching on the S&P 500. We've also got earnings on the way with Netflix and Texas Instruments set to report after the bell. Stay with us.
Real-time access, data-driven analysis, from U.S. equities to global macro matters, Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter where you are, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock. And that could certainly be short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers bring traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, morning movers only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
We are back here at Market Close and Sam Bartis here on the floor of the New York Stock Exchange alongside Marley Cated in our Chicago headquarters. There's just a few minutes left in today's session, so let's welcome in Kevin Green, Senior Markets Correspondent, to help us close out today's session. Kevin, what levels are you watching on the S&P 500 as we head into this close?
Well, we've had a lot of consolidation here today. If you're looking at the S&P just in general, we had a little bit of a shake-up after President Trump's comments, but we were able to level out for the most part here. Now, going into the close, the big area of resistance, at least for today, has been that 5750-ish area. Technically speaking, that has been a big area that we've been kind of focusing on here over the last month or so. We obviously had that pullback, and now we're trying to retest it, seeing some selling activity kind of getting into that level here. To the downside, you're looking at 67.30, so a pretty tight range if you're looking at around 20 points. Right now we're trading kind of in the middle of that range, but overall we actually had a pretty decent day when we're looking at market breadth. Over 60% of the stocks in the S&P 500 in the green so far, and it's been more of a value trade. If you look at those dividend payers or those that are trading at relatively cheap multiples compared to the broader S&P 500, those are really the stocks that have been kind of winning. And unfortunately, because they're a lot lower when it comes to weighting in the S&P 500, they don't have as much of an impact like the Mag 7, which for the most part is kind of mixed overall. But volume, for the most part, I would say it's still kind of light, just kind of similar to what we saw yesterday. And once again, we're just probably waiting for earnings to really try to break us higher, or a new narrative. And hopefully, this narrative when it comes to China and the United States, hopefully some of that commentary actually kind of abates here as far as some of the negativity, and that probably will also lead equities to the upside. But the volatility is coming in, for the most part, rolling up. We're fairly close to all-time highs here. We just need to break through on some large volume in order to confirm that the trend is still to the upside for the S&P.
And KG, we talked about this volume story yesterday, sort of likened it to almost like a holiday Monday. But if we're still seeing this light volume today, knowing that we have some big names reporting today, some more big names tomorrow and Thursday as well, what's it going to take? How light are we? And what's it going to take to get that volume back on track to give us that push through these resistance levels?
Well, I think it's going to be the commentary from the conference calls. Now, Netflix is probably not so
commentary.
They're not really going to impact the AI trade for that matter. They're not going to really impact the semiconductor trade or anything. But the commentary that we're going to hear from Tesla or even some of these other names over the next couple of weeks or so, we'll actually be able to digest that and then try to impose some of that commentary on other stocks. For instance, Google and Meta, if they continue to talk about the increase in CapEx spend because of artificial intelligence and because of the expansion in data centers and their power needs, then that also gives these thematics more fuel to the fire to move to the upside. And in fact, that's exactly what we saw today. A lot of the themes actually lost a lot of steam. If you look at, let's say, the uranium trade, saw a pretty aggressive pullback to the downside when you're looking at the URA, or if you're looking at other components within that trade, the Oklos of the world, things of that nature. You also saw maybe some of the other power players just in general, the utility names that are out there, the CGs of the world, selling off here have been, even quantum selling off fairly aggressively here today. And these are really the themes that have been holding up because of this overall narrative of expansion of artificial intelligence, expansion of quantum computing and power needs. And then once we lose that, we need something else to kind of backfill. And I think the earnings announcements and the commentary is going to be able to do that.
Yeah, certainly interesting, particularly wanting to hear from some of the power companies as well, GE, Vernova, how they're sort of placed to take advantage and capitalize on some of that as well. KG, just a couple of minutes now, less than that, 1.5 to the bell. So just want to get your thoughts on what we've seen across the commodity space today, as we have seen a bit of profit taking going on there.
Yeah, we have seen a pretty aggressive pullback in gold. Obviously, we've been kind of leading up to this moment. We saw a large volume candle on Friday. Yesterday, we had a retracement back to the upside. I would say the volume was relatively light if you kind of look at the last 7 days.
Here we go, back to the old support. And ain't got enough time to take the trade.
The volume actually has been a little bit lighter than I would.
Now, if we were in midday, or I'd take it right here. I'd take this trade. I'd take it. I'd take it. We've been holding that support all day. And that's the top of that yesterday's channel. So, we got Netflix earnings after hours. I'm thinking, I'll show you why I'm hesitant on taking this trade. Only technical reasons. Let's look at a different chart. Because it's a head and shoulders, that second shoulder line. So if it could break out and have a double top, find some resistance up here. But I called this out down here at the bottom when I hit my alert. I think I got it even in the room. Let me see. Yeah. So I put this, and we were cheap then, but we're not cheap anymore. This was on the 16th. Netflix triggered alert 1186.61. That was right down here on my alert. And that was an inverse head and shoulders, kind of. A little bit overbought, and then that was a low buy. But see, we just dipped hard. Now this is going to be a buy. Oh, fudge. If I had money, I'd buy it right now. I mean, I do, but I ain't. I'm talking about 11. You can't buy options. Buy 5 shares. Boom, baby. I still think it's way overpriced. I mean, this is perfect. God, I wish I'd. We'll see if it stays there tomorrow. I'll swing this sucker. Because I think this thing's way overpriced. I really do. I mean, even at this level. But I'm not into Hollywood. That was the reason I said when I got in the trade a couple of days ago, I said, I'm not into this, but I'm going to trade it. I'm not into it, but I'd trade it here too. I mean, they're putting out some weird shit. Netflix is. And they come out, well, WWF is going to be on there. Well, also they got child molesters and freaking transsexuals on there too. I know a lot of people that, well, I don't know a lot. I know a few. People that, I mean, there's people out there that just, that's all they do. They're couch potatoes. I don't watch TV. I watch YouTube a lot. I haven't watched a movie. I get bored. You know, I just sit there twiddling my thumbs when I could be doing something more. I got rid of my TV 5 years ago. 5, 6, maybe 6 years ago now. When they took Cops off the air, I got rid of my TV. I said, that's it. I'm done. This politically correctness stuff, I've just had it. Cops, that's all I watched. I mean, that's what kept me out of trouble. That's what kept me at home on weekends. Me and my dog would sit around and watch Cops. I think I bought 2 TVs in my life. Maybe just one brand new TV, and the rest have been used. Hand-me-downs. Yeah, maybe just one TV. And that's probably 20 years ago. 25 years ago. Been a long time. 20 probably. Okay, well, I'm going to get out of here. YouTubers, thanks again.